morning, ladies and gentlemen. Welcome to the third and last, unfortunately, day of the CEE Sustainable Finance Summit 2024. My name is still Julian Toth, and I'm the CEO of ISFC. Really good to see so many of you still here, and hopefully you are learning a lot of valuable information. Today, we will go a little bit deeper into sustainability in business. Now, we discussed sustainable finance policy on Monday, then banking yesterday. Obviously, it is all very much interlinked with business. But today, the idea is to go and dig a little bit deeper into what sustainability means for businesses, for companies, especially how it can be perceived and how can it be leveraged as an opportunity, and how can integration of sustainability principles into strategies, into business models, products, and activities, how can it be turned into a competitive advantage, right? And exactly today, we have multiple panels and discussions and keynote speeches focused on that. We will go through also CSRD reporting and how some of these new sustainable finance policies, how exactly are they integrated, how are they applied and implemented in practice, what does it mean exactly? I actually recently had a meeting with a board member of one company here in Czechia, where actually really large company, fairly unknown because it's in distribution and it's sort of B2B business, and they just realized that there is some CSRD regulation. So we had a quick chat and a quick workshop about what exactly it means, what are some of the implications of the CSRD regulation for this company. So I showed them the KPIs and the complexities of this regulation, which for people who have never seen it before, maybe a little bit daunting and scary. But then as we went through some of the KPIs and started discussing all the data that needs to be collected and all the sustainability aspects and strategic elements that needs to be discussed, even the board members who are focused on sales and commercial aspects, realized and actually started looking at it from the perspective of certain opportunity to reflect back and actually analyze their operations, to see how some of the aspects, some of these activities under E, S, and G can be improved, maybe for better competitive advantage, or maybe even for improving some of the products, maybe managing the cost, and many other advantages. So this is something we want to explore today more in practice. We will also go and talk about transition planning. We have an entire panel dedicated for that. I think this is one of the biggest topics nowadays. This is something Martin Spolz said on Monday. We obviously have a destination, 2050, net zero. How do we get there, right? So the companies actually have to think about it, have to have very concrete action plans and roadmaps, how to get to 2050. For that, we need some plans, some plan for transition. So we have an amazing panel on that. And then we actually dedicated, I think, entire afternoon to real estate and to built environment. One of the most important topics when it comes to transition, the building stock. There's a huge need, especially in this region, to improve the building stock and to reduce the emissions. And that's that we also have quite a few very interesting panels on that. So maybe without any further ado, I'm enjoying talking to you one last time, obviously. But now, please let me introduce the first keynote speaker, Nathan Fabian, from the UNPRI. He's Chief Sustainable Systems Officer. Nathan, please come to the stage. Nathan Fabian, in my view, we still have many investment funds here, I think, and financial institutions, but maybe for some local businesses and so on. UNPRI is the largest global platform for sustainable investors. You will probably maybe mention that as well. From my perspective, Nathan is one of the most instrumental people in development of sustainability, not only policy, but also practice, not only in the EU, but also globally. So very much looking forward to your keynote. Thank you very much.
Thank you, Julian. If I may start by congratulating Linda and Julian for the energy that they're bringing to this discussion in this region and this successful event, and to your good judgment for attending now maybe for a third day. So as Julian says, I'm from the PRI, and I'll tell you a little about the PRI, but I'd like to start with a premise for my remarks to you today. I'd say that sustainability is becoming a core function of financial markets, but it's true that our work is not yet done if markets are to play a meaningful and substantial role in a sustainable net zero world. For those not familiar with the PRI, It is the leading proponent of responsible investment around the world. It was established in 2006. It came out of the UN system, and this is why, even though we're in finance, I can talk to you about a sustainable world, because there's an international framework of agreements that sit behind that UN system on finance. And today we represent a community of over 5,500 investment organisations who collectively invest over $120 trillion of the world's savings. This is over half of the world's savings. So over half of the world's savings pool has committed in some way to consider sustainability and ESG factors. And we're driven by this view that an economically efficient and sustainable global financial system is a necessity for long-term value creation, and that this system must inherently benefit the environment and society if it is to benefit the investors in the future. So there must be these multiple benefits if it's to be sustainable for us. And to enable this, we work with our investors on incorporating ESG factors into their investment decisions and our evolving understanding of fiduciary and investor duties. And what we see is that investor practices are evolving rapidly. There is an increasing demand for data, for target setting, for planning, and of course actions by corporations on sustainability drivers. Now, 5,500 investors, let's be honest, they don't all take the same deep approach on sustainability. But you may not know that there are now over 1,000 of these investors, the largest ones, that voluntarily participate and collaborate and take on additional commitments to guide their investment approach. This includes incorporating their own environmental targets, transparency beyond regulatory obligations, active stewardship and engagement of corporations, and close work with financial regulators. You may have heard of some of these alliances. They focus on net zero, they focus on nature and human rights. Now, the Net Zero Asset Manager Alliance, you may have seen, it's been in the news recently because of the situation in the United States, and I'm happy to talk about that. But it has more than 300 signatories of over $55 trillion in assets, and 250 of those signatories have identified their own net zero targets for their portfolios. There's also an Asset Owner Alliance, and the level of target commitment against those 100 members is even higher. So we need to start to think about the implications of large institutional investors who set the tone in capital markets adopting these kinds of objectives. Now, nature is a growing issue for investors, and so I want to briefly mention it. We also have an initiative that focuses on the relationship of nature and human rights and supply chains, and I think it's a good example. There's an initiative called Advance, which focuses on the incorporation of human rights questions in the supply chains of the agricultural sector and technology product sectors. And as we think about our global economy and supply chains and due diligence questions and nature, these issues are becoming even more important. Now, not only are these investors actively setting these obligations, they're also disclosing more on what they're doing. So investors are taking some of the load of the transparency burden. We all know that for years, investors said, oh, companies, answer this questionnaire, provide this information for me. But the truth is investors are starting to take the load as well. Over 4,000 of our signatories disclose their own use of climate scenarios, their own use of which metrics they consider in their risk management approaches. These are in advance of regulatory obligations which are now coming in so clearly. Now again, of course, it's a spectrum of depth and rigour, but the point is they're doing this beyond regulation. So why are investors taking these steps? So my point here is to try and emphasise the demand side of the equation in capital markets, which is growing. Investors can see that countries have set national targets on climate and on nature, and they can see the expectations or the consequences of these targets coming through regulatory and policy settings. Also, policy change is being pursued by countries on climate. It's easy to be negative. It's easy to see the forecasts of more than 2.5 degrees of warming. But our own analysis, which we call the inevitable policy response, shows that if countries continue to implement climate policies at the same speed, peaking of warming at somewhere between 1.7 and 1.8 degrees is still achievable. And we know that we must achieve that level of warming because after 1.8, we don't really know what happens. But if the policy change keeps accelerating like it is, we are positive that we can get there. Investors can see that. And of course, we have central bank and financial regulatory oversight increasing. We have expectations of clients and beneficiaries increasing. And so the interpretation by investors of what is prudent and diligent today is also shifting. And so will the court's interpretation of what is prudent and diligent. So as a result, financial market expectations of companies is shifting as well. Investors expect to see data. They expect to see plans that reconcile climate and nature science, national and regional targets, anticipate policy and technology change, and transparently disclose. And for these to increasingly form our plans on transition. So before we even get to the regulation, I want to start with the demand and these signals that are coming through the capital markets about what we can expect in future. Okay, so now let's discuss financial reform. I know you spent some time on this on Monday, but I hope you don't mind. It's worth just noting that financial market reform is global, it is accelerating, and it is necessary. The first moving markets have moved. The fast followers have followed. And all the other countries that want to keep pace with reform in financial markets are now stepping in. This is the stage we're at on the reform curve. And globally, we see concrete reforms in many areas of financial system function. Every few years, PRI examines the state of investment regulation around the world on sustainability, and we're just about to release our 2024 update, and I thought I'd give you a few of the stats before we do. So we assessed policies across 28 countries, leading financial centres and economies. And our update will show that there are over 300 new and revised regulations since 2019 that support or require the incorporation of ESG or sustainability into capital markets. Of these, 230 apply directly to investors, stock exchanges, or other financial service providers. And many of the regulations directly reference global frameworks that deal with sustainability. For example, of these 300, 206 mention the Paris Agreement, 73 the UN Guiding Principles on Human Rights, 9, we were looking backwards, on the ISSB standards, so that number will grow, and 4, the Kunming-Montreal Global Biodiversity Framework. The point is, these global and national targets and frameworks that we assumed would be voluntary spaces are being incorporated into policy and regulatory requirements in explicit ways, which means that we have no choice but to respond. Now, specific types of reform. And the reason I'm taking you through this is because I think it can be tempting and possible to assume that Brussels is driving this, but that's no longer the case. Certainly Brussels invested early on behalf of Europe, but we see that the reform is truly dispersed and accelerating around the world. For example, we have corporate and financial product disclosure obligations in the UK, good example of a fast follower, Australia, Japan, and Argentina. On environmental benchmarks in the form of sustainable taxonomies, there are almost 40 under development around the world, including in Brazil, Canada, Indonesia, Singapore, South Korea, the list goes on, and 8 already have some form of regulatory backing. There are 25 countries around the world that have stewardship codes or regulations, including Japan, Australia, Malaysia, South Africa, India, the list goes on. This is all these countries developing their own financial reform packages because they can see where capital markets are going on sustainability. And I think the duties question is quite interesting. As markets are expected to pick up these types of targets and reforms, the big question is how far will investors and corporate directors be expected to go on sustainable outcomes? And it is the EU example, but it's interesting. As of August 2022, you may know this, insurance and reinsurance companies were required to take account of the potential long-term impact of their investment strategy on decisions on sustainability factors as part of their prudent person obligations. So when we start to move into this legal zone of what the job is of the prudent investor, I think we're seeing genuine and quite substantial change. Now, I'd like to focus briefly on China and the US. The Chinese economy matters globally, obviously, and the US, there's a bunch of quizzical things happening in the United States at the moment, and we should just reflect on what they mean. So, in China, on corporate ESG disclosure, there have been requirements issued for state-owned enterprises. Always the big question for economies with a lot of government intervention in the economy. But state-owned enterprises in China have had ESG reporting requirements issued. In addition, stock exchanges. Last month, China's 3 major exchanges officially released sustainability reporting guidelines for listed companies. So these are indexes that you may not have heard of. The SSE 180, the Quechuang 50, the SZSE 100, the GEM 100. So what does this tell us? It tells us that China is trying to build the capacity of its capital markets with sustainability disclosure obligations. Very important. And then earlier this week, I think it was Monday, China's Ministry of Finance issued an exposure draft on Chinese sustainability disclosure standards for business enterprises. Now, where this leads, we need to see. It's an exposure draft and there's a consultation. But at the PRI, we hope this is the start of an adoption process on the ISSB, and we'll certainly be advocating to that end. So in the US, now there's 2 interesting things happening in the US. 3. The first one is that they've produced a massive subsidy for industry called the IRA. We need to think about the dynamics of that. The second is that there's a pushback against ESG, or an anti-ESG movement, which is political. And the third one is, don't say this too loudly, they're getting on with their financial reform anyway, despite these 2 points. And it can easily be missed. The US Treasury released 9 principles for net zero finance to provide guidance and validation for investors establishing goals and frameworks to work towards net zero goals. The SEC provided guidance to investors seeking to undertake collaborative engagements, saying that they were able to do so as part of their fiduciary roles, and it issued scenarios under which investors could collaborate and stay within the law. The SEC also finalised the fund's name rule, such that any fund described as ESG or sustainable must have those characteristics in 80% of the underlying exposures. And of course, California, which makes rules for much of the world, let's face it, on sustainability, approved 2 laws requiring large companies operating in the state to disclose climate-related financial risks and scope 1, 2, and 3 emissions. Now, it's easy to think that this reform's not happening because of the fight, but the truth is there is change in financial market regulation in the US. Now, they've also dropped a very big subsidy, or incentive, as our American colleagues like to call it, and that's reasonable. The truth for Europe, and I think for many countries of the world, is that it's unlikely that the same level of subsidy will be offered, or incentive, from public finance. There will be public finance offered, Europe already does it, but the question is whether that will be the primary model that's used to compete with an economy like the United States. I think it's more likely in Europe that we're relying on a combination of public finance and private finance. Of course, the US wants private finance as well, but it makes sense in Europe that there's more emphasis on catalysing private finance as part of the readying of the economy and capital markets for transition, because the subsidy won't be as large. The incentives won't be quite as large. And so I think it's important that we're thinking about what capability we need to have in our private capital markets to support transition. And in that context, these regulations and reforms start to make even more sense. So why are governments implementing these changes? Well, I've mentioned some of the reasons, but there's a combination of risk management capability and making sure that markets are aware of the scale of transition that's coming. And so there needs to be an absorbing of the likely facts of transition as we face it. Of course, financial regulators want to stress test their financial system and their portfolios in their economy to understand how well positioned they are. And of course, there's a building of expertise that goes along with that. There's a need to build trust amongst our counterparties in financial markets. And ultimately, if you want to have trust in capital markets, you need transparency and you need standards. And we want to maintain our capital markets as well-functioning parts of transition. And of course, there's this point that I mentioned around raising flows. We must raise additional flows of allocations of capital so our economy can transition. And of course, this is a key issue in this market. And so as I conclude this part of my remarks, I'd say it's easy to think that the EU is operating alone, or that it is one of the only markets that is moving. But this is just fundamentally not the case. In the 7 years since the EU commenced on this additional round of financial reform, the rest of the world has moved as well. And now we have a truly global approach on financial system reform. And so, the demand is there, the regulation is there, and the policy is accelerating. But you might ask, well, so what does this really mean for me in Central Europe? And that's reasonable. And the main thing I would say it means is that the potential for finance to support economic transition and competitiveness in future is what's on offer. So the potential to support your economic transition and competitiveness in future. That is the reason it's in your own interests. Now, in financial markets, there's only two things that matter: access to capital and cost of capital. That's what really matters. Asset allocators consider the cost of investing as a primary factor in their strategic asset allocations. You'll know that index funds might be between 10 and 40 basis points of cost. Active equity funds, maybe 100 basis points or more. Emerging market small caps funds, 200 or more. And if we're talking private equity, well, wouldn't we all like to earn the returns in private equity? But the point is, these kinds of cost decisions really matter on asset allocation. And so if we want to participate in lower cost capital structures, we need to support the standards and the information flow that enables those markets to operate in a low cost way. And so if we want to increase access and reduce cost of capital, we also need to participate in these systems. Now, I'm not promising ingredient, but the truth is what we're doing is reducing the cost compared to other forms of asset allocation, and this still matters for accessing that capital for transition. And so standardised reporting frameworks present an opportunity for Central Europe, and ultimately that is increased access and lower cost capital. And there are signs that the transition is there. You will have seen the data, another $1 trillion green bond, sustainable bond year in 2023. And now under SFDR, over 25,000 funds disclosing, investment funds disclosing how they're placed under SFDR. And in the year to March, the inflows to Article 8 and 9 funds were more than twice as high in their increase than Article 6 funds. And so the signals are that this demand signal I'm describing is coming through in fund allocations. Now, we shouldn't pretend that this is all perfect. There is a burden coming on our corporations, and in many cases, they may not be happy about the level of work. And so we need to take steps to try and improve the framework that we've got. EFRAG and ISSB just issued interoperability guidance, which is very welcome. This is something that can reduce the burden on our companies. There are more working spaces for corporations to learn about these regulations and how to respond to them. I participate in something just started a couple of weeks ago by the World Business Council on Sustainable Development, which is explicitly sharing case studies and learning about how to respond. The point is we're in a phase where we need to support our corporations to take on the additional expectations of these reporting obligations. And there may be a lot of concern about cost, but we must be honest and say that the administrative cost of responding to these regulations is really nothing compared to the economic restructuring costs or the potential costs of not acting on climate and nature. So there's a reasonable conversation to be had about administrative cost, but please let's keep it in perspective when we're talking about transition. And if I may say, we need to encourage our companies to move sustainability reporting out of the sustainability teams and move it into the financial reporting teams. If sustainability is a core part of our financial function, then we need to put the reporting where the capability is, and where the systems are, and where the rigor is. And then we can let our sustainability teams get on with focusing on the opportunities that they need to transform their businesses. But we need our accounting functions to step up. So, as I conclude, it's clear that capital markets are moving by the demand, by the global acceleration in policy and regulation. The voluntary effort of investors is substantial, and it is also growing. And support for corporate disclosure is high, and acceptance of financial market reform is also holding, and I'd say mostly positive, despite the difficulties of financial markets responding to their own transparency obligations. We mustn't fall into the trap of thinking these reforms are just being driven by Europe or by Brussels. This is now a global phenomenon. And so it's time to focus on refining and improving the framework to the benefit of our own economic transition, so that we can focus here on allocating capital to that transition. And it's time to use these frameworks and treat them as the core financial activity that they are. And if we do this well, we can indeed ensure that markets, that capital markets, are a meaningful part of our transition to a sustainable global economy and world. Thank you very much.
Thank you so much, Nathan. This is exactly the time where I'm so happy we are recording this session, and it's also on YouTube, because this is exactly something I will watch again. It touched on so many important points, and also just interconnecting some of these different worlds of investors to companies to regulation. This actually might be one of the videos I send to people I'm trying to explain the topic to, so this can definitely help, and it's amazing to see so many people taking notes as well. But I do agree we are sometimes in this silo of both the EU but also the CEE, I think, when it comes to maybe perception of some of this topic and the transition and even the sustainable finance policy. So it's amazing that you have the position where Nathan actually was also leading the platform on sustainable finance, so very much involved with the EU policy, but also on at PRI talking to global investors and understanding the market. So it's really interesting interlinkage and trying to understand the global context, because exactly as you said, this is not happening only in the EU, and we do see so many activities and developments in other regions as well. So thank you so much. We will now continue with the second keynote. We have the speaker ready, so please let me welcome to the stage Maxfield Weise, Executive Director of CDP Europe. CDP being one of the most well-known and credible global environmental standards for sustainability reporting, and Max will tell you much more about that. Welcome to the stage.
Good morning and Dobry rano, everyone. Today, let's start off. I'd like you all to imagine a world we are far down the road, where we're far down the road on the transition to a sustainable future. A world where green products fuel our economy, our investments, our lives. A world where capital flows effortlessly and at the speed that is necessary to match the urgency of our environmental challenges. But right now, we stand at a critical juncture. We stand at a juncture where on one side we have the corporate world which is growing the green technology, but it is throttled by a need for capital, a need for capital to scale up. And on the other hand, we have financial institutions which want to invest in this green transition into the sustainable future, but they are trying to navigate the roadblocks in a landscape that is not moving fast enough. Essentially, we are stuck. We are stuck in what I like to call a green gridlock. Now, ironically, in this green gridlock, we are in a jam that is more apparent in key high-emitting sectors. Think of steel, think of automotive, think of electric utilities. The very industries that we need to drive us towards a green economy. Now, over half of these companies in these high-emitting sectors reported access to capital as a key concern in their decarbonization efforts when disclosing through CDP this last year. But what we find is that there is a mismatch in this because many of you here represent the green commitments of the financial sector. Over 2/3 of European financial institutions report now taking action to align their portfolios with 1.5-degree pathway. Now, of course, we know that the best way to achieve these targets is to have growth in low carbon and transition areas. And at the same time, we know that these challenges within these emerging green projects can present difficulties alongside the opportunities that exist as well. Now, these roadblocks that companies face are similar for financiers. Investments is often large, it's often lengthy, and in some technologies that are not yet economically or commercially proven or viable at this time. And the business economics don't necessarily exist or work depending on the greater need for policy within these activities. Existing frameworks for financing are just not fit for purpose. And there are also several intersecting issues that we see facing. So if we're looking at a sector like electric utilities, now the electric utilities is essentially the decarbonization engine for our economy. It's very advanced in its development for renewables, but some utility companies report concerns in facing credit downgrades and taking on more debt when financing new projects. So it's important that we do not forget what is at stake here. And we found in our latest CDP Europe report with Oliver Wyman that the sector is falling about 285 billion short. 285 billion. That's about the GDP of Czechia. So they are 285 billion short to reach the 1.9 trillion in euros of CapEx that is necessary for renewables to scale up, considering the projections for the IEA. So I think if we consider the scale and nuances of these issues, we must use robust environmental data. This is key. To drive the action we take and pave the road ahead, we need the solutions that exist from this robust environmental data. And CDP, essentially what we do is we unearth this high-quality data, the data that companies, that financiers and policymakers use as the basis for solutions. Now, we actually request this information on behalf of the capital markets, on environmental impact, on risk and exposure. It's not CDP who's requesting this information. We're requesting on investors who represent more than 90% of the European stock markets and about 1/3 of global financial institution assets, as well as from many of the world's largest purchasing institutions in terms of making purchasing decisions on behalf of them. And we continue to see a vast rise here in Central and Eastern Europe. In fact, disclosure rose by 36% this past year here in CEE in 2023. And that's about 10% higher than the European average. But I think the important thing to remember here is that it's not just about disclosure for disclosure's sake. Data allows us to see both the obstacles and it allows us to see the opportunities as well. And it's clear that we need to be able to have this view from a data vision world towards a climate-safe and actionable world where we can transition to 1.5 and nature positivity. Now, I think if we're putting it lightly, These investments are unique. They require a collective, innovative approach from development banks, from private equity, from insurers to traditional financiers, and of course, philanthropy as well as public funders. And we see some institutions that are already exploring blended finance, an example of which is BNP Paribas Polska, working with the World Bank's IFC on sharing risk transactions for sustainable financing, as well as financial institutions. So the important thing that we would like you to do as those representing the financial sector is to ask yourself, are any of your risk management strategies impending investments? How can you develop the expertise needed to overcome these challenges? Where can you engage with governments to foster a green investment-friendly landscape? Now, let's not forget about the opportunities. Opportunities are key here, and what we found is that 2/3 of financial institutions report developing products as well as services to finance renewable energy, to finance green buildings and low emissions transport. Now, the financial sector, we find it very uniquely positioned to engage, and that's important from a CDP perspective. We need the financial sector to engage and direct the companies that they invest in to ensure that they build up these initiatives and help accelerate the green transition. Now, when considering how businesses and how you invest into these businesses and how they are tracking and building green business models, we've identified 5 key forces in our analysis with Oliver Wyman. And we looked at European companies' disclosure through CDP this past year. And we found these 5 key areas: capital expenditure, product innovation, supplier decarbonization, customer engagement, and steering the business. So, what does this data show? Companies' own capital expenditure and sustainable initiatives is crucial. And the vast majority of European businesses align under 1/4 of their CapEx towards transition activities. And if we turn this around, now on the positive side, we're seeing that 1 in 10 European companies are investing over half of their CapEx. And this is what is needed. An example for Poland, we found a positive surprise that it's double that. 1 in 5 are investing more than half in their CapEx. Now, if we're reflecting on the opportunity for businesses and investments in this region to be frontrunners, we have some great examples coming out of CDP data. We can take packaging company Canpack, for example, and this is a good example because it reports about $249 million for a potential impact through creating more efficient production and distribution processes. So it's this kind of data, that we need to allow financial institutions to ask the right questions and to support the companies, to direct them as they make these investments and huge strides towards decarbonization. But right now, it's important opportunities that are at risk. These opportunities are at risk, namely one that we see is in the steel sector, for an example. It represents about 5% of European CO2 emissions, and we know that it's very critical in value chains. Now, what our report revealed is that on average, to produce green steel, the industry must find a way to speed up, because while nearly 9 in 10 companies now offer low-carbon products, green steel production is actually determined to be about 31% behind demand over the next 10 years. So I think what this highlights is a broader issue. About 20% of European businesses across sector, they actually fear losing customers. They fear losing customers to switching to alternative products, as well as to suppliers. And if we cannot keep up with this pace of green investment, that is where that fear lives and comes from. Now, what we found is that to move forward and to close this gap between planning and action, disclosing actionable environmental data is key. Data that is comparable, data that is comprehensive, data which is decision useful. With this, companies, financiers, and policymakers, they have the basis for the solutions to inform investments as well as buying decisions. It's information that we find is essential for companies to increase access to capital, value chain competitiveness, and of course, compliance with market and regulatory asks. So, it's by harnessing this information that we can actually change the gears on innovation, on collaboration and efficiency across sectors. What we need to do is we need to green finance, and we need finance to be green. It's clear that in order to keep our 1.5-degree destination within a line of sight, within reach, we need to remove the roadblocks, these roadblocks that we've been talking about, so capital can flow effortlessly into sustainable initiatives. And I think what is key here, and this is something that is often forgotten, is that the solutions exist. The solutions already exist to make this swift and large-scale shift to a greener business model that we so need. This is what we need to boost the commercial and economic competitiveness here in Central, in Eastern Europe, across the region, and of course the world. And what we find as CDP is it is crucial. This shift is crucial for our planet, for our very existence, and what it is the time is now. The time is now to break through this green gridlock. It's time to move the money. So what I'd like to do is give you a big thank you, and I would encourage you to look here, take a look at this image, capture it. This is our latest CDP Europe report, where you can find more information between the work that we did with Oliver Wyman about driving solutions through actionable environmental data. So I encourage you to enjoy the rest of the summit. Dziękuję and naskladano.
Thank you so much, Mark. Thank you very much for the insightful presentation. As I even said yesterday, we will be able to share the slides, and we always really like the beginnings and these speeches with all the good data and information, and again, seeing all the people actually.
We are really honoured here to have Jenny, who is an expert coming from the Sustainability Standards Board, so IFRS and questions related to that. Jenny is definitely going to be our expert in. We have Jessica joining us from the Chartered Accountants Association, so we will certainly be asking a lot of questions to Nathan's point on how financial decision makers can start to adopt these new standards. And we have Gary joining us as as a practitioner who will have an obligation to report under these new standards. And hopefully Gary will have the opportunity to share some of his lived experiences with similar frameworks over the time. Hopefully. So thank you all very much. And I would like to actually open for a moment to our audience. One housekeeping point. At any point, if you feel like I am doing an inadequate job asking questions and you have a niggling question you would like to ask, there will be a little Slido link that comes up on your mobile phone. I will allow enough time at the very end to ask your questions, so do feel free to raise them. I would love to do that awkward thing of show of hands, and I would love to sense from our audience who believes for the organization they represent you have a reporting obligation under CSRD this year. If you could just put your hand up if you feel like you do. Great, thank you. Minimal. Who has absolutely no idea if they have a reporting obligation under CSRD? No, we are 100% confident in the limited number of people that have a reporting obligation. That is interesting intelligence for this group, so thank you very much for participating. And equally, I will acknowledge those that have abstained from raising their hands. Mm-hmm. So maybe just to start with kind of some of the basics, actually. And Jenny, sorry, I'm looking at you to come on some of the basics. Let's start with the work of ISSB. And we hear a lot of acronyms. If you could shed a little bit of light on what ISSB does, how it came together, and ultimately the aims of that organization.
Absolutely. So it's exactly about these acronyms. So when it was announced at the World Climate Conference in Glasgow in 21 that the ISSB is to be formed, that was to end the so-called alphabet soup of acronyms that we have in the ESG or sustainability reporting sphere. And I was actually in the room when they announced that, because at that time I was the head of sustainability for Siemens. And the idea of the ISSB is to end this alphabet soup because, and we heard that today, that investors are looking for decision-useful information, and there is not one global standard. So when it was founded in 21, there was a huge frustration actually on all sides. I can share on the business side. It was if you wanted to do superb disclosure, it was hard to do that because you didn't even know which rule to follow because there wasn't any mandatory rule and there were different rules and they all have great acronyms. And so our job is now to create one global baseline for sustainability disclosure that can be used all around the world, and that's important to understand. It's a baseline so that all this information that companies then provide based on our standards is decision useful for investors, it's comparable, and that's the goal. We have very strong backing from G7, G20, and many other, IOSCO, who endorsed our standards last year. So there's very strong momentum on now creating this baseline, and that's our task, and that's what we do.
And is the work done now, Jenny? Can we retire and say this is good, we've got these standards, and now we're good and done? No, Nadia, we cannot.
Well, that's already, I don't want to be quoted in the wrong way, because we have published the first two standards last year, which we call IFRS S1 and IFRS S2. So the first two standards. And that's why he saw me a bit hesitant on the response, because basically in this first standard asks for the disclosure of all material information about all of your sustainability-related risk and opportunities. And so somehow with that, everything is covered. That said, of course, there needs to be more work to be completed. We have with the second standard now a complete standard ready and also published last June on all climate-related topics. And now it's the job to kind of complete this suite of additional content-focused standards. And we are now just starting to have new research projects on human capital and also on biodiversity. So that's kind of what's in the pipeline with the next work to come. But, and that's important, and that's why it was a good question, and it was good that you forced me to either respond with yes or no. With the first 2 standards, you can have a complete disclosure of your sustainability-related risk and opportunities.
Oh, interesting. And do you know, you may not, and I can share my statistic, but it might be wrong, how many jurisdictions have adopted that standard?
So maybe if you allow me to add 1 sentence to this. So we are now kind of offering and developing these standards, but it's the task of the countries to decide how and if they want to implement that. So I think, and that's your question on how many countries are now really implementing these standards. And we see also their very positive momentum. And still, it's a bit too early to tell, because obviously this is a very formal, very important, very crucial process. Then also in the countries, they would typically also undergo consultation, have exposure drafts to the public. And China just had their exposure draft open 2 days ago. So it takes a bit of time, but we see, I think, more than 20 countries already on this adoption journey. And still, it's a bit too early to tell.
That is my number. 20 was going to be the one that if you said.
And it's 20 kind of +1 with this week. And yeah.
Yes, some good news.
Good news.
I might pivot across, because there's a few more acronyms in the world. And if I can jump across to you, Jessica. So we've got this body called EFRAG, and we've got this acronym CSRD. So are you able to just very briefly explain to us what that reporting standard is and how it relates to some of the concepts that Jenny was talking about as well?
Yes, of course. So, well, everybody apparently knows about CSRD, so I could probably just go home. But it doesn't have the specific reporting requirements, which is where EFRAG, the European Financial Reporting Advisory Group, comes in. And they have developed the European Sustainability Reporting Standards, of which there are 12. So we have 2 general standards, which are kind of similar to IFRS S1. And then there are 5 environmental standards, 4 social standards, and 1 governance standard. So it really covers the whole spectrum of ESG. These don't all come into play at the same time as the sort of hands-up piece came. Initially, there are 4 stages of implementation. So 2024, January, is when it all kicked off, and the first reporters will be in 2025. And those will be those who are large companies already subject to the previous NFRD. So there's already many acronyms. So hopefully we can let that one go and move on to CSRD. There'll be some really important things in terms of investment and finance, because it will also inform the Sustainable Finance Disclosure Regulation and really improve that data flow for investors and directing financial flows. And then there's 2 sort of key aspects to CSRD, which I would say to focus on. So number 1 is the value chain. So it affects direct and indirect, as well as upstream and downstream within your value chain. So you're going to have to consider the sort of impacts, the material impacts, risks, and opportunities that are affecting your business. And that's really to inform not only investors, but also all users, which is kind of follows into that double materiality perspective. So we have the ISSB, investor focus materiality, and then we have the CSRD double materiality, which is looking at those impacts, risks, and opportunities. And previously on Nathan's slide, we had the Task Force for Nature-Related Financial Disclosures, and that is slightly more similar in terms of double materiality. So we're thinking very much about the impacts on our organization and on everybody else as well. So that's sort of the initial piece. I would say there are 3 kind of key recommendations. The first is to figure out what scope you're in. So where in that implementation phase you're sort of going to start reporting. So are you a large corporate coming in 2026? Are you an insurer, bank, or someone with securities coming in 2027? Or are you sort of coming along down the line in 2029? It's important, I think, to recognize that ESRS are sector agnostic at the moment. There are going to be sector-specific standards. They've been slightly delayed. And then there's also in development SME standards. So all of these have been out for consultation. ACCA recently fed into the listed SME standard and voluntary SME standard. And our kind of point that we came to was that only the voluntary standard is kind of needed because it has that value chain cap, but also it will enable consistency of reporting. But when it comes down to the voluntary versus mandatory interplay, it's very much about awareness and making sure that your supply and value chains understand the requirements that will be of them. And I suppose initially, sort of a bit of relief for everyone feeling overwhelmed by regulation is for the first 3 years, you'll only have to report on, well, you can report more, but the mandatory piece will be ESRS 2, and it will be Appendix C. So that is very much for informing investors who are already subject to that sustainable finance disclosure regulation. Probably a quick run through.
Very comprehensive. Well done. Thank you. So I'm going to come, Gary, next to you as someone who I understand may well have reporting obligations under these frameworks. Just to perhaps shed a little light on your experience to date and or your preparation in light of these new regulations within your organization.
Okay, thank you. So I'm CEO of EP Infrastructure, which is one of the biggest energy infrastructure businesses in Central Europe. I'm a main board director of EP Power Europe, which is one of the biggest power generators businesses in Western Europe. I'm the C-level executive of EPH, responsible for ESG. Last week, I'm also responsible for 6.5 billion euros of Eurobond finance for the group. Last week on Thursday, EPH launched its first inaugural green bond. We received 1.8 billion euros of bids for a 500 million euro bond. Success. What did I do? So I had consultants that gave me a full roadmap to 2050. I issued a 180-page sustainability report that I doubt very many people have read. I issued a green framework with my advisors from the accountancy world. I got 2 second-party opinions, one from Standard & Poor's, Shades of Green, one from Fitch Sustainable. What else did I do? I committed to net zero 2050, carbon neutral 2040, zero coal 2030, methane emissions 2025, and all sorts of other things. I'm now also committed to Scope 3 disclosures and Scope 3 plans. Oof. Excuse my Czech, but Ježiš Maria. The objective is net zero. And all the rest of this is a method to get there. And I accept it's a method to get there. But CSRD, we will invest between 1 and 2 million euros this year. And we will disclose in 2025 CSRD for the entire group. Please, 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 is that it? Is that the line in the sand? Because some of us need to get on with the energy transition and actually do it. And before I joined EPH 8 years ago, I was the CFO of a large insurance company in the Czech Republic. And my responsibility there was to bring in Solvency II. Solvency II was a risk management system to prevent systemic risk in a country. And what did we have? We had an overload of regulations and consultants. And finally, I sat in front of somebody very important in the Czech National Bank. And I said, is it important that I put in a risk management system to prevent systemic risk in the Czech Republic, or that I fill in these forms? And he looked at me and he said, Gary, please fill in the forms. So we need to be really careful here. Our objective is net zero, and we will not get to net zero if we continue to amend, consult, change, review. Yeah, CSRD has to be that line in the sand. I don't want version 2, I don't want version 3. I want a common methodology that we're all aligned with. And the point we're all missing is, in this audience, put your hand up if you believe in net zero 2050. And there is the fundamental issue. You haven't persuaded society to go to net zero, but all you're doing is alienating society over and over again with more and more regulations. So we are fully committed to CSRD. We are fully committed to net zero. But the one thing that will stop us is bureaucracy. And I apologize if I've upset many people.
I love contention. Gary, it definitely seems like you're speaking to our audience here.
It's,
so thank you.
It's the Czech Republic.
So thank you very much for raising those points. And maybe it's a good segue, Nathan, across to you.
Yep.
So Gary raised a lot of concern that I think echoes the viewpoint of a number of corporates who sit under these reporting obligations.
Yeah.
And I wondered if you had a response from the line of sight that you're in.
Yeah, Gary's experience is very welcome. I think it's also understood. And I guess the question I'd put back to Gary is, does he want the system to function like this? Does he want to be able to raise capital for his net zero 2050 plan? And does he believe everyone else should as well? And that's a rhetorical question as now, for the moment, but you might want to respond to it. I think that it's very difficult for businesses to transition. So in the way that they conduct their activities, investors are going through the same challenge at the moment. If I was inside an investment organisation, I would have used the same story on SFDR, which is the fund disclosure framework everyone knows, because it's changing and wasn't perfect and there's still issues. And frankly, PRI has got a team that's working with the Commission to try and streamline it to make it easier for everyone to use. And so these are really important reforms, but they're difficult reforms. And so I think the only response to Gary, apart from understanding that that is the experience he's going through and that all of us are going through, is the question on why. Do we want our capital markets to function in a way that investors can allocate 1.8 billion to capital fundraising for a net zero transition plan? I think the answer to that is yes, and so we've got to find ways to make it easier to implement, not take it away.
Thank you, Nathan. And I think there's a couple of questions coming up that I'll draw upon, though. So one of the points that was made earlier is we're in this process of a global framework that is looking predominantly at climate-related disclosure. And I think from a CSRD perspective, it's gone a step further. And whilst, Nathan, in your opening statement, you made the point that there was a recent May statement that there's kind of this 99% overlap between the two. I think maybe there's a concern, to Gary's point, that in the evolution of IFRS, we see divergence in practice relative to what the European mandate is. And I was just curious, in looking directly at you, whether that is something that ISSB is aware of and working on, that when, for example, Europe and or other jurisdictions take those standards and apply their own flavors to them, the concern is that this becomes less of a globally harmonized framework and more divergent jurisdiction by jurisdiction.
Mm-hmm. So where to start? Maybe we start with what we call interoperability and the so-called baseline approach, because I didn't have the chance to speak about this. I think when you think back what I explained earlier today, that we want to have this global baseline. A global baseline also means that there is room for additional building blocks. We call that building blocks. So basically, speaking now about Europe, if there is a country that wants to have additional disclosures for whatever reason, political agenda, a clear political mandate to achieving the Europe sustainability goals, or because a company also might want to disclose additional information because they want to fulfill additional information needs, not only those from the investors, then the idea is that there is a global baseline, but there is a pretty seamless way of adding building blocks and additional requirements. I think that's important to understand. So the case that a country has these additional requirements is fine and is part of the idea and part of this concept. I think that's important to understand. And of course, in our work, we very much focus on this interoperability, which is the seamless idea of having the chance to adding these building blocks. Now, speaking about Europe and speaking about climate, in the joint discussions and exchanges that we have on a very positive, on a very regular basis with EFRAG, who is the standard setter for Europe, we have managed to have a very high now interoperability. So basically, if you fulfill either ESRS or our climate disclosure rules, it's very easy to fulfill the other side as well. Very easy means that there is an interoperability guidance which has 33 pages, so just because people always believe it's that much, 33 pages, which would give you clear guidance on how you have to do your climate disclosure, so that if you stick to those rules, that you then have this interoperability, and it's little things, but it's important things, and if you follow then those rules, then it's easy. And also there, this interoperability guide we've developed together with EFRAG, so it's not from us, it's not from them, it's our joint work, I think, which shows, and that's very important, that both sides share a very strong joint understanding of responsibility to ensure this interoperability, and that's the case for everything that has been published already, and that's of course and certainly also the case for everything that's being developed in the future. So that's a core activity of what we do and what we focus on, not only for Europe but also for the other countries and also for other standards. So for example, speaking about GRI, we've just also, I think this or last week, announced that now for the next set of standards, we have an even closer look into what GRI is doing. It's also the case for CDP. We just heard CDP speaking, so a close alignment on their questionnaire on climate. So really trying to get this as seamless and interoperable as possible.
That's comfort, I think, maybe to Gary's main concern. And Gary, maybe one response to you on your 180 pages. I can assure you that Bloomberg does read your report.
It's a very good report.
But also, and maybe, Nathan, just to come back to you, more from kind of the mind's eye of financial organizations and the data they want. So Gary, to your point, absolutely, when harvesting your data, we observe probably about just under 95% of global market cap produces some flavor of ESG report. There's a lot of E, S, and G data out there.
There's a lot.
Is it structured, standardized, normalized? No. Is it, in some cases, a PR view of the good things a company is doing? And I am certainly not accusing your company of that, but are there cases where that is true? Are there data points that year on year for the same organization change? Are they comparable within sector and within geography? My answer would be no. And therefore, welcome result of some of these frameworks should bring standardization. And I think, Nathan, what you said is, there's roughly 50% of the world's capital waiting to be invested in good things. So from that investor community, is there this demand for structured and standardized data? And for the effort that Gary and his team are putting into this, will there be results? I think there's always a promise of cost of capital. Will that be true when everybody has an obligation to report this?
Yeah, I mean, in this case, there was certainly supply of capital. That's been demonstrated ably. I think investors always ask for data first because it's the least cost way to transition their own exposures. So it's in investors' self-interest to have data. So yes, investors rate data as the number one issue. There's a range of other issues in financial markets as well, but data is all the number one issue. So expect the demand to continue. I don't think there's any investment analyst in the market who's going to re-rate your company because of the cost of administering your sustainability report. But they're certainly going to re-rate your company if you don't have a transition plan and can't sustain it with reasonable data and forecasts about what you're doing. So let's just be serious about what we're dealing with here. This is a very substantial restructure of our economies that we're dealing with. And if we want our markets to function, they're going to need the information. And so that's why the demand is so high.
No, I think that's fair. And Gary, maybe if I could come back to you. Whilst it sounds like a burden, at any point do you feel like there's competitive advantage in this for your organisation?
Clearly there is. Those organisations that are at the front of reporting and at the front of this wave will get the clear advantage. So we have 3.8 billion euros of green assets on our balance sheet already. We're investing in the next 3 years 2.4 billion euros in EU taxonomy aligned assets, another tick box. So if you want to stay up front, then you need to be riding this wave. So don't get me wrong, we're fully committed to this, and actually we're ahead of the ball. But you know, it's a question of never losing. The objective is to transition your business. Now, as a business, we're considered the big bad wolf of CO2 emissions, but actually, we've already taken out since 2016 21 million tons of CO2, and in 2 years' time, 25 million tons of CO2. So instead of castigating me, support me. And I'm just worried that this is just overloading on the paperwork. And I was in London last Monday. There's a huge asset manager in London that I've known for years. I said, Will you invest in my new bond? And he said, are you SBTI aligned, Gary? I said, good news, Will. In EP infrastructure, I'm fully SBTI aligned. He said, that's super, therefore I can invest. So that's the positive side. I'm out front, I'm SBTI aligned, I get the investment. But then I said to Will, do you know what SBTI aligned means? And he said, no idea, Gary, but I must tick this box. Yeah? So the financial services industry is very guilty of creating boxes to tick, as opposed to understand as financial institutions what they're trying to do. And the final issue is the financial services industry, and the banks in particular, are primarily responsible for greenwashing, which is creating this skepticism around green bonds. You know, some of the things we've seen on green finance, frankly, are ridiculous. There's a company, I won't mention the name, that was building a 500,000 meter block of concrete to build a warehouse on top of. But they put a beehive on the roof. And guess what? It was a green bond. So this is the nonsense that we need to obliterate, because then the credibility of what Nathan's trying to do gets lower and lower and lower, because people just become skeptical that everyone's just finding a way to get round it, to tick a box, to fill in the next forms. But actually what we're trying to do is to get to net zero. And whilst not many of you put your hands up, who believes in net zero 2050? I do. I have 3 kids. I want net zero 2050.
Thank you very much, Gary. And so I think the point there being, if we do have meaningful data that is consistently reported and with not too much chop and change, that people are very much behind that. And I think, Jessica, maybe if I can come to you on the next question, because we hear that a lot, and I've recently had the fortunate role where I've been speaking to a suite of investors for the existing ESG data sets that they use in their investment processes, roughly how many data points do they use? Now, on a broad poll, I get somewhere between 40 and 200. 200 being the max, and the person that says I use 200 says I would like to use 40. So quite a lot of them are saying I want to shrink to a more meaningful subset. In CSRD, we're not seeing that, right? We are seeing 800-900 potential data points, if not more, being reported, either in narrative form or in quantitative form. And I was just wondering, from an accounting perspective, what burden that is placing on your members having to deal with that obligation as it comes forward.
So I think we did a review recently and we found 1,143 data points across CSRD, so it is tricky. I do want to just quickly
Sorry.
disagree with you, Gary, because you keep saying net zero being the ultimate goal, but sustainability as a whole is the ultimate goal, and that is what ISSB IFRS S1 is. It's about capturing everything that is sustainable, and that is what CSRD is about doing. It's about looking beyond carbon emissions, and that is why there are so many data points. It is tricky. I think there's going to be lots of iterations of regulation as we do have those consultations come in. But there's some difficulty in that jurisdictions, member states have to adopt everything by July this year. It's already started in January, so that makes it a little bit trickier. And also there will be differences between the adoption in member states, as well as when you look at ISSB and adoption globally. And that does make things difficult because business transcends borders. But for accountants, we could deal with IFRS when it came in. And if you look at IFRS, it is comprehensive and it's ever evolving. The difference here is pace of change. If we look at specific IFRS, we have years and years to just edit it. And this is a huge amount of information that we need to do. What we have said and what feedback we've got within our roundtables and interactions with our members is this is about materiality, this is about judgment and critical thinking, which is what accountants are very used to doing. And it's about reporting and measuring what is relevant and what is impactful. It is not about measuring and reporting on everything that is measurable. We could measure absolutely everything if we wanted. It's not necessary. And I think people can get slightly overwhelmed in identifying what is relevant, because we do not want sort of sustainability reports going beyond 180 pages. For CSRD, it has to sit within the management report. It is going to be within that financial reporting process. And yes, finance teams will interact and sort of come out of that siloed approach. But ultimately, one of the key issues we have seen is capacity, education, and training. And if we can get people up to speed, then it might be easier. But I think the phased implementation will be really useful, and that constant feedback. Like, for example, SFDR, we noticed that often Articles 8 and 9 sometimes felt like a barrier to entry because of all the requirements. But if you look at SDR in the UK, it took that and it made it a lot better. And when we get all those jurisdictions sort of taking that leadership and adopting things should take it and make it a lot better and easier. I think there's an element of ISSB saying, don't let the perfect get in the way of good, which is always scary with greenwashing, but also of just kind of getting stuck in as well and identifying scope and implementing that really good governance and understanding what data to collate and report on.
Thank you. I think that's it. I started my career from a sustainability perspective as supporting the Secretariat for TCFD, which kind of as a precursor was saying, have you considered climate-related risks and/or opportunities? And there was huge backlash to say, well, that's competitively sensitive, we don't want to share it. There was a lot of phone calls saying, what does being a supporter mean? Do I have an obligation to report? And bringing people along that journey to see where it's landed from an ISSB perspective in a set of standards that say, and to the point, that this needs to sit at board-level approval. Is critical. And I think one of the key successes we always spoke about within TCFD was governance. As long as you've got someone who has accountability, good decisions will be made, good metrics will be honoured. But we always steered away from being prescriptive in those. And maybe, Nathan, if I can, for some closing thoughts on this point, from a PRI perspective, you previously expected a lot of content from your members to be reported. Where do you now stand in that as an organisation in light of kind of new reporting obligations coming through?
So we would say that our role changes on reporting because the institutions with the actual mandates for supervision are stepping in. And PRI doesn't really have a supervision mandate. So we see our reporting framework as an enabling tool in a journey of the financial system adopting these obligations. So we will be adjusting our reporting obligations consistent with that view over the next couple of years.
Thank you. And Gary, maybe if I could come to you to shine a different light. You've talked a lot of the burden of reporting. You've put an ask out there saying, I am happy to commit to this if it is structured, standardized, and does not change. You are also happy to move your organization in line with the goals expected of you. I asked you this question a little earlier, but I am going to rephrase it and slightly ask it again. Do you feel like in early adopting what you have and going through the rigor and process of reporting, of engaging with second-party opinion providers, engaging consultants on this matter, your organization is now in a better place moving forward?
Oh, absolutely. So the reality is you must commit to this, no matter what your head is telling you or your heart is telling you, you must commit. But to be in front means you will win the transition. So effectively, we will launch probably 5-6 billion euros of green bonds in the next 5 years. It's a competitive advantage to be up front. I agree with my chartered accountant, because I'm actually a chartered accountant as well. Merge your ESG departments with your health and safety departments and place them in your finance departments. But you have to commit, and if you commit, no matter what you really think deep down, you will get a competitive advantage for your business, and your bank manager or your commercial lender or your Eurobond lender or even finally your private equity investors will give you more capacity if you're up front. There will never be a cheaper form of finance from green. It won't happen, but you'll get far more volume from staying ahead of the curve. So yes, I was deliberately controversial, but my recommendation is to commit to this. And my plea is enough's enough.
We've had a full narrative arc in the panel.
Very good.
So thank you, Gary. Maybe just for final points from Jessica and Jenny, in advice to our audience who are about to start on this journey, if I could turn to both of you just to share in 30 seconds, what would be your top tidbit as an organization starts to embrace these new frameworks?
For me, training and capacity building. There's a shortage across the entire sector of people who can do this, and that is sort of the number one. And that's not even me with my personal investment as ACCA. That is just, I think, a fact.
Jenny?
Well, I've hidden that I've been strategy consultant for the majority of my career. So I've done many, many change projects with many clients all around the world. And in change, I think there are two important things. One is embrace the change. The winners of these projects were always those who embraced the change early. And the second is build your own opinion, be able to have a grown-up conversation, and you can only have this if you know the facts. You need the facts to be able to have your own opinion, and I think that's what's required here.
Brilliant. Thank you very much to all my panelists today. I really appreciated that. And I think, is it Julian, over back to you now?
Good. Thank you so much, Nadia, for brilliant moderating as always. Gary, we will be, as I said, we'll be sharing all the slides and resources and materials with the audience. We can easily include the sustainability report as well to get more readers. But you said controversial in the end, but to be honest, I think the best discussions, I wouldn't even say controversial, because it's exactly about different worlds and perceptions, not even colliding, but actually merging on the stage. And to be honest, in the end, I think you are actually talking about the same things. And me being on the platform, and I think Nadia will also agree, and everyone involved, especially, and I think you heard from Martin Spolz as well. This is one thing, when I joined the platform in only last year, actually, what was really surprising in a positive way to me is how much they listen to feedback. How much, for example, Martin is keen on coming here, speaking to, for example, the Confederation of Industry, speaking to companies, listening to feedback. It's the same, I know EFRAG also, ISSB have all the roundtables discussions. And we recently did a we had a workshop with a colleague here in Dublin this was for the World Bank and IMF, and we had this slide. It's a really famous slide now recently. I'm not sure who exactly put it together, but it's showing all these standards merging somehow, trying to be simplified into 1 or 2 or 3. And just to your point, Jessica, it's been, I mean, only a couple of years, I think now, let's say like, 5 years when we started discussing these standardized or standardization and the topics of how we can simplify and accelerate the transition. 5 years is not that much in business. I mean, so I think we are definitely on the path of simplifying some of these things, on improving practicality, but I think to do that in the best possible way and the most effective way, we need more discussions like that. So I think it's always the best panels where you have people from different backgrounds and you have people from practice and also people working on these standards. But let's also not think that these people, they do talk. I think they talk more and more. And one of the main developments I think we see is that understanding on both sides that actually there is need for simplification, especially also to include SMEs, right? Because that's something not to forget. Good. Now, that's a lot of talking considering there's coffee and snacks waiting for you. So we'll have a break now. So enjoy the break, and we'll see you here, I think, in 30 minutes. I'll let you know. 40 minutes. Okay, good, it's working. I think we can give it maybe 1 more minute or 30 more seconds because I saw so many people still waiting for coffee. And so I'll just kick it off in a few more seconds. So, because I see people coming in, so 1 sec. Or actually, in the meantime, I can just explain the next session. You see the upcoming sessions on the screen here. So we will do it now. It's a mix of different formats. So we will start with a TED Style Talk presentation by Nicolas Duas-Sinzanki, and then Peter Dovoli will also join on stage, and they'll have a conversation here, which we also we will include Slido actively, so there will be opportunities for questions, and you will be very much encouraged to take the questions. And then we will move to a very interesting presentation by Stefan Müller from SAP, and then we will have again moderated panel discussion. Good. So I think we can start. I still see some people coming in, but that's okay. So please let me now introduce the next speaker. So we have this TED Talk, as I said, by Nicolas, who is from the World Business Council of Sustainable Development. Nicolas, please, the floor is yours.
Thanks a lot for this. Thank you, everyone. It is my great pleasure to be here today and to introduce to you the Partnership for Carbon Transparency, or Pact. As Julian mentioned, I am from the World Business Council for Sustainable Development, which stands for WBCSD. And the last acronym I want to clarify is PCF, which stands for Product Carbon Footprint, and I will speak a lot about this during my session. Also wanted to mention that I'm joining from Switzerland, so I feel the obligation to congratulate our host country for this session on the gold medal. Even though I had hoped the outcome of the final would be different, definitely a very successful tournament from the Czech Republic, so congratulations on the gold medal. And with this painful part out of the way, let's focus on the topic of today, which is Scope 3 transparency. So I will start with putting a little bit of a context of how Pact sees the challenge of Scope 3. And I'm very sure that many of you will find this familiar, whether you're a company trying to better understand and measure your Scope 3 emissions, or you're a financial institution trying to get more specific data from the companies you invest in, or whether you're also a service provider company that is trying to support their clients into decarbonization. So I'm sure it comes to the surprise of no one that companies are under increasing pressure to decarbonize. And this includes the emissions on their value chains, so the Scope 3, not only emissions linked to their own activities, but also emissions broadly within their value chains. So pressures can come from internal pressures, meaning, for example, the need to meet a voluntary target that has been set, or it can come from external pressures as well. One that we commonly say is that consumers are asking for more and more transparency on the products they are buying so that they can make purchasing decisions. Another external pressure that has been discussed in length during the summit is the more and more regulation that are asking companies to disclose information. And lastly, also very relevant to the people in the room and to the session, to the summit this week, the financial investors having more expectations on the companies they are working with and wanting more specific data from them. And when we look at Scope 3, in general, we see that the highest share of emissions stand in the upstream part of the value chain. This, of course, depends a lot on which value chain you are looking, but in general, a lot of emissions happen in the first upstream part of the value chain, which makes the abatement of this upstream Scope 3 emission critical for overall decarbonization. But to be able to decarbonize your Scope 3 emissions, you need data. I think we've heard that a lot already this morning. We need very specific data. And more particularly, we need data that is accurate, meaning that it reflects the actual emissions happening in production, and that is based on primary data and verified data. Then you need data that is granular, that is linked to a specific product. So there is also a very high importance of corporate level accounting, but this today and the focus of Pact is looking at product level accounting. because in the end, business relationships are formed around products and services that the companies would purchase. So if you want to start making decisions or steering your business, you need actually the data that is linked to the product and services that you're buying. And lastly, which was also mentioned quite a lot earlier, is that we need comparable data. If you don't have comparable data, it's just data points, but they cannot be aggregated and bring a bigger picture to the table. So with that in mind, I will go into the next slide in just 1 second. There we go. What is required to actually unlock product-level accounting? So bear with me with a very simplified illustration of a value chain. So let's imagine a tier 0 company and 4 of their suppliers. What we see currently is that each company or each supplier in this example calculates PCF slightly differently, whether they're using different standard calculations to do it, or if they're interpreting a standard guidance in a slightly different way because of the flexibility that the existing standards provide. Then we end up with a bowl of fruits, which may be appetizing. They were very nice fruits during the break, but it's not very helpful when it comes to decarbonizing and understanding the bigger picture of the value chain. So the first thing we need in order to create product-level carbon transparency is a globally applicable standard calculation guidance. And with that, each company can start calculating product carbon footprints the same way. And this will bring us data accuracy. So the data itself reflects the reality. But once you have this data harmonization, you need actually the data to flow within the value chain in parallel of the products and services that are flowing. So for that to happen, we need an infrastructure, a tech infrastructure that enables the standardized exchange of PCF data. And with this, each company or each supplier can start exchanging peer-to-peer their PCF data to their customer, or data access, as we call it. And lastly, very importantly, we need global value chain collaboration. This collaboration and this broader ecosystem collaboration is a requirement for adoption of standards. It is a requirement to make sure that there is alignment within an industry and cross-industry as well, with the final objective having a value chain where all companies calculate PCF the same way and that the data flows from the upstream part all the way to the end customer or the end consumers. And so with that, it is my pleasure also to introduce what we are doing in more detail within the Partnership for Carbon Transparency. I see there has been a little problem with the colors of the slide, but essentially our main mission is to empower companies to make carbon-informed decisions. And how do we do that? So we have been working on the Partnership for Carbon Transparency for over 3 years now, and we are articulating the partnership around 3 pillars that reflect the building blocks I mentioned previously. So first of all, we've published a guidance that helps companies harmonize the way they calculate product carbon footprint. Secondly, we have developed text specification with key partners to help the standardized exchange of data to happen at scale. And all of this was made possible by an ecosystem of different stakeholders that make this adoption possible. I will go into a bit more detail on each of these pillars right now. So first of all, the Pathfinder framework. So the Pathfinder framework is a sector-agnostic guidance that companies can use to calculate product carbon footprints. And I think it's very important here to say that our objective was not to reinvent the way PCF calculation was done, but was to create a little bit more specificity on building on existing standards. So the Pathfinder framework starts from the GHG protocol. It starts also from ISO standards, but we'll be adding a little bit more specificity on how PCFs are calculated, especially to bring this harmonization and this consistency on how companies calculate PCFs. It also stands as an ambition point. We want this document to help companies start their journey of PCF calculation, start their journey of requesting PCFs from their suppliers, but also having the pathway to improve and the roadmap to improve gradually. The framework itself, and we don't need to go into too many details, all the deliverables of Pact are available publicly. But essentially, the framework itself is based on the different building blocks you see on the screen. First, an element on emissions accounting, how to actually use the standards that exist, how to actually calculate PCFs. Then we have an element on data integrity, so how to select the data sources, primary data, how to select secondary data sources when you don't have primary data available, and how to do quality assessment on your data that you're calculating. Then you have assurance and verification, where there's, of course, a critical step that you need to make when you're doing data and that you're exchanging data, and you really need the assurance and verification methods and mechanisms in place. And finally, there is an element in the framework to help companies format the data so that it can be exchanged with their customers. It is important to look at also how the Pathfinder framework was created. So this is a sector-agnostic approach. The idea behind Pact is that we will provide this underlying alignment mechanisms that then industries can build on and bring the needed specificity for their industry. So, for example, we're working with several different industry initiatives that are taking the Pathfinder framework and building on top of it to bring that specificity for their industry. This is about how to calculate PCFs. Now moving on how to exchange the PCFs. What we see currently is that companies that are requesting PCF data to their suppliers or exchanging with their customers often use very different formats. They use methods that are highly laborious. And for example, we mostly see companies using spreadsheets and emails to exchange data, which, as you can imagine, if you are thinking about thousands of suppliers, this becomes very complicated. And also, we've heard quite a lot from suppliers that they have survey fatigue. This is also something that we heard previously. There's a high amount of requests for data that are almost the same, but not exactly the same. So then you need to tailor your answer to all of the different customers in a slightly different way. What the vision Pact has and the members of Pact have is that PCF data exchange need to be standardized, and we need to leverage tech solutions to make the data exchange as automated as possible in a very standardized way. So in practice, this is a little bit of an example of how we see things happening in practice when it comes to data exchange. You have different companies sitting at different places in the value chain. They have their own selection of IT tools or IT systems internally, whether you want to develop your own IT system, whether you want to go to the market for an IT system that helps you calculate PCF and exchange PCFs. But regardless of your choice of technology, you are able to exchange data if the technology is then interoperable and following the tech specifications. On the bottom, you can see a couple of currently Pact conformance solutions that are already in the journey and helping their clients and companies exchange PCF data. Also, if you have been using a solution, the conformance testing process is not too complicated, so the idea is really to find the solution that fits your needs, and then we understand how it can also be Pact conformant. The objective here is really to make it as simple and as automated as possible for companies to exchange data so that we can have this flow of data in value chains. And maybe coming to the last pillar, the ecosystem part, everything that was made by Pact was made possible by the ecosystem of it. So of course, Pact is part of the World Business Council for Sustainable Development, which is a membership organization. So we have companies that are members of Pact that you can see on the bottom left. And we are working with them to understand how to develop the Pathfinder framework and to understand how to accelerate calculation of PCF and exchange of PCF. Of course, we're also working with leading tech companies in the space. They are the ones that have developed the tech specifications. They have come together to define what it needed to have interoperability between tech solutions to calculate PCFs. But it doesn't stop to corporates. We are also working with a broad range of different players that are all needed for making carbon transparency a reality. We're working, as I mentioned, with industry initiatives that have the best view of what is needed in their industries. And we can provide the alignment, but they will define the real specific needs for the industry. We are working with disclosure mechanisms, CDP, EcoVadis, and others, because there are existing very important flows of information. And what we are hoping to provide as Pact is simply a standardized PCF, but how this information flows and how it is disclosed is done by other partners that are already very established in the space. And maybe before going into a bit of a discussion with Peter, we just wanted to share here that this slide and the ecosystem is also an invitation to you to join the ecosystem, to join the collaborative effort that is needed to create carbon transparency. If you're a company interested in calculating PCF or requesting PCF to your suppliers, please consider looking at the Pathfinder framework or consider industry initiatives that are doing something similar instead of reinventing the wheel to bring this harmonization. If you're an investor that is requesting data to your companies, please also consider requesting data that is standardized, that is already being calculated by companies, so that we can lower the efforts on measurement and we can actually put the efforts into actual decarbonization and not measuring, but actually actioning this decarbonization. Thanks a lot for your attention. We are now moving to a discussion with Peter from the Czech BCSD, which is our main partner here in Czech Republic, and it is my pleasure to welcome you to the stage as well. You want the slides?
Okay. Good morning, ladies and gentlemen. Thank you very much for this invitation, and I'm very happy that Nicholas came because I see World Business Council for Sustainable Development as a real driver of the sustainability agenda, and it's important because I think the ESG became important in 2005. I think it was in the UN study called "Who Cares Wins." So it's about caring society, about that sustainability goes hand in hand with the stability of the financial system. So we got some questions on you, and the first is for Scope 3 data. It is important to move from proxy and secondary data to primary greenhouse gas emission data. Could you give us an example how Pact can add value in this respect?
Yes, of course. So the whole journey of companies that are implementing Pact is to get, as you mentioned, primary data, moving from secondary databases to the highest share of primary data in the calculation of PCF. This will enable, very simply, to have an accurate view of your Scope 3 emissions. If you are only relying on averages, then you cannot really differentiate your company's efforts in decarbonization of your value chain. And if you're using only averages, then, I don't know, a shampoo bottle will be the same as another shampoo bottle. So all the investments you make into helping your suppliers decarbonize will not be reflected in the calculation. So last year, we did an implementation program with a couple of companies. And in the end, after having engaged with over 900 suppliers, having exchanged more than 1,400 PCFs, they reported a variance of 37% between the PCF they have calculated using secondary data and using primary data. This is both either increase in emissions or decrease in emissions. And 37% is enormous. If you are trying to hit a target, but you have a margin of 37%, then good luck understanding where the hotspots are. Another example that happened last year was done by the companies that you can see on the screen. And their approach was to, OK, let's bring together the full value chain of a laptop screen. So they engaged not only with their Tier 1 companies, but also Tier 2, Tier 3, Tier 4 companies to understand what data was needed to calculate the product carbon footprint of one laptop screen based on primary data. And this was a successful exercise. They did produce this product carbon footprint. So now the question for them is, OK, you have done this for one laptop screen. What about the other thousands of products you have? And then we have the discussion of scale. How do we make this happen at scale? And this is where we think that technology providers, IT solutions are also needed to be leveraged because there are critical players in this space to make this happen at the scale.
All right. So you mentioned the exchange program or exchange part of the Pact and Pathfinder solution. So how does it work in practice, actually? Because you said it's very flexible. So is it a platform, or what's the kind of solution for this?
Yes, I'm very glad we added this question here in the slides because it's a very important question and often a misconception of Pact. So Pact itself, or WBC itself, doesn't get any PCF data. We don't receive any data from any company. The purpose of the framework is to enable interoperable exchange of data between a supplier and its customer. So essentially, and very simply, it's an API or text specification that any company or any solution provider can embed into their own suite of solutions that can then help companies exchange PCF. The idea here is to create a network and be as inclusive as possible. Any company that wants to have and plug into the network can have a solution and start requesting data to their suppliers. Also, this helps companies remain in control of their data. We are not hosting any data. If you are the sole owner of your data, then you can decide to whom the data will go. And the idea really, again, is to connect companies and connect value chains to exchange PCF data.
Okay, so in practical terms, what does a company need to do to use Pact and to tackle their upstream greenhouse gas Scope 3 emissions?
Yes, so all of our deliverables are publicly available. Today I'm doing an open invitation to any of you to look at the framework, look at the text specification, to understand how you can leverage this for your own Scope 3 calculations, or potentially to request standardized data to companies that you are investing in, helping your clients in their decarbonization journey. So everything is available itself. Of course, there are also evolutions in the standards. We know that the GHG protocol is also working on evolution of its standards. So there's also a way to contribute to the discussion of this evolution and how does Pact need to adapt its own standards or guidance to reflect the changes in the GHG protocol. But in terms of implementation and applicability, I think it's also very important to have local partners. And this is why also we are partnering with you to ensure that the capacity of companies interested in implementing Pact does not stand with us as a team at WBCSD, but actually other partners can help companies adopting this. So maybe turning to you now, asking you a question about what you are looking at doing regarding Scope 3, and what are your plans in terms of Scope 3?
All right, so we are the subsidiary of the World Business Council for Sustainable Development in the Czech Republic. Last year we celebrated the 10th anniversary. It is at the moment quite a closed bunch of companies, and it's because we are completely business-owned association. But we accelerated our efforts because we think that we should go beyond the net zero and carbon ambitions and include sustainability. Because sustainability is not the issue for one individual company. It is about value chains. So there might be a big value of collaboration, facilitation of awareness, trainings, etc. So we developed this, as you can see, these 6 working groups. 4 are now already working. So the first is Vision 2050, which we developed to give a vision for highly industrialized Czechia and how to transition, because we are moving from fossil fuels driven economy to digital and low emission economy, and it will be enormous transition. Yeah, and it's multifaceted and a lot of collaboration will be needed. So we created and prepared in line with the WBCSD Vision 2050, a similar document for Czechia. Then Ukraine war came, so we are now reconsidering how to update it. Another working group is on Scope 3, and where we want to really work hard, because this is important. When we saw the factor of 37%, how you can rely on such data? Yeah. In understanding carbon, shadow price of carbon, and embedded risks in this, if we are talking about such inaccuracy. So it is important to really get aligned, to understand, because if you cannot manage anything if you don't have data. Yeah. So it's just then symbolic phenomenon. You are just guessing from the window. So it's important that we have data, and there's a standalone value in having such a data. Then we developed this rethink. It's about decarbonization 3 years ago already, and we are now having 30 companies which meet on a quarterly basis to discuss the developments in the legislation legislation. We are bringing business representatives to display their good practice, etc. So this is very important. This year we reinvented the circular economy, which is very closely related to the issue of carbon management. It will be critical, and in the autumn we want to launch clean mobility and smart life, because we think this digital sustainability nexus might be another big area for additional co-benefits. So this is where we are. And an important issue, after 22 years of inaction, we will have the Czech version of corporate standard of greenhouse gas protocol. We want to translate Pathfinder. And this is important. We would like to move it forward, but we know that we are currently in the process of reviewing greenhouse gas protocol, and removals will be added, and so we will be aligning this process. But in September we want to release it, because you cannot decarbonize if you don't have a glossary for decarbonization. And again, we want to discuss with our colleagues how we could create some capacity building package which would reflect the rising needs of the market. Because what I saw on your example, 8 companies led to some 900 companies involved in the value chain, and 1,400 product carbon footprint. So it's an immense amount of work, and if we can facilitate awareness, understanding, that's the right issue going forward. Maybe before we go to the questions, if you can, we discussed the issue of sustainability and ESG as measured sustainability, but I know that the agenda of World Business Council for Sustainable Development is larger. So if you can just briefly say what you are doing, what you are tackling with, and what you are preparing for the future.
Yes, of course. Thank you for the opportunity to introduce also the organization, so the World Business Council for Sustainable Development. Essentially, the organization is a business organization, so a neutral NGO that brings together companies to discuss the most pressing challenges around sustainability. How we are doing this is also producing different series of outcomes. So we're working on standard setting. WBCSD is one of the conveners of the GHG protocol itself with WRI. We are developing frameworks and tools. So for example, I just mentioned the Partnership for Carbon Transparency, but there are many other tools that have been developed by WBCSD and their member organizations, such as the CTI tool, which is Circular Transition Indicators, that I also believe you are working with. And other tools and mechanisms for companies that can leverage in order to address pressing challenges. We also do global advocacy. We bring together companies at important events, such as COP and other events, where we need to bring the voice of businesses to accelerate some of discussions on sustainability. We heard a lot about regulation and policy, and we believe that bringing leading voices of companies in terms of sustainability can accelerate the discussion on how to push for policy making. And maybe just a little bit of how we do this. Our work is articulated around 3 imperatives, so the climate imperative, the nature imperative, and the equity imperative. Those are our fundamental missions for WBCSD. And across these imperatives, we have global value chains that we're working with, and we have member representation on each of them. So think about agriculture and food, transport and mobility, built environment, all of those value chains that cross the imperatives that we're working with. And the idea is to bring together these companies on a cross-sectoral level to address the challenges of the imperatives. We also put a lot of emphasis into corporate performance and accountability. This is key to our understanding and key to our members to really understand how can we improve corporate performance and accountability mechanisms. So we are working very hard with different partners this year and in the coming years to better improve the system of how companies are measuring their performance and are being accountable for. And maybe lastly, just also reflecting to a comment that was being made during the panel, that we need upskilling in sustainability. It's a critical element that was mentioned by the panelists. And so WBCSD also is trying to help companies upskill their workforce, upskill their suppliers or their partners through an education system or an academy where we are bringing the knowledge of our members as leading companies in working in sustainability and spreading this knowledge as much as we can to others that need it.
All right. Thank you very much, Nicolas.
No, thank you.
And now this is the floor for your questions. I received already one, and it is, does it make sense to devote so much effort to more precisely track Scope 3 emissions when the real work needs to be done at reducing Scope 1 and Scope 2 emissions? So what's your view on this?
Also curious to hear your take on this, but definitely it's a common question. I think the importance of looking also at Scope 3 is that leading companies in value chains that have actioned their Scope 1 and 2 know how to do this. But the long tail of suppliers and many other suppliers are not even addressing their Scope 1 and 2. So you can have companies that are helping their value chains to accelerate the transition and to accelerate their decarbonization journey by investing in support systems for their suppliers, for SMEs. And this will help accelerate the broader decarbonization journey of companies if you're also considering outside of your own Scope 1 and Scope 2.
Okay, thank you. So, Nicolas, you mentioned that, and I know that business was always ahead of the regulation in terms of sustainability. So, what are the benefits of measuring Scope 3 emissions? Because there was that discussion in the previous panel that, okay, it should be the final stop. We should not go further because it's too strenuous. What kind of real values for business you see?
Yeah, so once you measure properly, as you mentioned, you can actually start managing. This is fundamental. We are not in the state yet of companies having a clear understanding of their Scope 3 emissions. So currently, there is nothing you can do around looking at hotspots in your value chain because you don't really have the data available to do that. And once you start measuring, once data starts to be harmonized, then there's a very wide variety of different use cases that is unlocked. So for example, you can, of course, do product innovation based on your data. You can shift kind of the product formula of how products are made to ensure that you are creating low carbon products. There's also an element of procurement decision making that is unlocked by accurate measurement of Scope 3. You can support your suppliers in their decarbonization journey, so you understand a baseline at one point, and then with time you can improve. You can help companies improve their decarbonization targets. Also, maybe a very important one is about sales, marketing. All companies that are very active in sustainability, they want to be able to communicate about their performance on product level. We have, at least in Switzerland, there are examples of companies wanting to put a label on their products in the shelves. But if you're using average data again, then the number doesn't mean anything. It just means that shampoo is that emissions. But it doesn't help companies actually understand, actually showcase the difference between their shampoo bottle versus other shampoo bottles. So that's a couple of ideas. Maybe you also have some ideas.
I just wanted to raise the issue of greenwashing, because so there will be certain forbidden words like sustainability unless you are able to verify. So this is very critical, even in the business names of companies. So and we know that recently the EU released also some guidance on titles of investment funds that needs to be aligned with. The place for your questions, I think, if you have any that you are in okay? Just a second, microphone.
Is this aligned with the EU CSRD regulation?
Yeah, of course, that's a wonderful question. So we are currently, our objective is that a company that uses Pact will be able to use the data for disclosures. We have been working with the EU Commission in the development of Pact. We have received feedback from them. And really, the highest importance of companies developing Pact initially and then using it is to ensure that any resource they put into this then is going to be leveraged for reporting and disclosure. So it is definitely not divergent in ways of doing things, but you need to see this effort of carbon transparency first as getting accurate data from your suppliers. And then once you get that, the unlocks are many and various, including reporting of standardized data. Same for example, CBAM. We have talked a lot about how CBAM will impact companies. I cannot give a definite answer on how Pact can support you, but what I can say is that companies that have been using Pact are much better prepared to then answer to upcoming regulations.
One important comment, I think both Scope 3, the Scope 3 is reflected both in ESRS, E1, and IFRS S2. So there are 41 times mentioned in the ESRS, and companies will be also asked to show the percentage of greenhouse gas emissions which are based on primary data. So the whole system, converges into accuracy and primary data. So there needs to be some effort, exerted, especially with big companies, to avoid any greenwashing and any liability issues. Last question, Nicholas, what do you recommend? We are now in Czechia, where to start in terms of for real economy, for financial sector, and for public sector, both central government and self-governments? What would be your recommendations?
So I'll speak on behalf of what we've seen within Pact, but I think my key takeaway is to really start. You need to start understanding the data that you're collecting, the need of the specificity of the data that you're collecting, and consider a collective and harmonized approach. We have seen that companies are requesting specific data to their suppliers, or investment companies requesting specific data, but we cannot manage a system where there are different requests coming from different places, and we need to agree on what data needs to be calculated, how it needs to be calculated. And then companies can bring value into how to actually decarbonize. The measurement piece is fundamental, and it needs to be broader alignment on the data itself. And then we discuss how competitive advantage can be taken using this data, and how a business can be steered to capture competitive advantage. So my key recommendation is to really start. It is a journey, especially for companies maybe in the room. It is a journey. We have seen companies doing it for now up to 3 years. And I can definitely say that the first years, the data received was not usable at all. So the earliest you start, the earliest you will get data that is actually valuable, and that you will help your suppliers calculate the data that you need. And with time and gradually, things will improve towards a vision that we are focusing again on what matters, so decarbonization action, and we are confident in the measurement and how things are being measured.
Thank you very much, Nicholas. Thank you very much. It was my pleasure, and very much looking forward to further collaboration with our organization. Thank you.
Thank you. Thank you, everyone.
And thank you from me as well, Peter and Nicholas, for the brilliant presentation. One of the things we try to do here in the summit, as you may have noticed, because it's the third day, is to combine some of these more high-level panel discussions, although to be honest, even the panel discussions actually go quite deep, but also some of these more technical presentations focus on solutions of very specific steps, how to do things. And because, also you ask all these questions, and you can use it, and you can use the valuable information for your role, for your job, but also because we are in 2024. So 3 years ago or 4 years ago when we started the summit, we could have all these nice talks about what we want to do, but now we are definitely on how we are doing things, given all the pledges and all the commitments. And now we continue with how. So I'm really, really pleased to invite to the stage Stefan Müller from SAP, who will be talking about integration of non-financial information into financial reporting. Stefan is Global Solution Owner for Finance and Risk, and this topic actually has resonated and was one of the main components of all the discussion so far, I feel. So the floor is yours, and here we go. Thank you.
Yeah, thank you very much. Yeah, thank you very much. As already said, my name is Stefan Müller. I'm Solution Owner at SAP for Finance and Sustainability. And yeah, I've been around at SAP for almost 17 years, always in the area of finance and ERP, and worked with dozens of companies all around the world. And a couple of years ago, I started to see quite an interesting trend in the economy, that the topic of finance and sustainability slowly but steadily moved up the business agenda. And that was also the reason or the spark that I said, okay, I need to understand more. We need to get closer to this to see how our solutions from SAP can actually help and support customers on that trend. Yeah, and super happy, obviously, today that the topic has finally landed in our customer boardrooms. And I think this conference is yet another great proof point for this. And that's why I'm also very pleased to have the opportunity today to be on this stage and to show you how we from SAP, how our solutions can actually help customers on the intersection of finance and sustainability. But please allow me, before I dive into the topic, right, for those of you who are not so familiar with SAP, with the company I'm coming from, on what we do, spend a couple of minutes to introduce my company. And basically, we are market leader in business application software. We have a revenue of, we have a revenue of roughly 30 billion euros, and actually 99 of the 100 largest companies use our software. But we basically help companies of all sizes, and with that, and that's what we are very proud of, we are the biggest technology company headquartered in Europe. And if you want to boil it down, what we do, I'm trying to explain this to my family for 15 years, so maybe I can do it here now in a couple of sentences. We help people and organizations to connect, collaborate, and gain deep business insights. And we have a global network of more than 25,000 partners and thought leaders, and with that, we truly help the world run better. And when we think about what does it mean for us running better, we are a fierce believer that both is possible. Run a profitable and a sustainable enterprise. And that's why a couple of years ago, we decided to invest, and we took a bit of a bet back then, to really embed sustainability, carbon information into our main product, into our ERP solution, and connect it on the financial process and transactional level. Connect finance and sustainability on the process and transaction level. And that is what we call the Green Ledger. And what this Green Ledger is, how that works, what is and will become possible with the Green Ledger is what I would like to spend the next 17 minutes. And I'm very happy also for the presentation of World Business Council from Nicolas upfront, and because we also sit on top of this Pact standard that was just presented. And to start to unfold this question, let's start with a view on how we actually believe the role of CFO is evolving today, but already in the future. And to structure this answer, I really like this chart from our partner EY here, that basically grouped into internal and external drivers, as well as operational and strategic tasks. And let's quickly run through this section and start at the bottom left on the external drivers and the operation task, where we see the need, and I think there was a lot of talk about this this morning, for CFOs to comply with these existing and upcoming standards. Corporate Sustainable Reporting Directive, CSRD, but also outside Europe, I think that was also mentioned this morning, the evolving policies in the US from the Securities Exchange Commission, from California, and maybe to add one acronym to the soup of acronyms that wasn't mentioned yet, if we look to Asia, for India, the BRSR, the Business Responsibility and Sustainability Reporting, among so many others. So we see this cross-region, cross-industry, and for our customers, this is typically the problem at hand that needs to be solved today. And I think you all agree to just this task is already a big step. So many data points need to be identified, collected, processed, reported. And think about it, if we now start to report, let's take the Securities Exchange Commission in the US, you better make sure these numbers are correct, or at least explainable. But it's not only the compliance part, right? So if we now move up to the bottom, to the top left, and I think that's also very nice connected with the keynote this morning, we also see an increasing demand for sustainability information from the investor community. that before investors provide access to capital, they want to know information about sustainability, risk and opportunities, including their financial impact. But also internal drivers, right? So not only the external one, but also internal drivers that we believe drive a CFO towards more sustainability management. And there is a need to add the sustainability dimension to enterprise strategy and business model decisions, to not only decide on financial impact, but also to plan for the carbon impact of our strategies and business models. And if we want to take action on the strategies, we also think we need to evolve on the operational side, on the day-to-day decision-making, to not only decide from a financial, but also from a sustainability view, right? To make better decisions. To give you some examples, again, to link to the presentation just before from Nicolas, where to source a product from. Or, I mean, most of us likely traveled to Prague for this conference. Why only allocating cost to cost centers or travel cost budgets to cost center? Why not allocating carbon budgets to cost centers, which can help me on my decision for the travel option to come to Prague? Or another example, not only to calculate the cost of the service and the products that we manufacture, but also the sustainability impact of those. And doing this in an enterprise resource planning system, in an ERP system where the business transaction actually happen. And when we looked from SAP at these categories, we decided, okay, we need to add it into the ERP, so we need into our enterprise resource planning. We need to add sustainability in there and to connect it with process and transaction and eventually treat carbon like money. And what are these capabilities that such an approach will unlock? And this is first of all, audit-ready carbon reporting. Because if we post carbon to financial accounts, it will be a super seamless experience to add sustainability information to a financial report. Users can see the data lineage from a sustainability report all the way down to the prima nota. To give you an example, if we post 3.1 emissions to an inventory account, we can trace and link them to the individual goods received that caused these emissions. Companies, but as well as auditors, will be able to account for carbon for legal entities, for subsidiaries across geographies in an ERP system, similarly like we did to do it for finance, which will eventually increase the trust in these numbers. And we all know, and I think also the word trust was mentioned this morning, trust is such an important currency when doing business. But it's again, not only the audit side that, or the audit ready. And I forgot to say one thing, right? I mean, of course, what we also support with that is the anticipated move from today's limited assurance to the anticipated reasonable assurance that we already see on the horizon, right? Where we all struggle a bit, what does this actually mean? But if we move carbon data into an ERP system, we believe we can prepare for that. But now, access to insights. What we also do with that approach, we make carbon impact data accessible, understandable, and tangible to all users of an enterprise resource planning system at the point when the decisions are being made. Typically, this sustainability information is in a sustainability report, the 180-page that nobody reads, right, to pick up this one again. But with this approach, we link it to the process and transaction level at the ERP at the point in time when the users need to make the decision, which will eventually lead to better decision making. Because we can help companies to not only achieve on the financial goals, but also on the sustainability goals. And let's take the planning, forecasting, and simulation as an example, right? With such a system, we will be able to plan on business impact, on business performance, not only from a financial, but also from a sustainability point of view, with applying the same rigor accounting rules that we know from finance. double bookkeeping entry, changing of documents. I just cannot change it. Like maybe I can do in an Excel file, but I need to cancel it. I need to repost it. So we're applying the same rigor rules that build on this foundation of trust. But I would say, I take a little bit of a breath, I would say enough theory. You maybe think, what is he talking about? This is future. No, it's there. This is a solution that we will release this year. The pilot we will release next week officially. And I thought I'd give you a quick demo on how that actually looks like. And so that's basically the starting screen of our S4 system, right? And what I do now, I create so-called carbon collection documents. And also important to say, this green ledger approach, it doesn't come up with the carbon values. The carbon values need to come from somewhere, like when you create an invoice. When you create an invoice, you cannot say as a company that invoice is €100. The supplier tells you that this invoice is €100. In finance, we account for it. And the same thing here, right? So what I'm doing now is I'm going to upload carbon footprints from a solution called Sustainable Footprint Management. This solution basically sits on the Pact framework that Nicolas showed earlier, right? So where we can retrieve the carbon footprint information from. And this is an example here from a food processing company or consumer goods company. So now we get a couple of materials from this Pact network, for example, with some CO2 footprint. And we can go in, and now what we can see here, it's at the very bottom of the screen. Let's maybe do the first one. It's scope 3, obviously. It's 3.1 coming from products and suppliers. We have the footprint here. Down here, we have the different categories. So we have a bit of transport, we have a bit of CO2 footprint. And now the fun part of that is what you see here in the middle. Because now we start to assign accounts and profit centers and business segments and all the financial dimensions to it that you know from a financial posting. And one might ask, where do you get this information from? Well, we look in our ERP system where we today also already post goods received from a financial perspective. And we just reuse this accounting logic and now also apply it for carbon. So we can post carbon to accounts and we can post carbon to profit centers. So that's what we do here. Right, I now just said posted, I go to the journal entry. That is then not a financial journal entry. For those of you who are familiar with our systems, that screen looks very much like a financial journal entry. But the beauty of that is we are not posting financial, we are posting CO2 values on financial accounts, on company codes, on business segments, on profit centers down here. We give this a journal entry date, we give this a user, the same qualities that we know from finance. And now think about it. What we have done now, we have accounted the carbon into a company's organizational structures in a very traceable and auditable way. And this opens up a whole lot of beautiful things we can do. What you can see here, and as said, this is a real system, you can see here CO2 values, and in relation to the operating income, which would allow us to, for example, calculate emission intensity on revenue, emission intensity on operating income, and what have you. And not only do we have this now on a group level, as you see on the top left, what I'm doing now, I drill down to certain business segments, to certain individual cost centers, and can prepare their performance, not only from a financial, but also from a sustainability point of view. Oh, just jump a little bit up. Nevertheless, what you see here is basically what I just shown you in the system on the slide. So typically top left, top blue is the financial process. We have logistic process steps, which then result in logistic documents, invoices, goods received, whatsoever. In finance, we value them financially, which we post to a journal entry, doing some double counting, bookkeeping on certain accounts. We then do consolidation, and then we report it. And what we do now with the green ledger is basically the same thing. We take the logistic process steps. We now have a CO2 receipt, which is not the financial value, which is can be the CO2 value of that goods received. Again, refer to the Pact a presentation. We then post this into a CO2 journal entry. We then post this into a green journal using the same accounting logic that we have for finance. Do some consolidation, so to do operational control, financial equity control, all that stuff, and eventually prepare it for reporting. That's in a nutshell what we do. And as you see, right, this green ledger can be a very solid and trusted carbon accounting foundation. And with that, we can enable new analytics and new reporting capabilities, as we just saw in the demo. But we can also enable new planning and forecasting capabilities, right? Because with this system, we can use the existing sales plans and material resource plan that we today use to forecast finance, now to also forecast carbon impact. Looking at the risk management side, I mean, with this system, we're now also evolving our financial risk management practice to formulate sustainability risk and opportunities, including their financial impact, in the today's existing risk solutions from SAP for governance, risk and compliance. So not setting up a separate practice, using the financial existing practice and getting sustainability in there. Or period closing. I mean, with these standards and regulations that we heard about, a lot of additional tasks and responsibilities come to the period end closing that are typically, again, that need to be managed by a CFO, right? And not only the financial, but also sustainability closing we typically see in the CFO departments. And with SAP closing solutions, you can simplify, orchestrate, coordinate these new sustainability tasks, right, in the same process, in the same tools that we also use for financial period end closing. And I can continue. I only have 20 minutes and only 1.5 minutes left. I haven't even talked about consolidation. I just mentioned it just briefly. When we look at CSRD and with the need for operational control next to financial control, which can be different, right, based on equity share, based on operational share, we also extend our consolidation solution for group reporting, so they are able to handle finance and sustainability rules in one solution. We have different versions that different teams can work on the different topics, etc. But I just wanted to mention you that this green ledger is the foundation, and on top we now extend our finance solutions to cover the needs. And yeah, with that, I would like to thank you very much for your attention. And one thing I also wanted to say, which I almost forgot, we truly believe that this, what we have here, has the potential to pave the way to a completely new set of ERP systems and to redefine or reinvent the word of resources of this enterprise resource planning system to help our customers to continue to succeed and prepare them for future challenges and opportunity. And with that, thank you very much. And if you have one or two questions, more than happy to take them.
Thank you so much, Stefano. Good. Any questions? I think we have maybe 1 or 2 more minutes. If there's any questions in the audience, or if not, then you can still... Oh, we have one. Good. Let's do one.
Yeah, the connection resides on the financial org structures. For example, then you have on an account, let's take the inventory account. You know the value, the financial value of the inventory. On the same account, you see the CO2 value of the inventory. If you look to a cost center or profit center, you see the cost and the revenue associated to a profit center, plus you can see the carbon associated to this cost center. So on that level, we make the link. Technically, these 2 documents are 2 individual documents. We have the financial one posted at point A, and we have the sustainability one posted at point 2, but they use the same accounting logic in the background, if that answered your question. Yeah.
Very good. I think we only have time for one question, but I'm certain that maybe if someone catches you up in the hallway, then they can still ask some more questions. In the meantime, thank you so much the staff of the hotel that they seamlessly replaced the stand with the chair, because we do have more speakers in the next panel. Now, Stefan said many things to react to, and I'm trying to be brief, but in the end you said one very important word, which was reinvent, right? Because we are actually reinventing or trying to, again, collide and merge two different worlds, which is environmental with sustainability and financial, which has been established for a long time. And it's really interesting take as well on this, try to reinvent maybe even the perception of how these two worlds can collaborate and can be synergetic. Now, I did mention how and transition so many times in the morning and even in the previous days. And now finally we have a panel on transition and implementation. So we actually have a panel focused on how. Now, the moderator will introduce the speakers, but again, as the other panels as well, I think the mix of speakers is actually very unique and very interesting to discuss how. Because it's consultants, it's banks in terms of financing, consultants providing advice to companies, and also a head of strategy of a company actually implementing the solutions or transition. So without any further ado, I will invite Simon Mondi to the stage. So Simon is editor of Moral Money at the Financial Times. So we're trying to, and the idea is to go a little bit deeper into practical implementation of sustainability and also transition plans. And who is better to do that? Who is better to dig deeper than a journalist from Financial Times? So please, Simon, the floor is yours.
Thanks very much. And I'd like to invite the panelists to the stage, please. So just to quickly introduce this session, I think it's worth taking a step back and just considering what this word transition means. Because we're talking about something absolutely enormous. Since the 18th century, since the Industrial Revolution, we have been living in the fossil fuel age. And that has been by far the most transformational period of human history, with dramatic advances in life expectancy and technology and human population, you name it. We've now realized, and all of that was based upon a fossil fuel foundation. We've now realized that fossil fuels are cooking the planet, and we have to move to transition as quickly as possible into the post-fossil fuel age in a matter of a few decades. This is, without any exaggeration, one of the biggest things that has happened in human history. And there are three really important things, I think, to remember about the energy transition. One is just how urgent it is. I've been, as a journalist, to places where people are already losing their lives and their livelihoods as a result of climate change, and this will only become more serious in the months and years and decades ahead. The second thing is the enormous opportunities that are available for the companies that really ride this wave of the energy transition, and of course the existential risks that face the companies and businesses that fail to do that. But the third thing, of course, is to remember this is going to be complicated, that this will present huge challenges. Anyone who presents easy solutions to these challenges should probably be regarded with some caution. But nonetheless, it is important to discuss the solutions and the ways of moving forward, and that's what we're going to discuss in this panel. And you'll notice conversation with the audience. That means we're going to talk, but you have to talk too. So we're really going to encourage people to speak up from the whole room. This is a safe space. There are no stupid questions or stupid statements. None of us have all the right answers, but the more that we can exchange ideas, the better chance we have of moving forward. So to quickly introduce the panel, to my right, Christine Werfel is the head of Group ESG and Sustainability Management at Raiffeisen International Group, headquartered in Austria. To her right, Marcus Pugh-Smith is Client Portfolio Manager for Goldman Sachs Asset Management Fundamental Equity. To his right, Jana Ružička is the Sustainability Director for Mazars Slovakia. To her right, Justina Wysocka-Golec is Associate Partner for Consulting in ESG, Decarbonization and Biodiversity at KPMG Poland. And last but certainly not least, Ivan Jakubek is Chief Strategy Officer for Eurovag, headquartered here in Czechia. So Christine, to kick off, what does transition mean in practice for a bank like yours, operating in Europe with a lot of work in this region, also, of course, in CEE region? What does a transition mean to you, and what approach do you take to it as a bank?
Thank you very much, Simon. Yeah, to put it in a nutshell, I think there are two changes, really big changes for a banking group, and I think here I can also speak in general. The one dimension is according to our relation to clients, customers, and the other dimension is also, of course, the internal change. So first of all, if you look to clients, to customers, first of all, and this is really a culture clash in a way, the purpose of financing of a financial product, of a service to customers is suddenly in the focus. You are engaging with the client and you're asking, why are you financing something? The purpose, the ESG purpose, is in the focus of the discussion. This is new. Before, it was only the creditability and the compliance of a customer. And secondly, and here really a new client engagement process developed, which triggers, of course, a lot of knowledge, ESG knowledge for relationship managers in the different industries to really support here the client. So banks have been put in the forefront of the Green Deal, really kind of intermediary to help here, to support here. This is really an instrument by the Green Deal to put here the financial sector in a role to support customers. This, of course, has a connection with a very stable knowledge, very good products, which we can help them. So this was an internal, I would really say it's a kind of nearly culture change here, really to establish a new advisory role to foster the relation between the bank and the customers to help them here in the transition. Internally, and this is also quite was a challenge and was a big step. ESG beforehand, we had reports in 10 years now, 180 pages every year on all what we are doing. In the meanwhile, this ESG is nothing what we are only having our own in-house ecology footprint calculated, what we are doing with our employees on the social aspect, but really it's established in the business strategy in our portfolio, because in our scope 3, which are our clients, our customers, there is the impact, there is playing the music. And this is now really integrated. So you have KPIs in every board member's performance management. And suddenly it, of course, if a board member has ESG KPIs in their bonus and in their performance statement, then it gets executed. Then it's implemented. And this was a very important shift. So it's implemented. And the second also change was that bankers are used to use historical data to calculate sophisticated models to scenarios for their portfolio development. I'm a bloody lawyer, so I'm not with the figures, but I know how they are very figured and Excel-driven persons, and suddenly there is no historical data available. You really depend, for the time being, on estimates, on benchmarks. So, for example, for the CO2 footprints on the average on every industries, you can rely on the data from the International Energy Agency. Of course, we know where we have to go in 2015 to be neutral. But actually, the steps in between are also now, in a way, given, but the transition is not clear. And then if you have to calculate this transition, but you have no proper data really where you can rely on, because it's such an average, if where really you are, then that's an uncertainty factor. But on the other side, regulation and also expectation are driving to set targets. And this is something, this is a new role where also decision makers have to take. And it will be the new normal that you yearly have to recalculate your targets because there are so many uncertainties on the scientific base, climate change, who knows really how it develops, but also on the data. It's increasing, of course, but for the time being, you rely on estimates, and this is something new.
Some really important points there. Thanks, Christine. And I think you're absolutely right. On the data, there's clearly shortages of certain sorts of data. But as you say, in the meantime, there are ways of working with this. There are estimates that can be used. And obviously, with the new regulations coming in, especially in the EU, but of course not only in the EU, globally, all over the world in different forms, new regulations coming in around disclosure, which will result in an avalanche of new data for banks like yours to work with. Justina, you work with a lot of companies that are thinking about these issues, and I suppose some of them, from Christine's point of view, Christine might be quite excited about the data that's going to come as a result of CSRD. I wonder perhaps some of the companies that you work with, they might be a bit nervous, where this is going to be a challenge for us to produce the data. Is that right? And more broadly, the companies that you're working with, how are they viewing transition as a challenge?
Mm-hmm. In my opinion, what waits companies in the near future, it's not just a transition, because we simplify that and think about switching fuels from fossil to renewable, or about reporting based on the CSRD. For me, it's a whole transformation process. We are now facing a global climate crisis. The last month was the hottest ever measured. The last year was also the hottest. So the need of transformation is because we decided to tackle that crisis. And this requires from us, from business, but not only business, but financial institution, governments, to transform the whole business models. The energy sector and transformation in the energy sector and how we use energy is just the beginning. We need to go through a deep transformation and seek opportunities to decarbonize manufacturing, services, real estate, transportation. We need to reshape our business models, how we design, how we produce, how we reuse, how we recycling, and this is called this is called a circular economy, and this is a donut economy model. And I think this is the circular economy, together with Blue Deal about water management, is the next big thing and big challenge for companies.
Thanks so much, Justina. So to move on to a company that's very much operating in the real economy. And Eurovag, I'm sure many of us are familiar with this. This is a really important Czech company that provides services for commercial road transport. How are you approaching the transition, both for yourself as a company, but also there's many things that you can do to support your customers, these logistics businesses, to pursue their own transition. How is this working for your company?
So I'll start a little bit on where we are working at, because many of you may not know where we stand at. And I'm very happy that I can touch to many of my presenters. Even your transformation story is something which is relevant to us. Eurovag is working in the transport industry. So the previous presentation about Scope 3, that's what we are solving for other businesses. And all these 3 days were about how we actually get to data and transparency. So that's what we knew 7 years ago. We knew that when we were trying to implement the sustainability into transport industry, we needed to have a core data from vehicle from what we do. So answering your question on how we solve ours and others, or the scope 3, which I would be more referring to, we actually said solving ours is so easy because that's just our own private decisions. 99% of all emissions are actually scope 3. So why I'm here? Because we don't put the sustainability, because we take it broader just than ESG and data. Why I'm here? Because for us it is a strategic move. For us it is not, and also I am responsible for ESG in our group. So we decided that that's not a CFO job. That's a job of business. Otherwise we'll not be able to achieve. And giving you kind of a perspective, what we look at is around the data. We really focus on we measure what matters. So I will try to explain you where it is. We all kind of forgot what transportation is. When we really realized it was recently COVID, when we didn't have water, when we didn't have a toilet paper in the shops. Why? Because the trucks were not moving across the borders. All the chairs we are sitting on, or the mobile phones we have in, that's transport. But many of us are forgetting that the transport is actually unsustainable business. Drivers doesn't want to work there anymore. It's a very difficult job. Their dispatchers and their business owners are actually on the verge of bankruptcies every year. And that's what we decided that's actually our role. So from this perspective, we, a few years ago, changed the purpose of Eurowag to make a transportation industry clean, fair, and efficient. And that can work together. So we have a super story of win-win-win, where customer is winning, us as a business is winning, and the environment and all of us are benefiting. Why? We mentioned that the scope 3 in a previous presentation is quite a lot of is there from transport. So if you count out of whole European Union CO2 emissions, transport is 25%. But a lot of us started with the scope 0, scope 1, scope 2, which is us. We try to take bikes and so on. But nobody understood that there is a segment which takes a lot of it, which is truck. Truck is transporting the goods to us. His emissions are much higher. So out of the whole 100% of CO2 emissions, trucks are making 8 to 9%. And that's where we focus on. So as a small company with 2,000 employees, we are trying to make sure that out of this 8 to 9% will be as little as possible within the short future. So we created the solutions, actually what we invested in and how we solve ours. We created solutions that engage truck drivers, engage dispatchers, engage business owners to work with us, to collect the data and actually improve their businesses. So at the end of the purpose, we start with clean and end with efficient. We are bringing up to 20% savings to our customers. So if we started, I think it was 2019, when we had the first prototypes, we gained in 13 months, you can imagine your business, most of you are business-related people. In 13 months, we gained 10% market share in Europe. How? Because we just give to customers something they were looking for, free, and we started to collect the data. So I think what is important for all of us is this transformation which you mentioned. How we can focus on the most important data point. Doesn't matter if I have 150 pages ESG report, right? But that the one that I can collect the emissions from the truck, that's the important one. Because then I can build business out of it. Then I can make sure that I'm providing the driver with a driving style he can follow and he can save money. The data, which then I can transfer to the business owners, and they can make better decisions when they are ordering loads or negotiating prices. So where we focus where the data matters and where we can make the largest impact.
That's some really interesting points, especially it seems that you're viewing this not simply as a cost, but as an opportunity to get a competitive edge by taking a strategic approach.
I believe that any investments which anybody is now making should make the world better. And this is a floskel, if we would say it. But no, I think that was a year where we really spent time on, can we make this change? What it embeds? And I think all of us can. So all the businesses can make their investments actually making the right decisions through all parties. What I can bring to my customer, that he makes the good, and he benefits from it, and the society benefits from it.
So Jana, this is, of course, a conference that we're having here in Prague. It's largely talking about challenges and opportunities in this region, in the CEE region. How do you feel, so you're based in Slovakia, how do you feel that the conversation around the transition in the business community in particular is perhaps different in this part of the world compared with other parts of Europe or other parts of the world?
Mm-hmm. I think we should stress that no company can do transition alone. So I always recommend my clients to join some multi-stakeholder initiatives and to work on sectoral issues together. That's maybe the difference, that in the past there were much more such kind of initiatives in Western countries than in Slovakia or Czech Republic. I was myself establishing a Slovak Business Leaders Forum, which was focusing on sustainability with business leaders, but that was new and it was existing 50 years in the UK. It was Prince Charles NGO. But so I really encourage clients to do the proper stakeholder engagement, and not only via sustainability reporting, and to ask them before they start their double materiality assessment, but also during the process, and also at the end, once, for example, the report is published, because you, of course, inform the other stakeholders. You do it for themselves. So you should ask them how they like it, what their thoughts are. In this, for example, there's one retail company which every year, I think they do it like 7 years in Slovakia, where they organize such kind of stakeholder roundtable, and they, in a secret environment, they talk about their concerns and so on. And so this is new, like maybe in the past, during the communism, we were more like closed, so now the companies are experiencing this, like this opening and speaking to other stakeholders. Another good example, I was advising a client who is a drug or medicine store chain, and they are first-time reporters, so they didn't want to invest so much time and money for stakeholder engagement. So they thought, like, okay, we have some business customers, the pharmacies, they always ask us some questions via questionnaires, so let's see those questions and anticipate that's their concerns. But I was really pushing them, let's organize at least like 2 face-to-face interviews with pharmacies and listen to them. And at the end, the result was really impressive for me, because one of them, their concern was very much about unused medicines, like take-back programs. And this is really unorganized in Slovakia. So basically, the company, I think it's some government agency, in some stores, they collect this hazardous waste like once in a year. So employees are there, just there is a bad air. And this pharmacy was very much because it's their product, so they risk. So they said, like, at the end, the result was, okay, let's change it. Let's go together. Let's contact other pharmacies. Let's go to the ministries together. And if not, they're going to change it. Let's create our own system and just go, establish own agency who will collect this, because this cannot continue. So this was really, 2 interviews, and one of them had a huge impact, and this would never happen once you only collect some inputs from questionnaires. So really, this is a very good example. And when we are talking about the stakeholder engagement, I'm very happy that we had the SAP here, because they are one of the very advanced companies, and this is because you have, like engagement, which is like your engagement are on war. They don't know what you're doing. Then it's like neutral, then supportive, and the highest level is that they are actually like advising you or kind of leading you. And for example, SAP do have a AI advisory panel, so they really invite other stakeholders to guide them through this. So this is really very advanced, but step by step, I think.
Thank you, and I really like your emphasis on collaboration, and I think you're right that perhaps in the countries that have achieved fastest progress around the transition, often collaborative industry initiatives have been a big part of that. So it's encouraging to hear there's more and more of that happening in this region. It's also one of many good reasons for this conference, which of course is encouraging other sorts of collaboration. Marcus, to come to you, obviously Goldman Sachs Asset Management, one of the biggest asset management outfits in the world. There's a lot of discussion about how much asset managers care about green stuff, how much asset managers care about transition plans in particular. What's the Goldman Asset Management view on this? How much do you care about transition plans, and what do you look for?
Yeah, no, absolutely. And I think throughout discussion today, certainly in the CDP presentation, the focus has been on we need to get money moving, and that's exactly what we're focused on here. And I think if you take a step back and think about maybe ESG investing more broadly, over the last few years, perhaps that's been oversimplified. You think of fairly ubiquitous exclusions, you think of not owning certain sectors of the market, you think of fossil fuels, weapons, but actually, ultimately, you don't have a seat at the table with those companies if you aren't owning those sectors, and you're fully overweight on much more clean parts of the market where perhaps from an investment perspective, valuations are stretched there specifically. But if we take a step back and think about where actually our emissions are concentrated, they're very, very specific to just a handful of sectors. So 82% or so of scope 1, 2, and 3 emissions come from only 5 sub-industry groups. So that's energy, materials, autos, cap goods, and utilities. Those represent roughly only around 20% of the market and upwards of 90% of water withdrawal and total waste. So there's a huge opportunity to make a real difference with real-world impact, working with those companies in those sectors, as opposed to just what is called on-paper decarbonization, so just divesting from businesses in those sectors. So I think that's something we're incredibly focused on, is investing in solutions, so your impact businesses, the very technologies that can help those businesses to decarbonize. So decarbonizing portfolios in line with net zero at the same time as investing in the solutions that provide theirs. So I think there's a couple of great examples that have already been touched on today in terms of the steel sector. I think discussing transportation specifically, you mentioned, Ivan, a great point around cost reduction there. That is exactly why we see a huge opportunity for companies to reduce costs and ultimately create value through transition. So by focusing on those sectors, we think there's a huge opportunity to fully push progress.
And what are the financial incentives for you? I mean, does this seem like a really exciting investment opportunity, or is it, do you think it's been overhyped, perhaps?
Well, I'm very biased talking about this topic, but I think fundamentally there's a huge opportunity from perhaps where we see transition risk as mispriced by the market. So companies being over-penalized on valuation because of a mispricing of their transition risk. And actually within that, there's a huge opportunity to identify companies that are really starting to progress in high-emitting sectors and ultimately work with them over time and see that value fulfilled. So the challenge there, understandably, is, are you just looking for ways to earn dirty companies in high-emitting sectors because you want to get more value-oriented exposure into your sustainability portfolio? So that's why it's critical to be partners with these businesses, to work with them over a longer time period as long-time investors, to engage with them, to monitor that, and ultimately see that valuation premium reflected appropriately and also see performance there.
Interesting. So there's sort of been a valuation penalty applied in some cases to a whole sector because it's got a big carbon footprint, but actually within those sectors, the companies that are moving fastest can actually present quite good opportunities.
Absolutely. And I think you've seen some great examples in the building space in Europe, similarly in the shift from coal-powered utilities to renewable-powered utilities in the US, similarly moving from oil refining towards sustainable aviation fuel and biodiesel. I think there's a huge amount of opportunity there.
Thanks so much, Marcus. So I'd like to throw it open to the whole room, and feel free to ask questions about anything you've heard, or if you just want to share your opinion, very keen to hear from the audience. Don't be shy. Well, yes, please. We have two hands suddenly went up.
I would like to ask you a question, I think probably to the lady from Poland and from Slovakia, because you are from advisors. I would like to ask you if you experienced a local company which is a subsidiary of grandparents somewhere who has to report based on the CSRD, which is applicable from this year. And the local company, which is small, doesn't have the systems for monitoring all the data and so on and so on. How the company should start, or how did you advise them? Because, it's a local company, small, they don't have people, they don't have systems, they do not monitor all this information, but they have to provide the data to the headquarters, because it's the whole group and they have to report everything, at the headquarters, let's say in Poland, because, the company in Poland, it's listed. How do you advise, or have you ever experienced, this kind of advisory to the local company, how to meet the, expectation from the parent? Because I think it's a situation of many subsidiaries in the Czech Republic, where they do not need to report locally because they do not have, the turnover here, or they are not listed on the domestic market, but they have to provide the data to the headquarters. So if you can share, some practical examples, because, I'm just coming from the, from the real environment, and we have exactly the same situation. And we just, struggle with that. And we still do not know really what kind of strategy our grandparent, is really giving to us. And we are almost in the middle of, June, or at the end of May. And we do not know what is required from us. So we used to report some data on the former, like a non-financial reporting, which were quite fine, didn't take too much time. So I'm from a finance, was getting all the information from the others. It was fine, but absolutely I do not know what to expect, for the CSRD reporting. If you can share some practical examples from your advisory services.
That's a really important question. This is, of course, one of the big concerns that's raised about the CSRD is the burden it could place disproportionately perhaps on smaller entities, and also as well as subsidiaries, potentially suppliers to big companies that will be faced by requests for information.
I know many companies, they are facing the same problems, and I think the general answer is that's why we prepare double materiality assessment, to identify if your company is important in the whole chain, in the whole group or not, or where are that data points, where are the places with the most important issues. And if you have the important places, important data points, they need to help you to tackle with that problem. Of course, it's also their responsibility. It's not because if we talk about responsibility, about disclosure, we said that that companies are responsible for the whole value chain, and it's not means only the whole value chain, the contractors, but also the company they own.
Ivan, could I get your take on this question of the reporting burden that can be placed upon companies, whether it's your companies, other companies that you work with?
I'm smiling, sorry for that, because actually, by background, I'm accountant. So I love the numbers, but it's really a nonsense. If I have to prepare the report, and my background is also coming from a private equity, so I'm looking at, would I be able to make the right decisions as an investor? No. So I think what we need to find the way through is find those things that makes impact, but real impact on a daily basis, and focus on measuring those. Because you opened the speech actually today how urgent all the change is. So when we started 7 years ago, we said until whole industry will be able to measure it, it will be a decade. Until the whole industry will understand the numbers, will be another decade. There's no way to wait. So what all of us should start to think is, what are those 80% of the problem? Cut it, measure it, and then push. But generally, what I think is, theorists, governments, policymakers are trying to make another tax. I'm sorry to say so. Instead of inclusion like we have now today, inclusion of business, customers, and those who are affected, and discuss what actually matters. And let's start measure what matters.
Thank you. We had another question from the audience, yes.
Thank you very much. Interesting discussion. Most of the countries will be revising their nationally determined contributions, which is basically a transition pathway for the whole country. They are due next year. What do you think? And I like the comment is that actually impact is mobilizing as much finance into the projects and into the transition which is needed. What do you think is would be the ideal role of the sustainable finance community and the private sector involved in all these new tools in shaping these nationally determined contributions? I'm coming from the United Nations Development Programme. Unfortunately, I don't see the finance community and the private community anywhere near the discussion table about these processes that are going to start very soon.
It's a really interesting point, isn't it? Because it goes, national policy shapes what the financial sector does, but the financial sector has a powerful voice when it comes to shaping national policy. Christine, Jana, Marcus, maybe you'd like to...
Yeah, I think absolutely to your point, we need to see a huge step up. It's not just enough to simply pledge and push these things down the line. You need to see a movement in terms of activity, so actual monetary contributions put behind that. And you see that playing out in different ways. You see the US going with much more of a carrot approach through tax credits, through the IRA. You see Europe with a different approach, with the stick approach, and saying you must hit these decarbonization targets by 2030, otherwise you'll be penalized. But overall, I think that will stimulate further activity. And there's an ongoing debate really in terms of, is the market in the finance space sufficient to really drive the transition here? Is price the right way to do this, or is subsidy the right way to do this? So I think that's a huge focus where we need to see a step up in the support from national contribution there.
And if you look to the Green Deal, which is using reporting as an indirect influencer, so these are all indirect measures. You have a goal, you have to report. But it's kind of mid-long-term perspective where you have to be. But there are no really direct measures. And as you said, the carrot in the US by tax reliefs or anything which really enables you to act also in the short term and make things happen. This is something which should come from states to support the transition as well. Because I think the concept in Europe with this reporting, with this double materiality, where you really then know for your own, where are the material topics, where do I have the positive, but also especially the negative influence on the environment, on social and governance topics, where I have to move. This is not only a solely reporting duty, this is really something which should include into your strategy for your company for the future, how you can make it stable. And to be honest, in this current environment, you have no security with all with inflation, with the geopolitical developments, on what you can really put your cards on. I think this is really sustainable business. And if you use the reporting as a kind of North Star where to go, but not only to tick the box, but to really see the impact you can use and where you have your negative, your positive ones, then you can move it. But for this, you also need these short time incentives. And here I see the states very much in driving also this process.
Jana, how do you see this process playing out in Slovakia or indeed other countries in the region and beyond, in terms of how far national policy affects what businesses are doing, how far the voice of business affects the national policy? How do you see this developing?
Well, currently for CCRD, there was not much allowance for national government to change it. I am aware only about like who will audit the sustainability report. That's what was left for countries to decide, and then I think the fines, like what would be the fine once the company will not publish the report. So we are more working with, I would say, with private businesses, with business, not so much with the government, unfortunately.
And as you say, so much of the key direction of travel is being set at the EU level, which is why the upcoming European Parliament elections are incredibly consequential. Not only, by the way, because they have a bearing on what happens in the EU, but EU policy has a massive bearing on what happens all over the world. You know, if you look at how CSRD will have a lot of reporters under it who are non-EU companies, and of course the suppliers that, through the cascading effect, it will have an effect all over the world. That's one of many things I'd love to discuss further with the panel. Unfortunately, we are out of time, but please join me in thanking the panel for a wonderful discussion. Thank you.
Thank you.
microphone. No. Hello, hello, after lunch. Hope you enjoyed the lunch break. And now we can already move to the next session, the upcoming session, which will start with the presentation by ISSB, by Jenny, but also then, as discussed before, we will move into real estate. Now, I'm conscious there's a TV with speakers in the hallway as well, so probably people can hear me behind the wall. And I saw so many of those people waiting for coffee, so I'll take it really slow and wait for you. And not that slow, I'll give you maybe 30 more seconds. But so we will now kick off the afternoon with the presentation by Jenny Bofinger-Schuster from ISSB, which for many people, and I do hope they appreciate it and realize that it's not that often that we actually have people from ISSB speaking in Prague, from my experience, going to conferences as well. And we often are very Eurocentric, which is understandable, I think, but also it's amazing to also include and discuss all these global approaches and global standards. And not only just to compare, but also to see what is happening in other countries. Nate and Fabian connected it to, or discuss also China, the US, and I think that's sometimes needed because we do feel like we are in this bubble only with all the things happening in the EU. So, Jenny, the floor is yours. Thank you very much.
Thank you. So that's a tough slot, speaking about standards after lunch, but I'm sure we'll get through that, so I do my best. If someone has a question in between, please raise your hand, or do we use the chat as well? Okay, whatever. I'm trying to answer all your questions then, of course, as well. So before I start my session, there's one super important point. That is that I really want to thank the organization for this beautiful conference. And we tend to forget there are all these people back there in the technical section. And I just had a super last-minute request, and they just made it happen. So thank you very much for doing that. We tend to forget when everything is running so well to thank the people who are really taking care of all these technical topics. So let's get right into it. I also have to challenge that I've shared quite some knowledge already in the panel this morning, but I know that some people are new in this session, so I kind of have to ask for your understanding that I start at the beginning. And the beginning is Glasgow, November 21, actually one of the first events that took place after COVID. And I was in Glasgow when they announced that the IFRS has now the task to define and develop one global baseline for sustainability disclosure. And while I was in this room, in the very first second, I thought, that's genius. Because we really need this to happen. There's no alternative to this. Imagine you are a company and you're active in 100 countries, 150 countries, or just 10. Should you now respond to all the different now mandatory reporting guidelines that these countries have? Probably not. So we really need that. And there was a strong need, and there is a strong need, that we have this one set of decision-useful, comparable information, particularly for the investors, for the capital market. And why was I also from the very beginning super convinced that this is the right task to do? Because it's with the IFRS. The IFRS has proven that they can set such global standards. They have the right processes, they know the audience, so we have the luxury of really using this super established, super strong system and approach that the IFRS is having. And that's really special. And maybe a last comment to this picture. We always speak about this alphabet soup. And so I wanted to have this picture, and it's pretty hard to get these pictures, and it's expensive, and we're a foundation. So you can use that picture if you want to when I share the slides, because it's my picture. So you see me in the spoon when I actually took the picture, and my kids then ate the noodle soup later. Well, sometimes you just have to do things. So the approach that we are taking, and that's also important to understand, is that global baseline. So we want to define a baseline with disclosure that can be applied and used all around the world. And I want you to keep this in mind for the discussion later on, because if you want to do something that can be used all around the world, that brings certain implications for how we work and also what is then included in this baseline. But, and that's important, this baseline is defined in a way that you can put building blocks on top. So if a country, for example, wants to add additional information requirements, this should be done in a very seamless way, ideally, so that the preparers is the people, the companies basically, who are preparing the reports, so that the preparers, that the companies don't have any extra burden, and that they also don't have any duplications, redundancies, but that this is seamless. And it also allows to have building blocks if you want to disclose information also for other stakeholders than just the investors. So for example, with GRI, we are also having a strong memorandum of understanding how we can make this fit, again, in a way that this is seamless. And keep this baseline idea also in mind, again, when we think about all these different country approaches. So what we envision is that if you apply ISSB, that this is a bit of like a passport logic. A passport that allows you to then enter these other countries with a very strong set of sustainability disclosures. We've published the first 2 standards last June. And I celebrated that day also, well, because it's a big deal, but also because I was allowed to open the Frankfurt Stock Exchange, the stock market, ring the bell with our standards. And I found it a special moment because for me it really felt like we're at the capital market. This is now real business. And that's why I really, really enjoyed that day. So let me give you a short intro to these first 2 standards. And I would really encourage you to read them. It's not a very long document. They're easy to read. And when I read them for the first time, I was actually at, well, the exposure drafts that were ready at this time, I read them at the beach in Greece. And I'm not a very nerdy person, I believe. And still, I got a sunburn because I was so excited reading through these first 2 documents. So I promise you, it's really good to read. And we had this before today in order so that you can form and have your own grown-up opinion and you know, shape your own change curve here. I think it's key to read the original. Just read it. Don't look into the comments. Just read those 2 standards. And in this one, in the first standard, we pretty much set the overarching frame for the sustainability disclosure. All the rules, all the logics. And this is very much in parallel to what IFRS is doing on the accounting side. So there should also be very sort of the definitions, the words should be very familiar if you're already applying IFRS on the financial side. We do, and those risks and opportunities are typically industry specific. So let's say a software company is probably facing different risks and opportunities than a building company. We have real estate in the afternoon. And so we want to have industry-specific disclosures. So let me speak a second about this material definition. When is information material? Because I just said S1 is asking you to disclose all material information about your sustainability-related risks and opportunities. So this is kind of a key concept and a key filter. Information is required to be disclosed based on our standards if it's material. And material means that if you either omit, misstate, or obscure this information, that this could influence the decision of an investor. That's always kind of the idea, the basic idea behind. And this idea should be also familiar to those already using the IFRS standards on the financial side. That's the lens that all the disclosure in ISSB is following. So S1, again, setting this overall frame with all sorts of definitions and concepts, key concepts, and also asking for the disclosure of all sustainability-related risks and opportunities. Then S2 is, let's say, the first really content-driven standard. We always said we do climate first, but not climate only. And so we focus on climate in the first 2 years and have now published S2 last June, asking for all material information about your climate-related risks and opportunities. And also in S1, but I think it's easier to explain it here on the climate side, we are applying here the TCFD logic. Because if you want to define this global baseline, it of course makes sense to use and to integrate concepts that are already well established. And of course, with all care and with all due process that we apply to this. And TCFD turned out to be one of them. So TCFD is fully integrated into our standards. And the FASB has also asked us now to track the TCFD implementation in the future. So what does TCFD, for those of you who are not familiar with it? It basically means that you always look into these risks and opportunities in your governance. Who is responsible? We heard that today before. Who is accountable for that? What's the strategy? How do you want to deal with that in the future? What's the risk management? So how do you actually identify these risks, and how do you then also track them, monitor them, and see whether the change that you have defined in your strategy is also really happening? And last but not least, metrics and targets. How do you measure it? And if you have set yourself, your company, a goal, a climate goal, then you should please also disclose it and also show the progress that you're making towards it. So those are the first two standards. And now it's key that the countries all around the world take the time and also care and see whether and how they want to implement our standards, because that's the task of the countries. We have very, very strong backing, and one I really want to mention here is the IOSCO, who endorsed our standards last July. And that's such a big deal for us because they did that once before, and that was for the IFRS financial accounting rules. And we see now very strong dynamics in many, many countries. We had that discussion before today, 20+1. We saw China publishing their exposure draft this week. Too early to talk about it in detail. Give us time to digest and to look into it and to translate it. But again, there's strong dynamics of countries all around the world applying that. And maybe one point that I also want to do here with these countries on the page, there's always a discussion on how can these standards also be applied by SMEs. In our case, I tend to say that's integrated in our work automatically because we want to have an inclusive approach that allows also, and particularly the Global South, to use our standards. And we see also particularly there, I think Nigeria was the first country ever who immediately said we're going to apply your standards. We see that this is working and that this proportionality idea that we have throughout the standards seems to be really working. Not sure whether I have to speak too much about ESRS as we did that this morning already, and we had a very, very good, very constructive discussions throughout the last 2 years together with EFRAG. Again, we share a very strong sense of responsibility to make this interoperability between our standards and the ESRS, the European standards, work again in a way that it's seamless and that it's not giving too much of extra burden to companies and also not to investors. If you do want to understand the details on how this now works, I am an ESRS a reporter? What do I have to do to also fulfill ISSB, or vice versa? There's a very detailed interoperability. Well, it's not so detailed. We standard setters tend to say it's so, that everything is so complicated. It's 33 pages in this case. So also this is something, you can look into, you can read yourself, and you can digest, and you can apply to see how you can best navigate in these two worlds. So you've seen now how we've started, what's our mandate, what's our concept, the baseline, the building blocks, the first two standards that are published and ready to be used, which is, again, asking for all sustainability-related risks and opportunities and information about them if it's material. You have seen how the countries are now adopting our standards. And so the question is, what's next, right? And the way we work as standard setters is very, very open. So everything we do is based on consultation. And I know that there are many organizations in that room here that would send us then letters if we have a consultation open and where we have questions. And so one of these consultations was now last summer on what's next. What do our stakeholders want us to focus on next? And on a broader idea, what we've really heard is they want us to focus on implementing the first two standards. And at the beginning, we were a bit like, yeah, of course, they don't want to have something new. But it's more than that. There is very strong push, support, and maybe also hope that this concept that we are developing really works. And so stakeholders really urge us to support the companies, to support the countries, to really implement these first two standards properly so that there's a very strong foundation then to put the next topics on. And of course, there is then, in addition, the need to work on the next standards, the next topics, but there's also, of course, more fundamental activities. I spoke a lot about interoperability. Maybe another keyword is connectivity. That's the idea. How does the financial accounting match with the sustainability disclosure, given that the IASB on the accounting side and the ISSB, that we are both home in the same organization? I believe that's clear and a given that we work on this. And of course, stakeholder engagement, as I do, for example, here today, is key as well. So what are then content-wise the next standards we are starting our research projects on right now? Again, that's based on consultation. So also if we have consultations, do me a favor and participate, because that's the way you're being heard, and you are being heard. All the letters, and we had 1,400 for S1 and S2, are being summarized, are being put into decision proposals that we then discuss in public board meetings. So everything is transparent and you are really, really heard. So please participate in these consultations. And so the next two content projects we're focusing on is on biodiversity, and the second is on human capital. I think it's clear that for both there is a strong push, and that's again what our consultation led us to. We have strong support. We have seen now also in the first voting, in the proxy voting guidelines this year, the ISSB being mentioned. You've seen the countries that are supporting us, the strong organizations, the G7, the G20, the IOSCO, and others. So I'm very positive that this will be successful. That said, thank you very much. You did fantastic after lunch, I really have to say. So thank you for that. And we have 2 minutes 28 for questions.
Any questions? Hands up. Oh, Simon.
Thanks so much for a really interesting talk. I just wondered if you could talk a bit more about the materiality wars, as some have called it, and whether you think it's a bit overstated, the extent to which there's a big difference on that front. Because if we're saying that under ISSB standards, you should disclose anything that would be material to investors. A lot of impacts on the environment and society actually would be of interest to investors. So how meaningful do you think that distinction actually is? Thank you.
That's a great question. And it is indeed a question I ask myself pretty often, because I do see that when we engage, that particularly in the first year, there was a very strong emphasis. We heard that all the time on materiality here, materiality there, and I have to admit, in my former role, I have to be careful, I'm speaking now in my former role, as a preparer and doing the reporting for a very, very large company, I never faced it that much. I felt like it's not easy, and still you can navigate through it. You can find ways to navigate through it. And also you have to see that the materiality definition is facing a certain dynamics as well. So this is not a set-in-stone definition which topics for a specific company are material. This can change with time. And I think we have also seen that in the last 10 years, how this has changed. So I think it's an important concept. I think it's doable. I think that's also what we see now when I listen at conferences to the first case studies that are out there. I think it's doable. And I don't see it as a war, because you had the war in there.
Questions? Hi, thank you. I have a question like the elephant in the room again. And it's, does it make really sense to come up with a second standards if the overlap is 99%, and then you need to do the materials, how to interconnect them, etc., etc. So why don't you just say, okay, let's use the ESRS also for the rest of the world?
I think two parts of an answer to this. One is we have a different mandate. Our mandate is to have this decision useful information for investors, whereas the EU has a different political mandate. And by the way, that's right. It's two different mandates. Yeah? So that's why it makes sense to have then also two different standards. And then, of course, certainly the second point is, as we develop a worldwide standard, we of course have to look into all the other countries as well and see how we can get this developed in the best way. We have, for example, a so-called jurisdictional working group where the key countries are participating. Europe is part in there as well. So where we also search then kind of the exchange to see what works best. We are late.
We are late. Okay. Well, thank you so much. Thank you so much, Jenny, for the brilliant presentation as well. Quick question from me now. The photo you took, did you have to go and pick those letters, or it was just a sign, a coincidence, and then you realized you need to build a standard based on the sign? It's both. Good. It's 3 quick points. You mentioned something really interesting, which I think especially people working with the sustainable finance policy, such as myself and my colleagues, appreciate. 33 pages. That's exactly what document should be. And I think that's one of the discussions we had in terms of practicality, how some of these very complicated documents and complicated regulations and methodologies can be simplified and can be more practical. So that's great to hear. Second point, what is really interesting and to see and to hear as well, I have already mentioned that before, and maybe I should have prepared that slide, but one thing is certain, we are definitely going from multiple standards to very few. And I will probably share that slide with you in the resources, but 5 years ago, 7 years ago, it was tens, dozens of standards. So we are already simplifying everything, and it's definitely the right direction to go. And maybe one more message here on ESG, on reporting, sustainability, reporting standards, because I'm conscious we are now moving to real estate. We have recently, with Irji as well, who has asked a question today, we had recently done a workshop for the World Bank and for IFC, I may have mentioned that, which was for 2 days, and we looked into transitioning from so-called ESG 0.01 to 0.02, meaning is the integration of double materiality, going from only reporting with backward-looking approach, where it's more about the policies and the historical data, actually transitioning to more impact-driven or transition-driven or contribution-driven methodologies. So that's also one of the main steps here. Not only that we are trying to simplify and make it more practicable to when it comes to sustainability reporting, so it's more comparable, so it's actually more practical to use for more informed decisions. But also we now see that all the standards and everything that is now being in use is actually focusing also on contribution to that transition. These are really, really important steps, which maybe just to remind you, basically happened in the last 4 or 5 years, maybe even less. So I think we definitely are on the right track. And now I will somehow link this to real estate. But we now are moving to real estate section. Now, I have never worked in real estate. Obviously, there's certain connection when it comes to sustainability reporting and ESG, which is an incredibly important part of the buildings and the building sector. We will discuss that in detail. But I do really like talking to people from real estate. And many of them we actually meet in terms of our network as well, because these are very much practitioners from the real economy, right? We have buildings not only in terms of the extraction of natural resources, but also the materials and also building, creation and manufacturing of cement, all the way to actually building everything around us, places where we meet, where we work, and which are very closely linked to our well-being as well, right? And it's really interesting how much hands-on sustainability is in real estate. My only experience with real estate and sustainability currently is that my wife and I, we recently bought a flat, which is a mezzanine flat, meaning that if there's a nice sunny day, we have 60 degrees in the flat, so it's a very hands-on experience of climate change and global warming. But that will not be part of the discussion, as I assume. So I'm going to pass the floor to Raul Garcia Rodriguez, partner at EY, who will chair this session on real estate. And I will also let you introduce your speakers and panelists.
I think you should keep on doing that.
No.
You're doing it very well. You know them better than me.
All the last energy I have, I'm trying to use now. But anyway, floor is yours. So we are now moving officially into real estate section.
Let's please welcome Peter Sweetman, Anna Dufnovska, Stefan de Goit, and Petra Heine. I think we're all here in the room. Please. You don't have a mic? Let's get a mic for Anna, please. Meanwhile, I'll warm up a little bit on the topic. Well, thank you very much, everybody. Just to frame something that was published today by The Economist. I used to work for The Economist, by the way. Today, I work for EY. I work in sustainability services, and I focus on real estate and the built environment. What I read today from my former colleagues at The Economist, a little bit later perhaps, 90% of the population will be living in cities, which means that 2 billion people will have to be accommodated in those cities. This is 2 billion new people coming into the cities, which means that we have to build 12 Londons every year until 2026. Sorry, in the next 26 years. That's just to frame how important this is. Now, let's see if we can find out how to do this better, or at least do it in a way that it's financially viable. And we're going to hear, and this is what we're going to try to do, practice. We're going to hear the things that are happening. Because we have already come to the conclusion that the compliance is here. We understand what we have to report on, or we think we understand what we have to report on. But we know that we have to do the reporting. But there is one step after, which is what are we really doing? Once we know where we are, we measure, and we have a plan to go forward, how are we going to do this? And I think we are all doing it at different space and at different pace and at different speed. And we have here practitioners that come from real estate, that work with real estate, and they will tell us a little bit about everything that they have done so far. So let's start with Peter. I'm going to sit down. And I'm going to introduce one by one, and then I'm going to leave you a little bit of room so that you can also talk about what you're doing. I'm starting with Peter here. Peter is a good friend of the summit and has been here with us a few times. It's a very inspirational figure in sustainability and real estate. I'm going to read because it's very difficult to follow everything that you have done. Peter has been working in finance for 33 years now, 20 years already in sustainable finance. So it's a very good track record. One very interesting thing that you just told me about the charity digital, which serves more than 20,000 UK social enterprises, providing 280 million pounds worth of hardware and software services. This is incredible what you've done in there. Congratulations. I think it's very inspirational. You've been managing climate change capital, and now, today, you are working with climate strategy, which I would like you to introduce a little bit. And we are going to give you room to explain the latest report that you have created on how to finance retrofit, how to finance the transformation of real estate. So I think we can start with those slides if they're ready.
Yes. Well, thanks, Raoul. Thank you, Linda. Thank you to the team at IFSC, and thank you so much for sort of having the patience to listen to me for the third time in 3 years. I count the number of sort of conferences I give, and this is number 475 on climate and sustainability. So every time I speak, my goal is to hopefully make you sit up and think, gosh, wow, I better remember that guy's name because I learned something today that I didn't know previously. So today, it's true, all of the stuff that I'm about to show you is written down in a long report, but this picture is something which, when talking about real estate, shows the European residential buildings in a light that probably I would guess most of you haven't seen. So the preamble to this is that in terms of wealth, globally, half of all of the wealth is in real estate and buildings. So that means that real estate and buildings is bigger than the equity markets put together. That's all the stock exchanges in the world and all the debt put together. We're talking about, in terms of financial consequences, the most valuable thing there is. So in Europe, what does that mean in terms of actual numbers? Well, it's hard to come up with the total number, but lots of organizations have tried. And currently, just residential, so that's just places where people live, in Europe is worth 20 trillion euros. Now, when you think about that stored value, and we're going to come on to what you need to renovate those buildings, but the first question people say is, okay, fine, but don't people borrow against that? And the answer is, of course they do. Both people and companies borrow against their real estate. There's 7 trillion of mortgage debt in Europe, so that as a proportion is sort of 35%, give or take. So we're talking about a large chunk of value that is in home equity. Then people ask me, well, I understand that, but a lot of people rent, don't they? And so if you're going to renovate a building to save energy, is there a split incentive there? So the answer, of course, is yes. But 71% of people in Europe live in a home that they own. So when we think about what's usually the case is that person's living in a home that they own. Then people say, well, doesn't the state, isn't there social housing? Doesn't the public sort of real estate portfolio count for a lot in Europe? The answer is yes. There are 200 million homes in Europe, and 25 million of those are owned by the public authorities and the governments. So it's a significant proportion, but it's not the main proportion. And then people often say, well, hold on, I've heard that institutional investors are buying up homes, and that's an issue because it's causing shorter supply and so on and so forth. So that may well be in certain places, cities like London, maybe a possible phenomenon. But the reality is they only own 3 trillion, so the whole sum of all of the real estate investments of institutional investors is 3 trillion in Europe, and the vast majority of that is in commercial real estate. So it's not, I think, a major factor. So having kind of got that out of the way, what I've spent most of my time thinking about is who do you need and how do you need to get money to people to renovate their homes? So Julian just said, and I'm sure a number of you have thought about, whether or not the thing that you live in is fit for purpose and whether or not your energy bills could be reduced if you did something. So changing the windows, buying a heat pump, sort of like installing LEDs, solar photovoltaic panels, insulation, you name it. There's plenty of things that you could do. And I guess most of you don't have things that you still use that are over 50 years old, and a lot of European buildings are very old or considerably old. And why is 50 years important? Well, 50 years ago, there were no real construction standards at all, which meant that any building that's been standing for longer than 50 years has had no requirement for insulation to be put in. Building technology has improved really dramatically. You don't see it as easily as you see it in your iPhone, let's say, but there's no reason, so lots of technical studies have been done that show that the building stock, which uses 40% of all the energy that is needed in Europe, that energy footprint could be reduced by over 2/3 cost effectively and with the current technologies that are available. So when we talk about buildings renovation, it's really a very significant portion of the climate and energy objectives for Europe. The innovative thing that we did in this recent study was looking at how much money was needed and to whom did that money need to go. So we were talking to banks and we were talking to governments and experts. We came up with 4 categories. So on the far left-hand side of this chart, you have essentially people who are considered energy poor, people who can't afford to pay their energy bills. So without thinking about distributional effects, but these are people, no amount of energy you can theoretically save to their property are they going to be able to pay back. So this, to us, felt very much like a social investment that was necessary for all the other outcomes, such as security, such as health outcomes. And when looked at through the microscope, even if you give away those renovations that a number of countries are actually doing, it makes sense in the long term for the economies because of the recovery, both through the taxation of the work, but also through the health outcomes, notably, among others, of the people living in those environments. So over time, I think that energy poor will have to be addressed through a social lens. And then on the far right-hand side, you have wealthy households where, and the pink is private money and the gray is public money, this chart, where, of course, if you're a wealthy household, you shouldn't be receiving a state support. But the 2 interesting bars to me are in the middle, and those are homes with poor economics. So homes with poor economics really fall into 2 categories. They are probably pensioners, retired people on a pension that's not keeping pace with inflation, but they live in a home that they own with substantially no debt or close to no debt. So they've paid down their mortgage, basically, but they can't get another mortgage. And why do I use the term mortgage? Mortgage is because mortgages is the most efficient. It's a highly efficient, low margin, high volume instrument, really standardized and a great one for borrowing against your home. Trouble is, if you're retired and you're too old, you won't qualify for a mortgage, which means that you have to use quite expensive financing to really tap into the home equity that you've spent your life saving. So who would want to do that? And frankly, when you look at the economics of the returns of a deep renovation, for example, you need to look at over the long term. They don't come back in 7 years. So the economics just don't make sense often. But they do make sense if you can provide low-cost or ultra-low-cost borrowing for 30 years, which can be repaid either on sale or transfer of the property or on sale of the property if the owner is deceased and the inheritors are inheriting it. So there is a form of finance that is not very well used, but I think in the future may well be much better used, which is a form of second collateral in the home, which can be designated towards the people who can't access mortgages, or the people who are we call the working poor. So that's 2 families, double income, no savings, and no capacity to extend additional debt because their loan-to-value ratio of their existing mortgage is high. So that's another example. And under that case, a long-term renovation loan can be paid off because those are the kinds of families that everybody, all of the continent, should be betting on because they are the future of work, and they will, of course, progress through the job supply chains and so on. Anyway, so standard households need technical assistance. So essentially, the other big issue we have is who do you get as a project manager to figure out the works that are needed to help you deliver the execution of that project? Some countries, Germany, have a state system managed by the state bank, KfW, and the energy agency, Dana in this case, which provides you access to 11,000 accredited project managers who co-sign the loan that you take with your bank to ensure the technical works are done right. Many other countries, this one included, do not have access to such a system like that, and that's something that I think over time is definitely beneficial. Banks have a key role, and I recognize I'm going to finish sort of soon. But so thanks to Eva's study, we heard yesterday, the top 15% study, we know that in Czechia, 54% of, so this chart which has a lot of red on it basically shows how inefficient, what high or sort of like E, F, and G label energy performance certificates, and those are countries, so listed. So most of the European real estate is in desperate need of renovation. And if you're a bank and you have a mortgage portfolio or a customer portfolio of loans, your distribution may look like something like the chart on the right-hand side, where today you have a median, hopefully a D, maybe even lower than D, and you need to move to transition your mortgage portfolio. You actually need to upgrade the collateral against which the mortgages are held. So there's something in the Recast Energy Performance Directive, which is now law, called mortgage portfolio standards, which member states are using to bring banks to the table, to get them together and to say, okay, the whole country needs to renovate its building stock. You, banks, have these relationships with your customers. I know the banks here, because I've spoken to a lot of you since arriving on Monday morning. I've been having meetings with banks, and they've got building societies, and they've got tools to help customer journeys, and actually there's a lot moving here in the Czech Republic, which I was quite impressed by. But that's something which I think shows, and this also shows that among the top 30 banks, 40% of them already, and this is already an old statistic, have a mortgage portfolio standard. So they're really thinking about what they need to do to help their customers save energy. And then finally, and this is really my last slide, and there we go. I will be working, so we invited the Czech Minister Hadlik, from the Environment Minister, to speak at a conference where we launched this report, not this one, but the previous report, which I was taking information from. And I think, it's fantastic to see the program, I think it's called Renovate My Grandmother's House here, which is an amazing system whereby public and private money can come together to support renovations. And I think that could be a fascinating example that when EU funds are added through something like an EU renovation loan, we can really extend the program that here can begin to develop a market, but then we'll need EU support to really extend to the full amount of homes that are necessary. So I'll stop there. If you want further information, you can shine your smartphone at that QR code, and it'll take you to the report. That'll give you lots of bedtime reading for later. And thank you, Raoul, and panel members for giving me the time to speak.
That's a pleasure to hear, and I think it's really interesting, and I know this works. It's something I think everybody needs to understand. But I will jump over. Let's follow the order that we have seated. So Petra Heine is ESG director, is the manager, is the leader of ESG for CPIPG, one of the largest real estate investors and owners, I would say, in Europe, probably. Please tell us about yourself a little bit. Tell us about CPI, but please tell us about the latest success story that you have with the green bonds. I think it's very important for the people to understand what has been the process. How do you envision the future of that capital coming towards you?
Perfect. Thank you very much, Raul. Thank you for inviting me, and also thank you for the organizers for having real estate as a focus for today. That's fantastic, and I will try to introduce CPI Property Group a little bit. We are a real estate owner, as Raul said. We have more than 700 properties, very diversified portfolio, offices, retail, residential, hotels, but at the same time farms, known for organic farming and organic agriculture, which could be also something pretty new. And we are also in many countries. So what was mentioned today, when we have different standards and then we are trying to implement it from the local perspective, This is something where we slightly struggle because we are mostly in Central and Eastern European countries. We cover 14 countries. And it's kind of messy sometimes to put all the standards together, all the requirements together. At the same time, we try to report on the consolidated basis. So you can imagine how difficult it is actually to come up with one consolidated report for the whole portfolio. So just a little bit about our role together with my great team, with the sustainability team. We focus mainly on setting the ESG strategy and goals, but at the same time on delivering on these goals as well, which is important to say. Then we focus on the reporting. As I said, it's a challenge for us, and each year we set to ourselves that now we are perfectly prepared for the next reporting round, and again there is new requirements, new disclosures, new guidelines, and we are really starting again to change the reporting and trying to amend it to be able to disclose as much as possible information which are needed. Besides that, I also support and my team and I support the finance guys in our organization. We have very proactive former CFO, currently CEO, who is really a pioneer in green bond structures, sustainability-linked bonds, sustainability-linked loans as well. So I guess we started in year 2019 when we issued our first green bond with our green bond framework and second-party opinion. And since then, we had now 5 green bonds. And what I wanted to share with you, what was pointed out by Raul, is that just recently, 3 weeks ago, we issued our last green bond of 500 million euros. We used our sustainability finance framework for that. I would like to stress out here that, we started having our sustainable finance framework in year 2022, and where we combine both green bond framework as well as sustainability-linked bond framework in one document, which was very helpful during the issuance because you are really flexible. Then you can see what the appetite is among the investors, and you are ready for both options, and then you can really decide. So I guess this was really clever. And also having the second party opinion for that was very useful because then you can start issuing the green bonds when you see the market is ready for that. And I must say that with this issuance, we experience a very high demand among the investors. The bond was oversubscribed 6 times. I guess it's an amazing achievement. It has not ever happened before. So we were really happy for that, and we could see that the investors, they do have the appetite to finance the green bonds. And as we had the roundtable discussion before the lunch, I must share with you that not all the net proceeds and the allocation is towards EU taxonomy aligned properties. Maybe it's supporting for you as well on your journey for more green financing that, in some cases, like if you have in the framework, for example, buildings which are certified LEED or BREEAM, they might not be taxonomy aligned because they do not belong among those top 15%, as was presented very nicely by Eva yesterday. So you could see ABs, in some cases even C, Energy Performance Class Certificate. But still, these could be buildings which are still eligible, and we could allocate the net proceeds. So this is something what I wanted to share with you, and giving you some example. For us, it was really brand new. We really learned by doing the stuff in our companies. To be honest with you, it's very exciting. It's also exciting to see the connection between the financial and non-financial parts within the organization. And I can't agree more. Balance for the decarbonizations as well as the real work, like really delivering on the target set and being able to actually improve the energy performance as well as other sustainability
topics such as social aspects as well as governance.
Thank you, Petra. It's very interesting. I think you gave a tip, and I don't know if everybody saw it, but I think it's a very dangerous tip in a way, thinking that moving away from the EU taxonomy alignment, that's also allow you to issue green bonds. I think it's the right approach because it's already the appetite. We have to watch that the companies may want to do something that they call green, and it's not so green, but this, I know there's professionals like you who know very well what a project finance looks like and how to manage a project so that the project will be more efficient. And we know that transforming efficiency into sustainability is a question of a taxonomy. So on that sense, using all the certifications, using all the tools that we have that might be looked at as commercial tools, we have the security that we have started already with this appetite. And this is something that then consultants and engineers and people around the topics should be able to translate, to transform from one side to the other. But you cannot do without. It's not a question of creating a narrative that is empty. It's a question of creating a narrative that might have a different definition, but the topic itself is the same thing. The KPI has to be the same thing. And with this, I'll jump still to our good friend Stefan de Goij, partner and Cushman & Wakefield ESG leader for Central Europe.
And Germany.
Yeah. And Germany, that's novelty. Good luck with that. And also, very important, and we will talk about this, RICS. But we've already heard 2 points of view, and you have a very wide point of view that I would like you to share with the room. What's the work that a real estate advisor or advisory company that might not be so strong or looked at so strong in the topics of finance or sustainability or sustainable finance, how can you help your clients? What can you do?
Yeah, thank you for the question and the invitation. To answer that, so we're working with a team of 60 experts within Europe and 15 approximately in Central Eastern Europe. I think our strength within this is a 360 view. So we are the second largest real estate consultancy firm in the world. And with the experience from capital markets, from valuation, design and build, into asset services, we see for the last couple of years that there's a strong growth into the sustainability question there. So what Petra already said, and probably what Invesco also has to acknowledge, is that we see from investors, from landlords, from funds specifically, all kinds of needs are starting to approach, whether it's reporting, whether it's marketing as well. I come from a developer's background, commercial, strong developer, where that is quite a tool. I mean, we need to make money, and you need to show also that you are good at that. So these services started to be born. At the moment, it's very strongly in this region. Czech Republic, Slovakia, 4 corporate offices here, is decarbonization pathways. This is where basically the investors, the funds are seeking what they need to invest in their asset or portfolios to decarbonize, or at least to get that at a certain level. Now, I've been talking to this for probably 5-6 years already, because you see it coming, what Petra already mentioned. We have a 40% carbon footprint. We know the EPBD recast is for the next 20 months up to discussion in our governments. The outcome will be very strongly pushing us towards direction. And with all that, the understanding starts to come now. So after a couple of years of education, about talking, about making awareness, we see now actually that the contracts are coming out to, I think there's an echo somewhere, I hear myself, that the mandates are coming out to start working on that, and the investors really start to know and see what is necessary. On the buy side, sell side, the buyers are looking for discounts, the sellers are looking for protection. In valuation, a very different topic maybe for later, but also in design and build, what is the embodied carbon that is coming in? So these are calculations, and based on that, they become decision tools. And there are companies and funds that are looking now, okay, give me the maximum I need to do, like literally to go to net zero no matter what the cost, and give me the minimum bear. So then we look indeed EU taxonomy alignment, we're looking at EPBD, we're looking at other things, but for us important is the economical value of the building, because I think most of you understand, you live somewhere, if you start to invest in decarbonization, we have clients that want to have a degasification of a building. This comes from occupiers, I will say something about that a little bit later, is that with all these investments that need to be made, they also need to make sense. And this is something that is very delicate, I think. If you go from gas heating to a heat pump or electrical boiler, you're not going to change building technology that's 7 years old. That doesn't make any sense economically. But what if your tenant that wants to sign for another 10, 15 years up in your vault and your value says, no, but you need to go without gas. So these kind of calculations we're going into, and that's what I wanted to mention, is that we strongly see at Cushman & Wakefield is becoming an occupier-driven market. This is where the occupier is starting to push landlords into investing in their buildings, and we're talking at the moment at the large occupiers, like the Amazons, the MasterCards, whatever, pushing because they have their own pathways of decarbonization in 2030, some of them already, it's 2025 almost, 2040, and they need to see their leased assets in scope 2, we need to decarbonize, and we need to report on that. Their supply chains need to report on that. So all of a sudden we see now there's a strong stream coming up in decarbonization pathways. And on that, obviously funds need to report. There's Article 8, there's Article 9, the other sense of let's say, compliance. And the last thing is certainly on the financing side of it, where banks more and more start to ask for more detailed information. They want to see a climate risk assessment. They need to understand, is this retention area big enough that you have here, given the heavy torrential rains that are coming all of a sudden? What is that in 10, 15 years in Prague? How does that look? And is this retention strong enough? Because I'm scared. With all this climate change, we see things changing. What does it do to your energy cost for heating if this, temperature stays rising? Whether in Europe the temperature go a little bit lower, I read in reports, whatever, but these are significant changes. Yeah.
That's interesting. I have some news for you, actually, because we have, I have been working 15 years as a developer of real estate, and I have a rather technical approach to sustainability, which is very in line with what you're saying. The good news for the market, and maybe not so good news for you, is that EY recently acquired Denkstad. And we have now almost 100 engineers working with us actually doing this. I mean, we're good friends, and we know that we have to share, and you have your clients and you have your scope on your clients. But what I'm saying with this is that we are seeing that the transformation is here. And this is what I want to resonate from your message. It's not any longer just reporting. Do something with what you get. And this is where we have to come in. This is where the real decarbonization has to happen, implementation of the measures has to happen, and we have to have people, and there is not enough people to do this for the companies, because there are very large portfolios, and any of those assets needs a lot of attention.
Yes. Well, we saw the numbers from Peter there as well. And
Correct.
About residential, is the investments that need to be made they're humongous.
Correct.
And we have this much time for that. So where is the capacity?
Yeah, and you have one reach that it's on the retail side, on the very detailed department where the people comes to buy, and it will be good to understand. Later on, we will do. I really want to go into Anna and talk to her, but I think it will be good also to touch different kinds of real estate and different kinds of investors, from the very personal investor to the institutional investor. Now, talking about big investors, we have with us Anna Dufanowska, who has just come from Poland, and I would really please introduce yourself.
Good afternoon. I'm working for Invesco Real Estate. I'm covering Central Europe. This is the investment management platform, active globally, and we work with institutional investors. We raise money from different type of institutions, and we invest on their behalf into the real estate. Only real estate, not infrastructure. In Europe, we have roughly 15 billion euro under management, 200 plus properties, very different properties, from industrial, office, retail, student housing, residential, you name it. And we also run very different strategies, from very core separate account investors throughout the value add and opportunistic investors. And obviously, what was said here, I was listening carefully because exactly this is all what we are trying to adopt as well as institutional investors. First of all, these are the requirements coming from our prospective investors. So today, any pension fund, any institutional players who like to give money to somebody like us, the investment manager, would start, what is your ESG strategy? And everybody would say, yeah, we have it, that's great. No, they will say, show me real case studies, what you do on the ground. So what we have at Invesco, we have like a top-down and bottom-up approach. Top-down approach means that we have 5 years ago already implemented an overall strategy, European strategy, what we want to achieve as a business. So we have clear goals and objectives on the decarbonization, energy, and CO2 emission savings, water and waste management. So we focus mainly on the environmental aspects. Obviously, governance goes without saying, that has to be done because we're like operating in a very regulated environment. And the bottom-up approach is basically, we have those 200 more assets that our teams are running across different, like 14 countries. And what we've done, we've pretty much completed the net zero audits for all our assets. So we know exactly where to invest. Maybe not exactly, let's be honest, but pretty much we know how much CapEx we need to invest in certain assets, and we know exactly which assets are trending and which ones will never get there. Because there are, let's be honest, 75% of the existing real estate today is unfortunately not compliant with the taxonomy. And 70 or even more built real estate, 70% of the real estate that exists today will be there in 20 years' time. So it's nice to talk about, new, say, industrial or office development, which is super compliant with the best-in-class materials. But the reality is that there are a lot of old, very often listed buildings with certain limitations where you are not able to implement the solutions. But like, I'm a practitioner, and we've been like implementing different solutions, different CapEx program in most of our properties across Europe. And I have to say that from what we see is that by investing very little, if you start just thinking proactively how to optimize your energy intensity and carbon emission, you can easily get 20–30% saving on your energy. Just by optimizing small things without investing in a large CapEx. And then obviously there is a wall. There is a wall, meaning a lot of CapEx, and you have to do that, you have to touch the facade, you have to change this heating system. And then there is an economical discussion. The challenge I see in today's market is that, unfortunately, valuations or valuers do not yet fully reflect the implication of the potential CapEx investments and having a better building in the future and pricing it fairly. Yes, so let's say you have a building which is worth 50 million euro and you need to spend 10%, it's not like a big number, 10% into the renovation. As an investor, you would like to see probably 55 million at the end of the process, at least 55, if not. The valuations not necessarily reflect that because they are looking at the past deals, at the transactions next door. So it's very difficult to have a very clear, objective assessments how to value those things. So I think there is a big requirement to change the regulations, and I know that the valuers associations are working to have the common standards how to reflect the ESG investments into the real estate. I mean, one can argue that you're bringing better liquidity to your building, potentially your tenant will extend the lease. Yes, this is all fine, but these are like soft, intangible aspects, and the investors are looking here and now, every quarter, valuations, they are assessing against the benchmark, and that's the challenge. I'm not saying that we should stop. I think, the awareness, if I look like 3–4 years ago, there is a massive improvement, especially in our region. I think a lot has been done. And the quality of data, to start with, is much better. So we know exactly like how much our assets do consume, how much they produce the CO2, how much energy they consume. We have very good benchmarks, but we are still far away, we as the industry, from the net zero targets. Because if like the best residential development today, energy intensity of the best residential development with top quality material is somewhere between, sorry, I should stop, yes?
No. We're looking into the questions, because questions are coming, and please feel free.
Okay. All right.
I have a question coming from you.
Okay.
Somebody else.
No, I just wanted to say very simple, like 60 kilowatt per square meter per year. That's the top-notch development. The targets for the real estate are below 50 kilowatts per meter per year. If you look at the hotels or shopping centers, they consume 200 kilowatt per meter per year. So we're talking about like a huge distance to decarbonize. I'm not sure even with today's technology whether we are able to decarbonize the real estate, but you know, we have to continue the effort, and it's good that there is also the whole banking and finance industry are getting more concerned and also aware of what needs to be done, and I hope that there will be sufficient financing, cheap financing, to deal with all those decarbonizations, because I think we'll be having a wall of the funding requirements, because investors themselves, they will not be able to fund everything and wait for the 30-year payback period simply.
So I have a question for you and for Peter on this, because you've mentioned it, and we were talking about this before with Peter, about the need to have the stick of the law behind us to tell us what to do. And we've talked about the Energy Performance Directive for buildings. Peter, you've studied this quite well, obviously, in your framework, in your work. Do you think this is a way to go? Do you think the stick should be harder than the carrot?
No, but so look, let me break down the question. I think you raised the most important point of valuation. I think when anybody talks about the need to attract investment capital, investments have to have returns. So the money you put in needs to come back in some way. So with respect to the EPBD, the Energy Performance of Buildings Directive recast that's just become law, what it does is it suggests that in all the different categories of real estate, there's a minimum energy performance standard that needs to be achieved. Now that's different from what you said. A minimum energy performance standard is the absolute minimum that a class of property needs to be at by a particular date. That doesn't mean to say it needs to be class A, it just needs to be above the minimum. The purpose of that, and that is law, meaning that the stick is that you will not be able to rent your property if it doesn't meet the minimum standard by a date towards the end of this decade. So that is the stick, and what is the carrot? So the carrot is, and I've worked with Tigova, which is the European Association of Real Estate Valuers, where I have a podcast on this entire topic, but about how do valuers see energy performance of buildings. So it seemed to me to be bizarre that if there were two properties, one of which had half the energy costs of the other, and of course it's not just about the energy costs, but any of you who have been inside an energy efficient property will know, it just feels more comfortable. There's something weird about it. I've visited offices that are hugely energy efficient, and they have great air circulation, and everybody's kind of got a buzz. It's just a weird thing. You have to experience it to kind of know it. But there's something about energy efficient modern properties where there are lots of other intangible benefits. So aside from that, and aside from the energy savings, I was throwing my hands in the air with the valuers saying, how come you can't see that? And they were like, well, it's not written in our guidebook. So I was like, okay, if it's not written in your guidebook, let's just write it in the guidebook. So we started a rather involved process thinking about the blue book and what are the instructions to valuers, because valuers are a little bit like accountants, see what they're supposed to see. according to the rules that are established for them to see that. And so I think it's a touch of a catch-22, which is kind of what you're saying, which is the market needs to reflect the change in value between energy-efficient properties and non-energy efficiency properties, which it does. There's a Joint Research Center report, which is one of the better ones that I've read on this subject, looks at 2 decades of data on this, and give or take, the answer is about 8%. So the sort of green premium, the difference between high energy performing buildings and low, is roughly 8%, depending on where you are. And there's also a reflection in the amounts of rent that you can achieve as a commercial related to energy performance. So the data seems to be there. I think the valuers are slowly figuring out mechanisms to be able to see that. And the more renovation transactions happen and the more the market is accustomed to pricing based on energy performance certificates, for example, or other proxies or standards, the more that we're going to see that actually the answer to your question is people will end up doing what's economically rational and sensible for them. Governments will put in money for some people, it won't be for others, but the energy savings together with the green value, together with the benefit and comfort and market access and all that other stuff, will be economically persuasive to allow people to not have to worry about the stick, per se.
Mm-hmm. So if we transfer this to a build-to-rent portfolio, like CPI has, is there a way that you have seen already this implementing into the price, into the rents, is there a green premium that you think you can apply? What is the conversation with the clients?
Mm-hmm. I guess it's definitely a topic, we see that it's on the market. Our current situation that we offer the green leases to our tenants, so far it's just being offered for all new tenants or all renewals. It's not mandatory for them to sign that. And we see that with some tenants, it's pretty easy. They are even sometimes proactive coming to us and asking for some kind of green lease. But with some of them, mainly the local small retail clients, it's more difficult, it's still not a topic. So we cannot say that it's like a 100%, but it's definitely the direction where we are heading right now. And we know that without our clients, without our customers, we will never be able to meet our environmental targets, because they are the majority of our Scope 3 emissions, which encompasses 78%. Of our greenhouse gases. So we know it's definitely the right direction to go.
Mm-hmm. Stefan, you also work with the clients sometimes, the people who are looking for real estate to buy or rent. What is your take on this? I think the question is as good for you.
Yeah, correct. We've been discussing this obviously for a while. I think when it comes to valuation, we're a bit in a difficult situation because the last 2 years we're not building exactly on a lot of knowledge in this case. Through RICS, there has been a publication in February this year where 12 indicators were announced, or let's say given to the valuers, which were based on input from consultants like ourselves, CBs, Colliers was there as well, and with INREF. So we came to a certain position. This is not a mandate. These are pure guidelines. This is to understand for valuers to, okay, what can we look at? And slowly this is coming. So together with the Sustainable Finance Center as well, we're looking at bonds. We have a few developers that already said, okay, we're going to pilot this, and slowly this needs to come. It's market. It's us doing it ourselves, because I don't see this coming from any regulation or other type. This is the market that's going to create this themselves. Yeah.
Anna, we have a question for you. Do you want me to read the question? The question for Anna is, so what do you do with those assets you declare as stranded, I guess it is? Do you use taxonomy, or are you considering embedded carbon?
Yes, so good question. So obviously we run the CREM analysis for all our acquisitions and for our existing portfolio. And yes, that's true. We have several stranding assets, day one. It very much depends on the local grid. So let's be honest, for example, if you look at Poland or even Germany, the grid is not the greatest. The same asset located in Portugal or in France would be strengthening in 2050 rather than 2030. And yes, we consider, or we already sold certain assets which potentially a local developer could do it better than us, and would have ambitions to bring it to the best in class. We are institutional investors, so also we take kind of limited risks for let's say for our returns. We do have, though, a lot of assets which are going to strengthen within the next 10 years, and there are plans to decarbonize them, maybe not fully, but like invest significantly. But it depends on many aspects. For example, when can you have a vacant possession? If you have a tenant now, you cannot do certain things. Or, the technological solution. There is a lot going on in terms of current solutions available on the market. 5 years ago, the photovoltaics on the roof were totally different than the ones which are installed today. So again, in 5 or 10 years' time, we'll have different solutions to use, and perhaps with those, we would be able to decarbonize even faster. So we're watching, also monitoring the market of the new startups, of the new newcomers to the market in this area, because there is a great opportunity to use those innovations. Yes, but each asset has a program to kind of reduce the consumption. On the embodied carbon, we only take it into account if we are developing ourselves. Because if we bought an existing product, I understand that the developer who sold it should have reported the embodied carbon, otherwise it would be a double counting. So again, this area is quite vague to me. Who is reporting what on the carbon emission? There are no clear barriers from which point you take over the reporting requirements.
That's where you have to come to me, and I'll do it for you.
Yeah.
No, but it's true that in the end, one thing that needs to be always aligned on the reporting. First of all, we're doing a large exercise of CSRD readiness for the companies, and this goes on the corporates, no matter what the line of service they are in. A corporation is a corporation and needs to do it if they meet the thresholds. Then we need to get down, and we are getting down to the very asset, to the very square meter of the assets, and this is where we become technical. The problem between the embodied carbon footprint and the operational carbon footprint and the accounting on water, on pollution, everything, things that we need to have somebody who can do this translation. This is where the added value of services like Stefan's or of mine come in, or what CBI has done already. The issue is the credibility on the timing and how often can we access the data. In the end, having a good set of data and having the people already with the education to use the data well, to integrate it well, to report on it well, it's, I guess, the path towards the goal that we have. Because in the end, as somebody said this morning, I think Gary said it from EPH, we're here to do something, which is to become net zero. Are we going to do it when we want it? I don't know. But if we are not thinking about that, and we're only thinking about reporting, or we're thinking about looking into the building without changing the building, or looking into the portfolio without changing the portfolio, it's not possible. But without the reporting, it's also not possible. Because like every other change, if you don't measure, you cannot change it. And with this, I have to say that we have already gone over the time, and I have Mr. Todd looking at me like, okay, so that's okay. Thank you very much, everybody. Thank you all, and see you around later on.
Thank you very much, Raul, for the beautiful conclusion. So that it made my job a little bit easier. For the first time ever, I will keep it super short because we are indeed running on time, and which is unfortunate because this is one of the topics which is very close to my heart, because we now will be talking about the interpretation of the EU taxonomy criteria in real estate. Very interesting to many people. I assume, because everyone keeps talking to me about that, and everyone comes to us as well to discuss the topic and the actual real-life implementation of some of the complicated criteria. Well, luckily for you, we do have, again, one of those more technical presentations on, as I said, how do you translate all the complicated criteria in real estate into practice. So we'll have Peter Vogel from EcoWatt. The floor is yours. And
thank you. Thank you, Julian. So I will try to be short, as you said. Okay, ladies and gentlemen, thanks for the invitation. It's an honor to be on such a conference like this one, because it's unique, because it brings financial world together with the designers and builders, and as we see, something is really happening on the market. So my role today is to present the interpretation of the technical screening criteria for the Czech Republic, for the Czech environment. My name is Petr Vogel. I'm a consultant in EcoWatt, where we help developers, property owners to be green. But I'm representing here today the EU taxonomy task group within the Czech Green Building Council. And that's where I want to stop for only one slide to talk about what is the Czech Green Building Council. The Czech Green Building Council is a not-for-profit institution that is thriving towards a market movement towards so-called Vision Zero. So our vision is that the whole built environment will produce zero emissions. And that's why we stand on 3 pillars. The first one is business knowledge. The second one is, we call it ethical lobbying. So it's an open lobbying for a legislative environment in the Czech Republic. It's called Šance pro budovy in Czech. And we do also cooperate with municipalities and universities. And the members are organized in so-called task groups, where they pro bono voluntarily produce what is a question on the market and why they are participating in such task group. And the result today is the common interpretation of the EU taxonomy technical screening criteria. In the Czech GBC, we know that real estate has a real chance, as I said, the chance for buildings. And the chance is that we as builders, designers, property owners, we are responsible for, at least in the Czech Republic, for more than 34% of the carbon emissions. And that is not counting the embodied carbon. Where the construction industry obviously is one of the largest emittent also, because we do consume a lot of concrete, steel, etc., etc. So our responsibility is there, and that's why we are struggling to take the wave of the non-financial reporting of the EU taxonomy regulation, and we do try to make it real. It's not happening. Oh, yes, it is. Yes, but EU taxonomy, I will start with the positive features, what we understand. The positive way is that we do make a pressure on the invested capital where the standard, where the green building standards is actually set. That's very important. That's the first step. And if the investor does not want to be green, we as designers or builders cannot do anything without it. So we do also see a huge movement on the market through the non-financial reporting, that the non-financial criteria are now really discussed at the top management of the companies. We have seen the panel before. But on the other hand, the EU taxonomy is, I would say, something what I would call a halfway cooked product, to be honest with you. And there's still a lot of work to do, and that's why we unified within the task group, because it's really robust. The size is extreme. The size of the evidence is extreme, and it's oftenly an academic approach, what we as technicians receive it, and it's somehow hardly transferable to reality. It's hardly transformable to something practical, what needs to be redesigned on the building. And last but not least, as a designer or as a builder, I need to know what should be the evidence on each technical screening criteria, and that's not covered at all within the EU's taxonomy technical screening criteria, which is also then important for the auditing and verification process. So that's why we came together, and all of this is leading to various gray zones. And those gray zones we were trying to cover. And I can now say that we have made this common interpretation of the EU's taxonomy technical screening criteria. The first ultimate goal is to eliminate various interpretations, i.e., in other words, impact on the design or on the investment. We would like to, on one side, eliminate the one very risky limit in my perception, which is that the EU's taxonomy would be leading to paperwork-only work. And on the other hand, we as builders would like to build in the future also, and so we need to do only economically viable options. So the interpretation should be in the way that it is buildable economically, and that's why we figured out solutions and interpretations that are somewhere in between these two extremes. Then we designed requirements on evidence, which is also important, as I said, for the auditing process. And we also described legal interconnections for the Czech Republic. The study is downloadable at the website. It will be printed out in the presentation. So the common approach is focusing on three main chapters only, because the amount of work is really large. So we have focused on the three main chapters, which is the construction of new buildings, renovation of existing buildings, and acquisition of existing buildings, so that every portfolio manager or developer can use it. And I have to say that the interpretation can be used for large buildings only, and because it's quite complicated, i.e., in other words, costly, I cannot imagine myself doing this interpretation for a residential family house. That's how the criteria are actually written. It needs to be fully redesigned in our perception, and I hope there is going to be some EU taxonomy 2.0 for smaller developments. For instance, as an example, when taking the main criteria for new buildings, which is the energy performance certificate, it seems to be obvious that you have to follow the guideline or the requirement that you get to be at least 10% better than what is required by law. But if you dig in detail, you can say that, at least in the Czech Republic, but I can imagine it's the same way around Europe, there were plenty of such energy performance certificates with different requirements that are fully uncomparable. So we came out with this interpretation: what happens when, based on the building permit of the property, and where to find the number. That's one example. Second example, where the most of the gray areas actually are interpreted, is the climate change adaptation do no significant harm criteria, where we designed it in, I would say, in the most feasible, simplified way, that we have identified priority risks for the Czech buildings that got to be analyzed in detail in each case. And on the other hand, there is also one way larger tab of the risks that you don't have to go through in detail. And we also described why you don't have to go in detail that much, because it is not threatening that much the design or the operation of buildings in the region of the Czech Republic. And last but not least, for each this priority risk, we have designed the methodology, the way of evidence, how it should be used, and also the limits that should be fulfilled, which is, and all of this is actually missing in the technical screening criteria. So we do want to go through common language, that if we go through taxonomy aligned property, it means the same for one company as the other. That's the key goal. And, whoops. Yep. Last but not least, this is also a study that was here presented by Eva, that for the chapter 7.7, we also pointed out that this study is actually now feasible and usable in a very simplified way, that for the main criteria when you acquire a building, what it means to be taxonomy aligned, that you simply go to the energy performance certificate, and if it is A class or B class or C with a significant with a certain number, based on the type of the building, you comply. Very simplified way of the common language. On the other hand, the journey there was quite long, I can say. And so that's the work we went through, and I would like to thank to all of the partners. Those partners were from the groups of developers, mainly sustainability experts, but also banks, and that's why it is so unique. And as far as I know, we're one of the first country, maybe the even first one, that is producing such a common approach. Thank you for your attention, and if there are any questions, or if there is time for questions. Thank you very much.
Unfortunately, we might not have time for the questions, but I think we can continue the discussion or any questions during the break. However, thank you so much for a very insightful and very practical presentation. Quick thing to emphasize and to mention here. We as ISFC, we are actually involved in 2 projects in terms of implementation and building methodologies for application of do no significant harm of the EU taxonomy to the EU funds. Very much going into the practical implementation for project proponents and applicants. And there are so many questions, and as you say, so many gray areas. And me being on the platform, I'm fully conscious of the importance and the, not only importance, but also the place or the position and need for the EU taxonomy in the market, but also it is a very complicated regulation and document for the market to absorb and to practically use, right? So we have these 2 worlds. And I just want to mention, because we as ISFC are also part of the Green Building Council, it is amazing to see some of the initiatives like this, to see how companies, different members, and also from consulting all the way to banks to real estate companies, also individuals involved with real estate-related activities come together, share knowledge, and I know even in your working group, it's amazing to see the collaboration and knowledge-sharing element to absorb some of these regulations faster and actually be able to accelerate the transition. So, for any companies here, for any practitioners and professionals here, I do urge you to speak to Peter. I know Simona is somewhere here. I saw, there she is. If you work in real estate, or even if you are somehow involved in real estate-related activities, which, by the way, it's a really broad aspect, I very much urge you to speak to Simona or Peter and get involved, because it's some amazing work they do. And this is something I also really appreciate as someone who's been working on some of these DNSH projects for over 2 years. This is exactly something that is needed as well to share practical knowledge and see what are the best ways and the most effective ways to use this in practice. So important. Now, we do have a break. Good. So I again very much invite you to get coffee, some refreshments, and maybe go and enjoy the garden, because we do still have really nice weather compared to yesterday. And we'll meet back here. Let's do 3:50, because I know we are overrunning, so we can take a few more minutes. Thank you. Hello, hello. Okay. Good afternoon, everyone. Hopefully you have rested during the break, got some coffee, some food, snacks, and we are now in the last section, not only of today, but also on the CEE Sustainable Finance Summit 2024. Okay, we still have some people coming in. Feel free to do so. There's a couple of seats still here. There's 5 seats in the front, same as in the classroom. Maybe, Christina? Okay, no pressure. Good. So the last session of the summit, the last session of the day, still focusing on real estate. Now, again, as before, going a little bit deeper and actually going a bit more technical and a bit more functional with the presentation, TED-style presentation by Krem and specifically by Hunter Kulwine, who will be talking to us about the best practices for real estate carbon monitoring. Hunter, the floor is yours, please.
Perfect. Thank you. Thanks for joining, everyone. I use this slide just to introduce myself really quick. I'm Hunter Kulwein, working for the Krem team since 3.5 years in real estate already. This is my 11th year. A little bit surprised by that number as well. So let's take a look into what is Krem, what we want to do, and what we want the industry to engage with. First of all, of course, thanks a lot to our partners. That's always important. Our work wouldn't be possible without them, and so that's always very important to honor them. And if you want to get in touch, become a partner as well, feel free to contact us. Just a little introduction. What we see is, and that is really important, and it's rising importance, climate risk is investment risk, and that is what it's all about. And I think that's why we gathered here, because we do see this as more and more important. The assets need to decarbonize over the next decades, and Krem is a tool to know what the risk is, to know what your emissions are, and to know where you need to develop your assets to. Transition risk, or well, climate risk always has 2 dimensions, physical risk and transition risks. In case the global warming keeps continuing, we all do know what that means, but that also means a lot to our real estate assets. Transition risks in this idea is that's what Krem is focusing about or focusing on. And those are the risks assessed, associated with the transition towards a 1.5 world, which should be net zero in terms of real estate, of the real estate industry. I always don't like the phrase net zero, because let's be honest, no one is going to have a carbon sink in their real estate asset. No one is going to do carbon capturing in their assets. So in terms of real estate, net zero world means 0 emissions. To highlight, and this is a very important one, this one shows transition risks in one picture. What did we agree on as a world global society is the one to limiting global warming to 1.5 degree. What current policies, and there are different lines here, but current policies, they lead to a global warming of 2.4, 2.5, various different, well, current regulation leads to a 3.2 degree increase in temperature, and the current NDCs, so that's what the states said they want to achieve in terms of carbon reduction, leads to 2.4 degree. But we agreed on 1.5. So this picture basically shows you what is the difference between current regulation, current ideas where the countries want to get, and what we agreed as a global society on. I've heard you talking a lot about regulation. Krem is not about regulation yet. The problem and the risk is that we have the idea of, as a real estate industry, well, we do whatever the regulator tells us to, and then we will go with the flow. But that one leads exactly to this picture. the real estate industry not being ready to decarbonize as fast as it needs to decarbonize. And that is a huge problem. And let's be honest, if you don't anticipate current regulation, and with CRREM, that's a possibility to anticipate that one, you will always, you will never outperform your benchmarks. You will never be better than other real estate asset managers, other real estate investors. So I suppose you take that one serious and yeah, look at those transition risks with us. This whole situation is the idea why we developed those CRREM pathways in the first place. We used the global budget and downscaled it. Not going to go into details. If you want to look at it, there's like 60, 70 pages documentation of the details, what we did there. But in the end, we came up with different pathways for different asset types and different countries, because every asset, I mean, first lesson in real estate economics is every asset is different, but we triggered, we sized it down on asset types and are now looking at the different asset types here. This, for example, is Germany residential pathway. It starts at around 34 kilograms per square meter. And this one shows you how fast, and that is a very important one. The green line shows you how fast does the average asset of a residential housing in Germany need to decarbonize to meet the 1.5 degree goals. And of course, we have those pathways for all other asset types, well, or a lot of other asset types as well, and a lot of other countries. This is just a little bit more about the details. Gonna skip that in terms of time. There were a lot of different organizations that looked at decarbonizing, and one big thing that we achieved as CRREM was aligning a lot of them. We collaborated with a huge amount of different organizations, aligned some frameworks, some country-specific frameworks, aligned those numbers with ours, and the most important one is aligning the SBTI pathways with our pathways. So the SBTI pathways are basically the same pathways that we developed as a CRREM team. In the end, it looks like this. These are some different pathways. I think this is, it doesn't say, but it's office, I suppose. And we see that, of course, the baseline emissions in each country are different. So Japan, for example, has higher carbon footprint per square meter than Germany, and France, for example, has a little bit lower one. But what we can see is that every pathways tend to go down really steep. And I know it's steep. We all do know that. We missed some opportunities 20, 30 years ago to not have those steep pathways, but yeah, that's where we're at. How to translate it and how to look at your assets. And I think this is our decarbonization pathway for some specific country and asset type. This is the property. And how the property scores, we will see that later, but just keep this one in mind, please. We have the line, the baseline emissions of the asset, and of course those baseline emissions are going to change over the years because the grid is going to decarbonize over the years, and that has a positive effect on our real estate asset as well. Climate change is going to also have an effect. It's not that big of an effect, but there is one in terms of change of cooling degree days and heating degree days. Exactly. So we look at this one doesn't work, okay. So we look at the building's performance, and of course there are different ideas. Retrofitting is one of them, and with a retrofit you can also use our tool to model that one to put the emissions down of the asset. You can have a look at the carbon prices. Of course, it's future carbon prices. No one will know what are they going to be. But with our tool and with our Excel tool, you can have those outputs and use your own assumptions going there. We have the whole building, and that is, of course, I heard some discussions about scope 1, scope 2, scope 3, what are we capable of, what do we need to look at as a real estate industry, but in our perspective, whole building energy and whole building carbon footprint is that is what defines the risk of the asset. So what we do and what we encourage everyone in the industry to do is take all emissions inside the building on board and evaluate them, because all emissions are part of your risk. And of course, what is much needed is data. And I've heard that, and I think that's one of the big problems since I started with the CREM work. No one has the data. It gets better and better, but we're still not there. Everyone in the world talks about data. I think real estate industry is one of the those niches where they still have problems with getting data. Not even talking about real life data, talking about yearly basis data. That, of course, has something to do with who's in charge, who's gonna pay for the bills to the electricity provider, and so on. But we encourage everyone. Data is the most important one, so start with that one, and build your contracts around it. Have a clause in it that says you need to give us the data, and that's very important. Overall, and that's what our tool looks like, we end up with this stranding diagram. And this tells us the green curve, as I said before, the average asset in the specific country, in the specific asset type, needs to develop in this, needs to decarbonize in this, in this pathway. And we end up with a stranding. This one is here in 2032. Stranding in these terms doesn't mean it's a bad asset or the asset is worthless after this. And it's very important to understand that the term stranding is, of course, if the asset is stranded, it's not good, but it always needs to be reflected in the price. So there is going to be an idea of buying or a strategy of buying brown assets, developing them to green assets. If you get the discount and if you have the money afterwards, still make a business case out of it. To buy a stranded asset is not a bad idea. It's actually, from an environmental perspective, can be a great idea to develop that asset to a non-stranding asset. So it's important to always keep that in mind, because stranding doesn't always mean the asset is doesn't have any value anymore, just has less value. What you can also do with our tool, and that is great, you have a whole portfolio overview and can look at it when, some selling, points of selling of those assets. Exactly. If you want to know more about our tool in particular, we do offer every 2 or 3 months in a workshop, and it's free to join for everyone. So just check our LinkedIn and you will be able to join that once, and you get some more insights on those Excel sheets. Everyone is talking about it in the industry, in the real estate industry. I know we're mostly with financial institutions here, but that's a little bit bragging from our side. We get bigger and bigger, and we hope to continue that journey. But what we also see, and that is important, is the more we get into details, the harder it gets for everyone to know what is meant and what we're looking at. So there's, for example, differences between target setting and risk management. And what we see right now is that no one really knows what is risk management, what is target setting, and on the other hand, what is carbon accounting. So we've looked at some particular stuff, and that is what we will talk about a little bit more in the future is, for example, a benchmark of F-gases. You can see here, that's from a paper my dear colleagues Chiara and Julia wrote about the asset performance of a retailer in Germany with and without F-gases. And we do have different pathways for including F-gases and not including F-gases. But of course, some assets tend to have a much higher F-gas footprint than others, some specific asset types. So what we advise is to use the different pathways, not in a concluded way, but to differentiate between the F-gases and the kilograms from a risk management perspective. Another one is looking at location-based versus market-based. I think everyone has heard of it, but if we look at it, and this one right here shows you a really interesting numbers from my point of view. So sold certificates from Norway to Germany, it's at around more than 5,000, almost 6,000 gigawatt hours per year. But the physical energy flow was just at 4,200 gigawatt. That doesn't add up at some point. And that is something regulators going to look at. And they start looking at it already in the H2 sector. And pretty sure they will also start to look at it in the future in the typical energy market. So, of course, like you can choose from GHG protocol idea perspective. You can choose, we looking at location-based or market-based perspective? So, of course, everyone in Norway, they have a great grid over there. Everyone in Norway says, yeah, we're doing location-based. Everyone in Germany says, we're doing market-based. So there are problems out there that will be tackled from regulators, and that is what it's all about in risk management. We do not have to look at what is current regulation, we have to look at what is going to be the regulation. To make it even more, more complicated, we need to look at hourly, on an hourly perspective. Energy storage, change of electricity peaks, like to use the peaks of energy production and put our the energy use on it. That's something we also need to look at, and we need to keep in mind when looking at carbon performance of buildings. Different projections for the future, of course, also are very important for the future development of the asset, for the future benchmarking of the asset. So from a risk management perspective, makes it much more difficult from a target setting perspective. Like having a market-based approach would be considerable. Peter, I think he said we need to look at embodied carbon even more in the presentation before. But we also need to look at embodied carbon of retrofits. So there's a lot we as a real estate industry need to look at. And we know it's a very difficult topic. But we also did a report on that one in the last year. We very proud about that one. We did some research how much embodied carbon is going to be in a retrofit, and what are the operational gains of that retrofit. So we can talk about a carbon payback period. How fast does the retrofit pay off? Because there were also some parts of the industry, mostly from people or from companies that did newly builds. They always said, yeah, with no retrofitting, like building new is always the best option. We found out, before you read all the details, we found out it's not the case, and this is one of those case studies we did. We looked at operational energy savings, operational carbon savings, and found out in this case it was 4.5 years carbon payback period, and we had, of course, also some look at other numbers. So we see it's, in terms of real estate and carbon risk, it's not like a small assessment. Yeah, let's do it. Let's do the small assessment, and then we will know how much kilograms our asset has. It's a journey. And to be on that journey, we also a little bit more to read for you. We did some research on green governance. What are great governance structures? That is the most recent one. We published that one in April. How to implement successful net zero plans into the companies, into the real estate companies. More than 60 frameworks and details, a lot of interviews, a lot of best practice examples, and the results is, that one got long, 150 pages, but really a great guide you should have a look at. And something that also, was developed within that process is the self-assessment tool. So you as a company can use that one and can have a look at where you stand with different categories. Is there a corporate goal? Are there emission reductions, embodied carbon, retrofit quote, share and stakeholder engagement, crisis resilience, and a little bit more. Great project also about to be finished is our more detailed version of the North America pathways. So we have that focus group, and much more resilient pathways, much more granular, and in that case, much more better. And of course, from the industry, also hopefully they will be received very well and used even more. It's not enough to read, so here's even more to read if you need some ideas of accounting and reporting of finance GHG emissions. And I think that one is important, especially important for a lot of those financial institutions. You can use that paper, those insights of that one. Great, I think the time's over. Thanks a lot. It was a rush, but of course, feel free to talk over a coffee or a glass of water later to me. Thank you.
Thank you so much, Hunter, for this really solution-oriented presentation as well. Okay, so we are before the last panel discussion. I'm conscious it's Wednesday at 4 p.m. How are we doing? People smiling, look at me, okay. It's actually really interesting to see because we did discuss quite a few challenges, especially in real estate before when it came to data, complexity of the EU taxonomy and many other things, which is true. And we all know that it is complex and it's not that easy to practically implement, but also amazing to see how many interesting and very sophisticated tools are there to address all that. I know we went through a couple of publications, which we will share, not only the slides, but it's amazing how much work is put into addressing some of these complexities. So this is really, really kudos to you as well for actually doing really amazing work at CREM. Now, as I said, the last panel, definitely not, well, we're actually leaving the best for the end, I think, here. So we are still sticking to the real estate. Now, talking about the real estate value drivers and the changes in financing real estate for net zero, which again will be moderated by none other than Raul Garcia Rodriguez, if I can kindly invite you back to the stage. #1 ESG in real estate practitioner, the most passionate about the transition in real estate. So I will let you introduce the last panel, and let's keep the energy going, and then I promise you some snacks and some drinks and some fresh air. The floor is yours.
So first I will start with Paloma, my colleague at the UNECE. Please come over. Paloma, I have been working with Paloma already for 4 years, 5 years, I don't even know. It's really, really a long time, but it seems like it was yesterday because Paloma is involved in so many things. and I will explain you more about what Paloma's work is. Adam, please come over. Where are you? Thank you so much for coming as well from all the way from Poland. CTP, very interesting project going on at a very large scale. And last but not least, Andrei, where are you? Here you go. Please come over. And Andrei is working with Colliers, also in ESG, so I think it's fair that we have brought a fairly good example of, or sample of different consultants, and I think it's good because many companies do have their favorite consultants, and it's good to see that consultancies in different cases are bringing different values and they're bringing different approaches to it, but everybody's moving towards ESG. Now, I will come back, if you guys allow me, to Paloma, because we have some slides. But before we go into the slides, I will present a little bit more about Paloma and what Paloma has been doing or is doing now. To start with CREM, Paloma is one of the brains behind CREM. We've talked about CREM already 4 years ago, I think.
Yeah, 4 or 5.
Yes, with EPRA.
We started 2018.
And still Paloma is behind with your team on the thinking and laboratories behind. So that's just one.
They do the work.
Yeah, but you do the calculation. Paloma is a professor of applied economics in the University of Alicante. She's been visiting universities in the US. I don't remember.
Berkeley, MIT.
Yes, Berkeley and MIT, only Berkeley and MIT, you know, just things that happen there. We recently had a really interesting conversation with MIT. I don't remember,
FIU, Atlanta, FIU.
It's so much. And, but what brought her here, other than the applied economics that she does with many, many publications and or initiatives, is that Paloma is the chair of the Real Estate Market Advisory Group at the UNEC. This is a working group that is very active, not as latent as most of the UN bodies. Here we have a really good pool of practitioners, professors, I mean, you name it. People are involved in real estate, and we try to produce thought leadership, methodologies, best practices, evidences, so that the people can use it. We focus a lot on working with public services, because we understand permits and licenses come from them. They need to buy the speech, the narrative about sustainability and affordability. I think that you should talk about yourself more than I talk about yourself, because
I can.
Please tell me a little bit more about what we do at UNEC.
Thank you. First of all, thanks for the invitation. I'm happy to be here on behalf of the United Nations. Is the profile I want to bring here and the type of work we are doing now in REM. Our group is formed by 23 professionals from all over the world. Raul is one of them. And we are doing voluntary work for the UNEC in the topics related with real estate. We all are experts in different aspects of real estate. And the last two main works we are done is on finance, sustainable finance. And this is why probably Raul has invited me, although Raul was working on them as well. And very recently, the UNEC published a decalogue of sustainable finance. It's already on the website. You can just download with the general. Okay, this is for the slides, right?
Yes.
Okay. But it's not there. Let me explain you. With the general recommendations, the United Nations is have given to the countries in order to promote sustainable finance. This is very important document that is starting to be. It was presented, I think, some months ago. It's already published. And is going to be adopted by the governments, which is very good.
Yeah.
although we understand that finance is a private market. So if you read the principles, you see how we are establishing, not we, I mean that the United Nations is establishing like a link between the capital markets and the government and sustainable goals. This is important. And the second work we are doing, and is very, very active, the United Nations on this, we belong to the Secretariat of Housing and Land Management, which is one of the divisions in the United Nations. UNIC in the north, United Nations for the north of the globe, right? Is in housing affordability. If we have to identify why finance is linked with housing affordability or sustainable finance, I think that is what I have prepared here. Housing affordability is a problem related with finance, the change on the finance system since 2008, with the global financial crisis to now, jumping to the sustainable finance, and creating a very important problem in real estate, in housing market, but is affecting other sectors in real estate due to the problems that new families, young household, and not so young, that young household, having to have a house. And what I have prepared here is some conclusions we have about how sustainable finance is important to solve the affordability problems. I'm sure that you all in your countries has strong affordability problems. One of the projects we are doing about affordability has two phases. One is analyzing data information. We are using the microdata from Eurostat, very detailed for every country. This part covers 34 countries in all Europe, not only European Union, but almost all European countries. And the second is the more institutional, that has passed through, identify whether or not the governments, national and city governments, identify, as we do, the affordability problems. After to see the results, I have to say that they identify very well, so which is good. And we have understood why this problem is on the table. And let me tell you that the problem is not the normal problem of affordability. During the economic cycle, we have periods that normal lack of affordability, when we have increase on unemployment and the cycle is going down, then there are people that has problems of affordability, right? These are, let me tell, the normal problems. But what happened now is not a normal. Is the result of two main shocks that has the impact on housing prices, housing markets. Let me just give you a reminder, but probably you are from the financial sector, so you know better than me the process. But the financial crisis in 2008, what did was disturb the mechanism of capital markets. The mechanisms were shocked when I'm economist in applied economics. So when we see a shock, say, all the mechanisms change, right? So it gave a shock to the capital market, the capital movements that impact on liquidity in the economies, in all economies, most in developed economies, all over the world. It was global, right? So what happened then? Well, banks, companies, governments face a very important problem. They couldn't move the capital they need to maintain their compromises, right? And immediately after, this shock affect to second level, well, not second level, first level, but second step, affect to the interbank liquidity mobility. And this affect directly to the monetary policy. So it was a revolution from the financial revolution with very bad consequences, by the way, and it developed a process of regulation that we didn't see since 20 years ago. And the final of this regulation was the stress, very strong measures, what are contained in what is known Basel III measures that has been embraced by almost all developed countries, Japan, United States, European Union, and that create strong risk measures in order to controlling the formal banking. And these strong risk measures affect especially to real estate finance. And the result is an immediate reduce on the total amount of flows for finance real estate in any aspect, both to directly to families. Our mortgage market in Spain has reduced the size to 25% from the beginning, from just 15 years ago, which is absolutely nothing, and also for developers. So, and the worst news is that this is for medium size, medium term or long term. So we are not going to see, hopefully I'm wrong, not going to see a new flow of capitals coming from the formal banking system to real estate. One reason, only to convince you, credits in real estate are long-term credits, 30 years, 25, 30 years. This happened in 2008. Those credits are still on the market. So the banks has almost, they are not on the limit, but almost on the limit of this risk measure. So they cannot give us more. So sustainable finance is an alternative. But how this is linked with affordability? The slide you have here is this one, yes. Well, allow us to understand why these macroeconomic problems are affecting and creating a vicious cycle inside the housing market. If we think about how the household enter in the housing market, they can enter in homeownership or rental. Normally, every country has like balance the entrance, and some of them are more owners focused, some of them are more renters, depending on the country. Completely heterogeneous, completely heterogeneous. So if ownership is the main goal for the families, they have to have enough income. First of all, income is important for the equilibrium. Second, they can have, I cannot see, the housing price has a role, but it's not the main role. The housing prices determine the amount of capital, but the amount of payments, it depends on the amount of capital, interest rate, and the maturity of the credit. So something that we experienced in our country, in Spain, when during, it was end of 19, early 20s, was that housing prices growth a lot, interest rates fall a lot. So the amount of money that people pay was almost stable during 10 years, so making very, very affordable the entrance. So it's not a matter of prices only, it's a matter of a combination. And the third is that you have to have enough saving, 20% at least, and you have to obtain a mortgage. And this is the one that is failing. Cannot obtain a mortgage because the system has failed and the amount of flow has. So, young, new household cannot enter in ownership. In my country and in other countries, well, we have, in our study, we estimate these ratios for the 35. And what we see is that those that find a mortgage are those that at least put 40 or 50% of the price on cash. So this is what allows the financial system to maintain the risk levels, right? What happened with the new? So young people have no savings. So first of all, so this is happening since 2008. So any new household need a house, cannot buy, instead that they are enough income to pay them, they go to the rental market. And then happen the second. All the flows in all countries, all the main floor of first families are facing the rental market due to this lack on the ownership. And the rental market is overheating. Let me introduce the second shock. The second shock is what happened after the financial crisis. And you can see this figure, which is very representative of why I say that there is a strong lack of supply. This is the, I'm in between, sorry. This is the housing start cycle. In all the countries you see there, I have 32. And it's an index. 2015 is an index, so don't consider that the levels are, the points are the levels. The first country is Greece, the second country is Spain, and the third country is Ireland, I think. But look at the reduction. So during 15 years, the construction sectors has not provided enough houses to cover the needs of the new population. If I put the similar statistic on population, you see how population is going up. So there is not enough. So people go to rental markets. Rental market, due to the pressure and due to the lack of supply, are increasing, rising prices, and the prices are rising 20% in Valencia, like 18% in Barcelona, and if we see Paris or biggest cities, also as well. This problem is different depending on you go. It's different in countries where the rental market is big, because the supply restriction is a restriction, but the effect is low. But it's huge in other countries where the rental market is between 3 and 7% of the total stock. And there are many, at least 10. This is what the analysis we have done in the second report for the United Nations tell us. So what happened with these new people? There is no houses, rental market is completely covered, and then they cannot afford a house, an owner. So this gives us the list of areas where the government should intervene. And let me just give you the last idea. And the last idea is, well, this act has two barriers for the entrance. One is lack of supply. Second is lack of finance. So sustainable finance is very good. Has substituting the traditional finance due to, well, real estate has all the condiments to be well reported to support the green assets, social assets, and sustainable assets, the 3-1. There has many talk this morning about the decarbonization. So using CREM tool, we could build like this to create green assets, for instance. But all this is happening in a strong change in the society. So at the same time, and this is my last thing, at the same time we are seeing how population mobility is increasing a lot. I'm not talking only about immigration. I'm talking about mobility inside the countries. Relocation, which multiply by, I don't know, many the total demand of houses existing in the countries. Second, we are seeing how the labor market is changing, and we see how other workers from other economies are coming here, and also with higher, by the way, with higher purchasing capacity, and then competing for the houses in our market. So we are seeing how changes in geopolitical are modifying completely the strategies of the industry in the location process to reallocation, coming back. High technology and the consideration of these sectors are key sectors for the economy, are starting to be developed again in our lands. So we need infrastructures. So everything happening at the same time.
Let me stop you here, because now you give me a word.
Sorry for that.
You just, no, it's important.
Time.
One thing, and this is something that we talked this morning as well, some of you who were in the closed session, one thing that we concluded, 18 people I think we were together, right, is that we are seeing, and now I'm going to talk to the two gentlemen here about it as well, that unfortunately the E is killing the S. The part of the societal management that we have to do to real estate to provide with housing, or we're going to talk now about about commercial and industrial real estate. This is not happening because we are focusing on things that are making this more expensive, not less expensive. Now, you mentioned infrastructure, and Adam is working for a company that provides huge amounts of infrastructure, working on industrial infrastructure. Please tell us about yourself, about the company, and then I have a question for you as well.
Sure. So first of all, thank you for having me here. Indeed, I'm representing mostly industrial and logistics, CTP. Happy to be here in Prague, in Czech Republic, where company has been founded 25 years ago. Now we're active in 10 European countries. And I think what stands out for me when it comes to sustainability, doesn't matter whether we think about E or S, is actually a time horizon where we consider an investment. And why I'm mentioning it is because we are a developer and the owner of the properties, and we develop to own. So our time horizon is long. We don't trade. We develop bearing in mind the fact that we now own, we will lease the building, and then the tenant hopefully will stay with us forever, but as we know, it's not always the case. So when one tenant leaves, another will come, and another, and another. So then it is of our core interest to build in a way that buildings will be attractive and efficient, not just now, but in the long term, and that gives a light to environmental matters, because that's supporting our business. At the same time, when it comes to the social matters, we're a long-term investor. We're developing parks, not single assets in locations. So then it is of our very much of our interest to be a good neighbor and to grow within the municipality, within the city. So to make sure that people living in the neighborhood are happy, that number of people living in the neighborhood is increasing, because that is prerequisite for many of our tenants to lease from us, right? So that's another thing driven by long-term approach that makes us thinking about society, social-related aspects. And then let me actually disagree with you on a more general ESG approach. You said that E is giving a struggle to S, right? A while ago. Yeah. Well, I would say for me it's a bit of for many of us it's overcomplicating things. And of course, if you look at the short term relating to what I just said, of course, whatever is changing, then it brings a struggle to all the other aspects that were planned. With this regards, I agree. But then when you look long term, I mean, is it really something that makes it more difficult? If we look long term and plan long term, does the fact that we want to build more efficient buildings make it less affordable for people? Well, I wouldn't say so, and that's the place where I don't really agree. And when it comes to the discussions we had earlier today and probably in 2 days earlier, I would say what is critical for every business, and I guess everyone would agree, is predictability. Right? When you have predictable environment, then you can plan and you can do things efficiently. So then, as we've seen even a while ago, we've seen a CREM tool. That is, one can argue whether the numbers there are good or bad and what it takes into account. I mean, that can be discussed. But then you got the numbers for more than 20 years ahead, right? So having this projection in mind, you can plan and you can find efficient solutions to meet requirements that are ahead of you. And then, but that's a voluntary thing, right? That's the tool that has been developed. That's the voluntary thing. But then, when it comes to the legal framework and the directives that are not just guiding us, but also forcing us to do or not to do certain things, we heard 2 panels ago about EPBD. So that's the directive for buildings performance. And that's why I'm mentioning it, because from long-term investor perspective, I've been very much counting on the fact that there will be something very specific when it comes to the energy performance expected from the buildings in coming years. And that's something that, that I would say makes it difficult to plan and to really start doing things now, because we know what's the 50, 100 years goal, right? We want to be all neutral, and that's clear. But of course, bearing that in mind, probably most of us would see it 49 or 99 years and waiting until the close to deadline and then do something about it, right? And that, we all know that it's not the way to move forward. And also, it's not the way to do it financially viable, because when we try to do something rapidly, of course, it costs a fortune. And of course, it's distracting existing business models. And as we know, real estate is one of the least innovative, one of the most stable parts of the business. We've heard of the economy. So then, long-term approach planning is very much necessary. And being an optimist a bit, if we know what is expected in 5, 10, 15 years' time, I wouldn't say that it would make what we built more expensive. Because, of course, if you are to build net zero energy or net zero building now, of course it's going to be more expensive. And then it leads to the question, who's going to pay for that, right? And maybe actually out of curiosity, because I believe actually that's the challenge. The challenge is not the technical thing. The challenge is not that we don't know what to do, but the challenge is who's going to pay for that. Right? So maybe to bearing in mind the time, to wake you up a bit. Who owns the property? Who owns the flat or a house in this room? Okay, we have a majority. Okay, so then for the ones that own a property, assuming you got some savings and you want to invest in a flat for rent, you have 2 options. One is 10% more expensive than another, and from both you'll get €1,000 a month net. Right, and the 10% more expensive one is the sustainable one. Who would invest this 10% more having the same return? All right, that's nice to see few, but probably most of us, being totally honest with ourselves, would rather say, well, yeah, maybe I'll save this 10% for another one, and then I'll think about it, right? And we're a bit in this situation. That's why the complexity and the problem is not what we need to do or how to do it, because we know these things, but how to make it working business-wise. And that's the challenge. And why I'm mentioning this, because that's very much the case of our company. So we're thinking long-term. We know how to do it. We're doing it. I'm happy to say that we recently have done it together with one of our tenants when it comes to operational carbon neutrality. So this is happening. This is not rocket science. We have there was discussion about financing. So there is money to do it, but as with all the money, there has to be business case supporting that, right? And then for that, I see 2 options. The first maybe not options, solutions. One, those are clients, but as we can see in the room, it's not everyone who would pay extra for having something more sustainable. And that's, I mean, we represent business and other people are representing other businesses. So many, as long as not forced to, would not pay extra for that. And then there is the second option or second source, that is legislation. That is very much needed to be raising the bar, first of all. Secondly, to make sense and to avoid relating to the point that I don't agree. So to avoid this kind of discussion has to be predictable and long-term. So to sum it up, we are in a very interesting moment because I feel that we are very much tempted to make things way more complicated than they are to achieve the goal.
You actually gave me a reason to what I was saying, because when the people doesn't raise the hand, they're saying exactly what Paloma was saying. We don't have enough money to survive on the basics, and we are already trying to tell the people that we have to go on the sustainable, which is more expensive. So I agree with you. I like actually the conversation, and it's important to understand, first of all, that we're talking about two different uses of real estate, but they meet in one place, which is the real estate itself, the land. And the prices of land has risen. And I have a question for you before we go to Andrei, which is, and you can answer or no, because maybe somebody in your company is not going to be happy about the answer, so think about it. When you choose a land plot or you choose a location, you choose it because you want to think about the human resources that are around the location so that whoever comes to work and use your real estate will have human resources, or you do it based on the price?
I think the answer, I mean, it's already answered, right? Because what's the point of buying cheap land if there is no tenant, right?
That's the extreme point, but I'm talking about a city. Mm-hmm. If you have the options, you said we have 2 flats, 1,000 each, we do this with that, entering the same thing. You have two land plots. One of them is close to where many people will call to work, and the other one is cheap. Mm-hmm. Which one would you use? Same city, same distance to?
So as simple as that. Which one would make a better business case, right? So probably in the place that people are living, so that will be willing to work, I will get higher rent. So I'll go for the
I like the one. long thinking. That's,
I mean, that's
it's reassuring to tell you.
I think that what drives also the people deciding on whether to buy more or less sustainable flat, right?
But Adam, do you think this is the case in the industry always? Because you build to rent and you keep, which by definition is responsible real estate. Yeah. This is when you go to the municipalities to ask for any licenses or permits, they love you because they say, okay, these guys are going to take care. They're going to develop something that is going to last. Yep. Not everybody's like that.
Correct.
And we know that.
Correct.
So if we have the long-term view, then everybody's like that. Yep. The problem, and then we change from industrial into residential, is that the younger generation cannot afford to have this vision. This is the issue, important issue. Anyway, let's not go there because I also want to introduce Andrei. Because Andrei is actually working with all kinds of real estate. And I will be very interested in, first, please introduce yourself, tell us a little bit about yourself and Colliers, and what you guys are doing in ESG and sustainability. And then I would also like to hear what's your opinion about the difference that we see in different uses and different kinds of clients that you have, because you may have, I know you do have clients that come to buy, come to rent, come to different, so please.
Yeah, sure. Thank you for that, and great to be with you. So I'm heading the CEE advisory team in Colliers. So we are basically working with all the clients that have any, let's say, sustainability needs for the real estate. So we are certifying the buildings in many different certification schemes. We are performing and developing decarbonization paths. We are doing study for the energy. But also we are like the think tank of Colliers because the sustainability is changing the way that I think we are operating the businesses and a lot of our business. So the Colliers is the brokerage company. We help with investors buying and selling assets. We are property managers. We are having the general contractor for the fit-outs and the architectural company. And actually, my team is not only working with the clients with their, let's say, problems or the sustainability issues, but we are also cooperating with all of that business lines to create the synergies between, let's say, how the sustainability should be linked with those services. You know, you now design offices entirely different than a few years ago, at least for some clients. So let's say, role of our department is quite wide. We are also developing the strategies for the portfolio or for the owners, but providing, let's say, the whole chain of possibility changes. So we are also the advisor for energy purchasing, like PPAs. We are having the smart technology specialist. So basically, whatever you want to do with sustainability with buildings, we are happy to help. But I think that discussion that went on was really interesting in a way, because there is this supposedly, let's say, not antagonism, but differentiation between environmental and social aspect. And I think that's a very interesting take, especially when you look at, let's say, how they're disconnected. So it's very easy to do a net zero building. It's totally easy. If we are switching down all the lights here and shutting down the ventilation and heating, and we just open the windows, we are net zero for that time that we don't use anything. So it's not hard to think of the structure that is net zero. It's hard to think about the structure that is, let's say, giving you the proper indoor environmental quality and allowing you to do something in it. On some of the panels before, there was the question that there's energy efficiency buildings that are, let's say, are feeling nicer because there are a lot of air. That's completely untrue. It's true if the building is greatly designed, so the systems are cooperating, but if you want to put more air in the building, it costs energy. If you want to put more lights, it costs energy. So there is a very big discrepancy between the well-being and with the environmental aspect. The question is when we see the balance of it. So for years now, you know, the temperatures in rooms were too high in summers, too low in winters, or whatever, you know, in different ways, and not some set point that is optimal. So we need to also think how to operate the building and think about what's the crucial component, and that goes back, I think, to the discussion. So I agree with Adam completely on the thing that long-term perspective is the thing that you see proper things in a proper way. And only in that way you can say evaluate things. Because if we agree that the physics is true, basically, so we are having limited resources, like materials for building stuff, but also energy is limited, and even carbon is limited. It's calculated how much can we emit to atmosphere before we hit this concentration of CO2 that, you know, put us well above 2 degrees Celsius. It's, I think, 9 years that we have if the current emissions are still. So everything is limited. And if you are thinking about that, that creates some long-term risks or opportunities. We saw the CREM, and of course there's this big unknown about the carbon tax or how much can it cost. And now I think the problem that there is with sustainability, that there are very, very large number of unknowns. We don't know how much the carbon will cost, how much the energy will cost, if the social aspects in the reporting will change, how companies will, let's say, want to see the spaces, etc. And yet we are here to make some bet on that. The companies are preparing strategies, they are preparing some, let's say, things how to adapt to that reality. And it's a very interesting, but also a very, let's say, unknown territory that we are in. So I think Adam also mentioned that there is also legislation that is coming that it's not so perfectly strict that we can estimate or simulate how the market will solve. So there's a lot of this it's not so easy as it seems on paper, just to, decarbonize. What about the social aspect? Everything is linked in that department. So sorry, I'm very vague, but it was too inspiring, your discussion, so I just want to...
No, it gives us also another point when in the work that we do with policymakers and we do in public services, and when we talk, most of the work that is done, it's addressed at specific officials in the cities, so that they understand they need to do something. And then we try to bring companies, like your clients or your company, Adam, that will invest in there to create wealth. Because we know that there is an added value in the investments in real estate, no matter which kind of real estate and no matter which kind of assets. By building it already and by bringing also some infrastructure to the places. Infrastructure is crucial. We know this very well. In the last 25 years, we've seen how the infrastructure in the countries that were able to absorb the funds, the EU funds, have boomed. And we've seen some that have not been so diligent in that and how they're suffering. The question here for us, and it is for all of us, is how do we convince the municipalities on specific investments with the little amount of money that they have? Because there's not so much money. So we are craving for investors who, like CTP, will come and will do the whole infrastructure of maybe a very big industrial park and only use a quarter of it. And then the rest has already the infrastructure. We'll see how it gets paid back. I know this is a big issue. But if you don't do the infrastructures, and this is a different kind of use, you don't have anything else to sell.
If I may jump in, I would say again that there are models that allows for this. Linking a bit maybe to residential and to the land owned by the state in different forms, right? I mean, the price is driven by the scarcity of whatever we speak about, right? So when it comes to the land, I believe all the investors would say, yeah, land is scarce, definitely, whatever you think about. So then when it comes to the housing, I mean, owning the land or owning the permit, you can really play with that, as you suggested. If you commit this part of the land that is maybe not perfect for industrial, for residential, or the other way around, I mean, there are models to finance it, and it can work. I think this is Sweden, that is, for instance, allowing to build more leasable area if you introduce certain features for the local communities. So, of course, it's not super easy. I would say everyone who's working with public authorities, owners, would say, well, it's already not easy, so it's not going to be easier. But then, again, thinking long term, models are there. And then when it comes to the affordable housing, you can say that you will only allow you will only give the building permit if the price of the unit or the rent would not exceed that amount, and then you make a tender, right? So you don't make a tender for the plot, but you have for the whole concept, because I mean we're creative, and when we're in competition, we're even more creative because everybody wants to win the bid, right? So it sounds like it's only the way of changing the thinking, but if we reframe a bit the task, so not for the municipality or the city, how to make the most money on the land, but how to actually make the most out of the land that we intend to sell. I mean, it's done, right?
It's the theory of value and value added, and retention of value. And I think Paloma can tell us about these models of private investment attraction that we've seen in Spain, because we have some companies and we have some cities that, well, by definition, in the urban development plan of every city, you have the economics of it that will tell you how much of each use you have to attain to and how to transfer these uses. But in Spain, we have some nice experiences. I wanted to talk about this. I don't want to kill the show here.
Well, land planning.
Yeah.
Well, we have several experiences, but I have to say that we are changing again or modifying the regulation. So our experience, our system of land planning changed substantially during the 90s when it was my region, Valencia community, that defined a law that introduced the role of the private developers inside the plan. So before, it was only things about the government, the central government, regional government, and municipalities. That's it. So private was out. And we introduced it. It was very, very well known, and it was extending for the rest of Spain. And time to time, the capacity of the private sector to define the land were reducing and regulating. And well, now is revising. But the revision now is not related to the PPP, this type to plan new land with private sector, is revising in terms of how to coordinate better the international regulation, which is the sustainable regulation, as basically inside the system, inside the Spanish regulation, which is very, very complex, how to introduce and how to speed the process. Because most of our developers, what they complain is about the delays. The plans normally have between 5-6 years time, so since the beginning and until all the regulation system ends. But after that, there are another system of permissions and so on. So this is what my government now is working. But it's here, so everybody is convinced that the only way to develop the land in order to attend the huge urgent needs for the real estate market is by a public partnership, public-private partnership. So everybody, the government, everybody. So what the municipalities are doing is they are allowed to do that, externalizing segments of the regulation. They are allowed to do by law. So, and there are an increasing number of small companies, well, medium-sized companies that are designing the plan, part of the plans, and providing to the municipality, and
And talking about PPPs, public-private partnerships, we have people from different countries here. We are in let's say, a very comfortable region. But I think, Adam, you're not always in a comfortable region because you're working a lot in a lot of different places. Is there something that you see that is a main difference? Are we really on a few speed Europe when it comes to this kind of regulation, permitting? How do you see this? Please give us a little bit of.
I would say in a perfect world, PPP would be a fantastic solution because that's the long-term approach. But then what, not to say kills it, but makes it more difficult is, as you mentioned, those are typically long-term processes. Meanwhile, we have elections, local or state or whatever kind of elections. And then, I mean, from elections to elections, pretty often everything can collapse. So that's not always something that is super interesting. But let me raise the example here from Czech Republic in the city of Brno, where we're very much present, not just with industrial and logistics, but also with office and residential, because we have also some of residential properties. I mean, the key to this success is defining common goals and long-term approach. Because, of course, as I mentioned in the beginning, business case needs to be there, because otherwise you can't count on private investors, right? Because what for then to be part of it? But then if there is a business case, even long term, and you see that you can grow your business together with the growth of the city, for instance, right? Then of course it's very much interesting. Probably if you have different needs, you might need to invite different profiles of investors. But that can work, and there are examples of working. So I believe, to answering directly to your question, PPP can be good, although it's extremely difficult because there is, and I would say that's a common pattern, because then it's typically related to multiple regulations related to public procurement and so on, while it doesn't necessarily need to be done through PPP. It can be done through open transparent cooperation with an investor or the group of investors, not necessarily doing it as PPP, but actually playing with the fact that at the end it is municipality that is giving building permit, right? So I would say without the common agreement, you would do nothing. And I would say typically it's of interest of both to find an agreement. So that should be strengthened, and then finding common goals and quantifying it. This is, I would say, the most efficient way to move forward, and not just for new developments, but very much for brownfields and redevelopment. It is very much happening in, I believe, in the whole Europe.
Thank you for mentioning brownfields. I wanted to go to Andrei about what is the temperature in the market between brownfield and greenfield. You guys do land services, you sell plots and you identify plots for investors and for developers. How do you see this ratio now? Because there was a moment where everybody was going into greenfield because it was easier to develop, no contamination, no remediation, no nothing. Then everything turned because it was impossible to get anything that was greenfield. What is the situation now? How do you see this?
Yeah, so I'm not that much into, let's say, the investment process of the land, so I'm not going to tell exactly, but I do believe that taxonomy and, you know, the changes around the biodiversity and the, let's say, regulation bits might be influencing that a bit. So in the taxonomy there are this, let's say, linked for the restrictions for the greenfield that you could develop for. So that might influence, but I'm not hands-on with that topic, so don't want to, you know, confuse you here.
No, that's legit. It's a question because I would expect that a company like Colliers may be sometimes prompted with identifying, and then you have, of course, different portfolios coming from different sellers, sometimes the municipalities offering you brownfields. But you know the brownfields and you know how difficult it is to develop a brownfield compared to greenfield. And we come back to what we were saying before. Is it easier to retrofit something that already exists or to do something new? A developer, probably Adam will nod on this, but I think we both will cry. We prefer to do something new.
Yes and no, I would say. It depends very much. It very much depends on the need, because I would say what we see as a macro trend right now is it's a bit shrinking of the office after COVID with all the remote work and very often related to prices of residential properties in the central locations. So people tend more and more to work remotely. So then for some office buildings, I mean, the A-class and sustainable of high indoor environment properties will be definitely around for forever, not to say, but secondary market, I think that would be a lot of interesting things happening because there is scarce of the land in the cities, and I would say that's why I said it depends, because for some refurbishment would make sense, but for some buildings, I would say it's gonna be, if you can refurbish a building that would not provide such quality as the new one, then of course we've already seen there are different tools how to calculate embodied carbon versus operational and so on. So you can hire engineers to really make not just the business case but also the environmental case. But I bet for many it would be both better business case and the environmental case to build something new addressing the new needs. Because of course, I mean, we can have half-empty office buildings still, but then maybe it makes sense to make it residential or mixed use. So I'm 100% sure, and we start seeing it also in Central Europe, that more and more of this transformational projects is going to come.
Thank you. We have only a few minutes left. We need to give room to everybody to talk, and maybe there are some questions, and please feel free. We have Slido there. We have Julian playing around with the microphone. So is there any question anybody wants to address? It's not very usual that you get these these four, on the stage. So feel free to call any subject that may. Wow, we covered all ground. We covered it all.
There's one there.
Yep.
Thank you. Thank you very much for great conversations. I'm listening very carefully, but maybe I want to...
Jakub, I know you, but the rest don't know who you are.
Sorry, I'm Jakub from a small company, Verdian, in here, and I focus on, actually I focused on sustainability housing research as well. And I wanted to ask, because, you know, these conversations usually are about decarbonization and measuring CO2, and of course, the environment, the E, which actually Raul mentioned, maybe E versus S. That was the conversation. From my perspective, it's about indicators as well, because it's easy to measure something physical, something tangible, which is usually environment. We have many experiences and so on with measuring this, but we can't really measure other aspects of sustainability, which is social. And that's why probably is far in the background, you know, in the conversations. And my question is, what is your take on this, that we are actually talking about decarbonization, but not necessarily about the sustainability as a whole? Why we are getting only, you know, 1.5 degrees Celsius in 2050, that's the goal, but is it really sustainability, and should other aspects of sustainability, you know, be in the background? Just because this is, let's say, this issue has the most space in the public and we know the most information about it. But, you know, for example, you talked about 9 years, let's say, you know, that we have 9 years to really make the change. But what about other aspects? Because for me, I'm personally quite scared if we are going the right direction. You know, if we are actually covering everything. Sorry for the long question.
That's
but
good.
Yeah.
Thank you. Thank you, Jakub.
Can I take on that?
Please.
Yeah, so I think that's the searching for priorities is like the climate crisis is a start of several other crises and problems. And I do think that maybe that's why we are, let's say, putting that pressure on it, because as you mentioned, it can be measured, it can be calculated somehow, let's say, can be applied. But I don't think that, let's say, not maybe all of the other issues of sustainability, but for the water pollution, biodiversity, there are some, let's say, regulations for real estate markets. In taxonomy, for many years, we were also elevating the standard of the building, you know, or trying to elevate rather with these certifications. So it is happening, but I do think that the decarbonization and energy is as a, let's say, central pillar. Probably because it's the most vital for, let's say, the future of the business. I believe the AXA CEO mentioned that the world that is 3 degrees warmer is uninsurable, and if something is uninsurable, probably is unfinanceable. So it's a problem like for the business and civilization. So maybe that's why. But the second one, I wouldn't agree. We don't have these social metrics. I don't think they are just as matured yet. So even for the real estate market and sector, there are the things like social value index, social value calculators that can, let's say, somehow measure the even financial impact on local communities, stuff like that. So there are these measurements, but they are not so sophisticated yet and not so broadly used. So similar for indoor quality, we have several metrics for, you know, CO2, stuff like that, or productivity levels, sick leaves level. It can be measured, but it's probably not so strict. And I think you're right that the climate energy is just on the, let's say, hot spot. But I think we have so little time, not only for the conference, but as a general rule, that it's reasonable to pick the one crucial and focus on that, but maybe that will be a mistake, you know, who knows.
We will find out soon.
Yeah.
I think if I may shortly comment, I think that's not the case actually. I think there are multiple social indicators, but those are indicators mostly for policymakers, right? And then I would say, I mean, we tend as a real estate community to take responsibility. I mean, maybe not to take, but to consider ourselves responsible for everything, right? But then you have indicators such as affordability of housing in a country or in a city, right? I mean, that's for the ones issuing building permit. That's not the one for us building a building, right? So there are multiple literacy and so on, but those are not commonly used in the sector, because I would say our projects, our activities can fit into executing on this agenda and meeting these indicators. But I would say for us, it's a bit like using the parallel, thinking about healthy living, making sure that someone in the crops is really taking care of, I don't know, his family or his dog, right? I mean, of course, it's better to take care of it, but if I want just to eat healthy food, should I care that much about these things? Well, that's my comment.
Agree with you that there are many indicators, but not so precise. There are a lot of work being done by the institutions to create data sets with precision and a lot of granularity. And if you ask me how I follow some, we normally use the SDG data set or SDG indicators. The United Nations also develop quite long list of indicators under every SDG. You can find all the information also in the website. And most of them are very precise. So some municipalities cannot have this one. So there is a project that is running since 3 years ago, I think, which is called Local Voluntary Reviews, which is a project that the United Nations helped the municipalities to develop the data sets associated to all SDGs, trying to create the variables that are considered that could represent green or everyone, poverty and so on, right? And believe me, there are many. So until we decided the number of variables, it requires like 1 year discussing with the statisticians and most people. Yeah, and it's very interesting. It's very interesting project, and they expect that probably in 4 or 5 years, most municipalities has all the infrastructure for taking the statistics. Be ready.
Yeah. So to close the session and talking about the same issue, there are 2 sets of KPIs that you can look into. One of them comes, let's say, from above, coming from the SDGs and United Nations ecosystem. The other one comes from the industry and the regional taxonomies. We just have to meet them in the middle. So we will have it all thing. Thank you very much, everybody, and see you around later on, right? You're throwing a party later on. So
yes.
Go for it.
Okay, thank you so much, Raul and Paloma, Adam and Andre. Okay, so I know it's usually the last few sessions, especially now after 5, and having and seeing and hearing so much information. Some of the presentations more technical, some of the more difficult topics might be really difficult to go through 3 days. But now we only have to do 2 things, which is good news. We have to conclude this summit, and maybe before doing that, we have to get energized a little bit. And to do the second part, we have an amazing speaker to close this 3-day summit. So please let me welcome to the stage Soni Kapoor. Soni, a very distinguished speaker, professor of climate and geoeconomics and finance at the European University Institute in Florence, but also the CEO of the Nordic Institute for Finance, Technology, Sustainability. The floor is yours.
Thank you very much. All righty. So I've been asked to, 1, not use any jargon, and 2nd, to try and sort of bring in energy and hope Hope and change was the phrase Linda asked me to do, but that's already been taken. So I'm going to try my best, right? Some of you heard me speak for about 2-3 minutes yesterday, but some of you might not have been there, so I'm going to repeat myself. So, in the broad sweep of human history, everything, all prosperity, growth, all this amazing architecture, the clothes you're wearing, everything we take for granted, has only come from 2 original sources, and that has been natural capital, broadly defined, natural resources, carbon envelope, biodiversity, land use, all of that, and us, human beings, and our ingenuity and creativity, something that is in economic terms called human capital, right? So those have been, and this is completely unchallengeable point of view, those 2 have been the only 2 sources of all growth, prosperity we take for granted. Everything else we talk about nowadays, you know, intellectual capital, financial capital, etc., they're nothing but accumulated surplus from these 2 original sources, right? Let's park that aside for a second. Now, where in the world do you think today do lie the biggest reserves of natural capital and human capital? Is it in CEE? Is it in the broader EU? Is it in the OECD, rich part of the world? Or is it primarily in, you know, Latin America, Africa, and Asia? And we all know the answer to that, right? But where in the world lie the biggest pools of financial capital? Who in the world owns the most intellectual property? And there, the answer is quite different, right? So, there is a pact to be made between these 2 sets of actors, the rich, aging, developed world of which we are a part, where we still have the vast majority of the world's accumulated financial capital, intellectual capital, not just backward looking, but also intellectual capital in terms of the new technologies being developed, right? And then there are the Indias and the Sub-Saharan Africas and the Latin Americas of the world, where for every country in Europe losing population, there's 2 gaining population with a very young demographic, right? With massive, you know, the Amazon, the Indonesian rainforest, mineral resources, what have you. So there is a marriage to be made in heaven of putting them together to save our collective future. And that is sort of the grand bargain I have been advocating with now. This has been my 6th G20 that I've been advising, the Indian G20 that recently concluded. Now, what does this look like and why is this important? So before I go there, you know, you can mark my words, 10, 20 years from now, I challenge you to find me and either, you know, throw egg on my face or say, hey, you know what? I think maybe you were right. Because having looked at this from multiple dimensions, there is only one sensible way forward for the global economy, where it is actually possible to reconcile the growth aspirations, human development needs of the majority of the world's population, most of whom still live at subsistence levels, with increasingly binding environmental constraints, of which global warming and carbon is only one, right? So time was, had we started 20, 30 years back, we could have sequentially first dealt with climate change, and then dealt with, you know, the biodiversity loss issue, and then dealt with water and ocean acidification. That time is gone. We now need to deal with all of this at the same time, often pulling in different directions. It's much more complicated, right? I mean, in many cases, it is not global warming and carbon emissions that are the binding constraint. It is water availability. In many cases, it is actually ocean acidification or collapse of the local biodiversity population, right? So this has become a far more challenging task. And this has been the greatest challenge to humanity, but it is also our greatest opportunity. Now imagine if we were where we are before, about 20 years back, when solar technology was not commercially viable, right? Imagine if we were in this place where we are today before Zoom and Skype and remote work existed. Then we would be truly, genuinely, excuse my language, totally screwed. But these technologies, the fact that this discussion is happening now, the crunch time has come, means that there is one way forward. The challenge is, it is very narrow. So imagine you're going up a very high mountain pass in the Andes or the Himalayas, and one way lies deep valley of death, and the other way lies, a pit full of snakes who are going to eat you if you fall inside. And we must, as humanity, make it to the other side. So how do we get there? So let's begin. The first thing we're going to talk about is growth. Now, if you look at the post-World War II environment in Europe and in the United States, we've had, relatively good time, at least until the financial crisis. We grew well. There was huge prosperity from the 50s and 60s and 70s, at least in Western Europe, not in CEE quite yet. And if you break that down, that growth came from two main sources. Around half of it came from an actual increase in the number of workers, and the other half came from an increase in productivity, right? Now, productivity is a nice catchphrase, but what does it mean? It basically meant that all of us, yes, we got access to technology, but it also meant that all of us significantly increased our environmental footprint. There was more and more materials and carbon emissions and energy going into what we were doing. So that was sort of the productivity side, right? And on the population side, we have gone, at least in Europe, and especially in Central Eastern Europe, from an actual increase in the number of workers, adding the tailwind to growth, to the actual number of workers starting to, if not stagnate, in many cases actually decline. So what was contributing to growth has now started pulling it down. And the productivity which took for granted that more and more material use, more and more energy will always be available, is being challenged by this environmental envelope, right? So in a good case scenario, unless things change dramatically, in a good year, many European economies should be happy if we manage to scrape, around 1% growth, right? So now this is interesting. It's not bad. We are reasonably prosperous. We could sort of live with that. The problem is our pensions, our pension funds are only viable with an assumption of 6, 7, 8%, depending on whether you look at US public policy, public pension funds or Dutch ones, etc. Continued compounded growth rate, right? Now, you can be a tiny hedge fund. You can generate a growth of 20%, a profit of 20% year after year in an economy growing at 2%. But can you be the whole financial system? Can you be the pension fund? Can you be the Norwegian pension fund that is 300% of GDP and expect to primarily invest in Europe and the United States and Japan with its declining population, stagnating productivity, and generate growth rates of 6, 7, 8% returns year after year? No, right? I mean, the laws of mathematics are the laws of mathematics, and eventually they catch up with you. So that's where we were right? So the growth prospects that face us with our demographics, with limits to what productivity can deliver, productivity growth, combined with our financial system and its viability, and the fact that many of us are aging, would like to retire, not into penury and poverty, but into, relatively comfortable life, something doesn't add up, right? So now you look at a country like India. Now, up until now, there was a very successful growth model that had been pioneered by the likes of Japan and Korea and China, which was export-oriented manufacturing combined with large-scale physical infrastructure investment domestically. And that has worked miracles. It has delivered more people out of poverty than any other thing entirely in the history of the world, right? But that model has ended. If India, starting from where it is today, reaches half the resource intensity that China has today, we, irrespective of what we do in the EU, even if we manage, which we will not, to get net zero emissions by 2030 in the EU, right, which is not even the target, we will still go over 2.5 degrees, right? And this is just India. And then if sub-Saharan Africa, which also has 1.4 billion people, also wanted its people to not live in subsistence agriculture in abject poverty, but wanted them, aspirationally to have living standards of the kind we do, and even reach half the level of resource use that China has today, then we reach 3.5 degrees, right? So the one tried and tested development model that has worked for tens of millions of the world's aspiring people has run out of the road. What else is on offer? Corona was horrible for all of us, right? I personally suffered. Luckily, I didn't lose anyone close, but I was kept away from my family for 2 years, and I'm sure many of you have horrible stories of loss. But on the one thing I think it may have potentially given us the hope to save humanity, right? Zoom existed before Corona. I had never heard of it. Skype existed. How many of us used it? When I was an investment banker about 20-odd years back, we still had these amazingly sophisticated video conferencing rooms, right? Nobody used it. Right? So what did Corona do? Peak lockdown, 2/3 of American GDP, 2/3 of EU GDP was delivered entirely remotely. Clearly, it came with a lot of suffering, problems, and that was not equilibrium, right? But is there not a possibility to have at least 1/3 being delivered remotely? Now, services are 70%, 80% of our GDP in rich economies and rising. The last golden age of globalization, which we saw between the collapse of the Berlin Wall, which allowed many of you living outside of the free world to join the free world, right? And all the way up to China joining the WTO until the GFC. What happened in that time? That was the amazing golden age of globalization, which delivered more than 1 billion people out of poverty, took you to the next level of standard of living, and allowed you to have opportunities and freedoms that you had not had before, right? But what it actually came from in macroeconomic terms was there was a doubling of the global workforce engaged in globally productive supply chains in goods. And goods are only 20 to 30% of the global economy. And that is the level of prosperity, human development, poverty reduction that it managed to generate. If we now go down the route of liberalization of remote trade in high value-added services, liberalization and remote delivery of high value-added services. If we pursue this to its logical conclusion, this next golden age of globalization, numbers we have crunched show that we can have a boost to global growth that is at least twice as large as what we saw with the last golden age of globalization, bring at least twice as many people out of poverty as that remarkable period did, while still managing to have an environmental footprint that is a fraction of what happened last time around. As an example, like for like, export of services from India versus goods from China has a carbon and environmental footprint that is about 1/10 as big as that of exports of goods from China, right? So going down this route is the only possible way of being able to capitalize on the availability of that amazing human capital out there in the rest of the world. It is the only way of reconciling a huge expansion in the volume and value added of trade without accompanying huge expansion in the physical footprint that the environmental envelope no longer allows, right? It is the only way of going forward in a way that is more and more interconnected rather than us all retreating into our silos towards inevitable conflict, of going into what I really think has to be the next golden age of globalization, where it no longer matters, or it matters much less, who is where, whichever person is doing whatever service from where. And the technological progress has brought us here. The fact that these technologies existed, both the normalization of remote delivery, the normalization of even meeting new people and developing relationships, meaningful relationships remotely, is absolutely amazing. So that is what gives me huge hope. Now, let's talk about, does it mean that we will not require all these clean minerals, etc.? No, absolutely not. We do require those clean minerals. Now, this is important because this is often missing from the European discussion and debate. Will there ever be a time when the EU will be self-sufficient in clean minerals? No, right? I mean, come on, we're not a very well resource-endowed continent. Maybe, you know, the United States has good availability, etc. But for the most part, the best reserves, the highest quality, most economically viable reserves of the minerals we need in gigantic quantities for the green transition lie often in low and lower middle-income countries in Asia, Africa, and Latin America. Now, are these places difficult? Are they unknown to us? Yes, right? And truth be told, we really screwed up last time, right? So if you're working in a coal mine, and I think I'm the only person working in the global macroeconomic policy-making space who's actually worked in a coal mine. Don't ask me why, but you know, it was part of my engineering internship. They knew we were all going to be very successful, but before we got there, they wanted to break us down. And I'm very glad I did this. It was horrible at the time. There is no clean mine, right? You can choose between workers losing 5 years of life expectancy or 15. You can choose degrees of toxicity, environmental toxic impact. You know, it's horrible, it's toxic, it's filthy, it's just dirty, filthy business. But the difference between 5 years of life expectancy loss versus 15 is huge. The difference between, you know, the tailings dam collapse and toxicity with cyanide artisanal mining and cleanest, latest, cutting-edge technologies is huge. The difference between grand theft and corruption that has undermined whole countries like the Democratic Republic of Congo with the resource curse and doing it better, for example, like Norway has managed to do, is huge. So we know how to do it better. But we need a plan. Mining has a gestation period of 5 to 10 years. We are nowhere close to having anything in the pipeline towards establishing that capacity. And the answer is not for Norway to do deep sea mining, which is not just economically ridiculously loss-making and unprofitable, but it's dangerously toxic for what is a very crucial part of the ocean life, right? The answer is to go to these countries. That's a fantastic opportunity for them. And rather than everybody depending on China, have 5 or 6 regional supply chains where you do mining with the latest cutting-edge technology, human rights safeguards. You help them establish sovereign wealth funds, fiscal rules, escrow accounts, anti-corruption, and do it better. And that's a fantastic opportunity to go down, increasing the value chain. So you have 5 or 6 regional local, and you're not dependent on anybody. That's the sensible way to go forward. And this is a financially viable opportunity, not for the likes of India, but for many countries in sub-Saharan Africa that have lower human capital, lower educational level for now, but much, much better resource endowment, right? So that's the mining part. So how does all of this get financed? Is it actually fundable? Now, let's just use for a second the example of the Norwegian Sovereign Wealth Fund, which is quite typical. As of today, if you look at the Dutch, the Nordic, the American, Canadian pension funds, around 80 to 85% of our investments are in other OECD countries. And as I said, the numbers just don't add up, right? I mean, you cannot expect 8% return in economies that in a good case scenario will grow at 1 or 2%. So what's the answer? Well, you know, when you go from iPhone 14 to 15, does it massively give you a productivity boost? No. When you get your first smartphone in rural Africa and Asia, that's remarkable. That's capitalism 101. Capital delivers the biggest bang for the buck where there's an actual scarcity of capital, right? Do we need more capital in Amsterdam and in London to inflate already sky-high house prices? Do we need more capital going to the big 7 technology firms? No. You know, I mean, Apple is sitting on tens of billions of dollars of cash that they don't know what to do with, right? Do we need capital going to Nigeria? Yes. So, quick example. As of today, even today, while we are talking about, you know, exotic transition and everything else, there's around 400 to 500 million people in Africa who still do not have access to electricity, right? Not air conditioning, but not even electricity. And the UN has a goal, it's even one of the SDGs, and there's even a UN body called Sustainable Energy for All. And when successful, each African family of around 5-6 people will have enough electricity to run a smaller than average American refrigerator. Or you can choose, each family member will be able to use one LED light, right? That is the aspirational success we have set for our brethren in Africa. Now, the Nigerian grid, Nigeria has, if I need to remind you, more than 200 million people, right? The Nigerian grid has failed 14 times in recent months and years, right? September last year, I think there were more than 50 million Nigerians without power for a day, right? Nigeria has as much electricity generation capacity with a population of more than 200 million as the city of Austin in Texas, where my sister lives. We know how much further investments are needed. And I grew up in Delhi. Today, temperature in Delhi has hit more than 50 degrees Celsius in the shade, right? And as of today, 8% of Indian families out of a population of 1.4 billion have access to air conditioning. And when air conditioning becomes, as it has, I think now in India, a matter of life and death, we know where Indian power demand is going to go. We know where African power demand needs to go. How is all of this going to be funded? Now, I've been guilty of this once. I'll never do it again. I once went around mimicking what a lot of us in this community say. In 90% of the world today, solar is the cheapest form of power. Except it isn't. So under very limited particular ways of defining, the cost of solar power, that is considered to be cheaper. But for the most part, the upfront capital cost of a quality-adjusted equivalent amount of solar power versus gas or coal in developing economies is 2 to 3 times higher. And for countries, if I say, I grew up in Norway, I've never been to a developing country, what does it look like? You'll say, well, structurally short of capital, terrible infrastructure. That's sort of definitionally what the developing country is supposed to be. So we are finger pointing at them using CBAM, using our taxonomy and standards and saying, guys, if you don't do this your way, our money from the EIB and whatever is not going to come to you and you will not be able to sell into our markets. But what have we done in turn, right? Have we helped them bridge the capital gap and given a choice? If a government has a choice between primary education and basic healthcare or choosing solar over locally available coal or gas, we know what every government would choose. And at least in developing countries, they have more of a moral authority to make that choice. So the numbers simply don't add up. But luckily, going back to what I was saying about finance, so from where we are, and when you ask me, I spend my life, at the beginning of my life, investment banking and asset management. If you ask, hey, does this project look attractive? My question immediately back to you, what does the rest of your portfolio look like? So it is completely sensible to have a project that, let's say, offers a relatively marginal 4-5% rate of return, or even 3 or 4%, but it looks attractive to me because this project is in Africa, or is in India, or is in Indonesia, economies with amazing population potential, growth potential that I am not exposed to. So given what most of our financial portfolios look like, at least until a point where 20 or 30% of them are invested in Africa and Asia, these projects will continue to improve the risk-return characteristics of our portfolio, even if they do not offer eye-catching 15, 10% rates of return. We need to do this at scale, and it's a quid pro quo, and this is the only way of also juicing up our pension fund returns to make our pension system viable. So to bring this whole story and narrative together, there is only one sensible, narrow way forward for the global economy that is able to deliver the significantly boosted global growth rates that the world desperately needs. is financeable, both in terms of the upfront cost of technology, but also in terms of the incentives of the institutions that can deliver that finance, because, my God, our pension funds need to reduce their excessive risk in Europe and the United States and increase potential returns, is viable technologically and from the perspective of growth in trade and services, without completely screwing up our planetary boundaries, and is geopolitically feasible in the sense there's something there for each of the major groups of countries. The lower middle income countries, resource-rich, get a mineral compact. The likes of India are able to export services. We benefit from growth, from being able to, at the time of record demographic asymmetry, when we are running out of workers, to be able to use a global talent pool and deploy our capital and sell our technologies. And that is the only way forward, and we have to get there. So everything you do in your day job, try and think about it. Is it somehow moving your institution, your country, your political debate roughly in the direction of a world that has no choice but to look like this? Thank you very much for having me.
Can I thank you? Thank you very much. Hello, hello. Thank you so much, Sonny, for the very powerful message. For the end of the summit, to also conclude, I mean, I know the summit is called the CEE Sustainable Finance Summit, and we do indeed focus on the region and invite many people from the region, but also had so many speakers and so many perceptions from abroad, from wider Europe, even from outside of Europe. And I think it is really important message to close on that while we named it CEE, while we talk about the EU a lot, this is a global problem. And it was really interesting take on how much it's all connected. And it's interesting to hear a very powerful message on the roadmap and how we can fix some of these problems. Now, we have made it. Congratulations to all of you. 3 days of very intensive and very hopefully informative and insightful discussions, but also a lot of information, right? I do get that. I was also in the audience. So I know our heads are much bigger now, but let me please, just to close the summit now, just let me please invite Linda to the stage to mention last few things and to obviously to thank you all. We can share the mic.
Okay, so thank you. You're the survivors of the last sessions. So I won't keep you for much longer. It's just to thank, first of all, our partners. Without them, as you know, none of these things are possible or feasible, because this is quite a complicated event, and we complicate our lives a lot. But you didn't realize, some of you, that there were actually also parallel deep dive roundtables happening. And on the ground floor, the one on EU funding just finished. So we really desperately want to join them outside in the garden, which is set up a bit like a wedding. So hopefully you'll enjoy that. But main thing is I would like to actually invite the ISFC team to the stage, please. And I mean the entire team, everybody who has the ISFC badge. Chop, chop. So behind every great event, there is actually a great team. Sadly, some of our former colleagues who have joined, I can see one person sitting. So some people are the people who work on the summit, while other people still take care of all the other things and projects and things that are happening in the background. So this is our current team, and I really want to thank each one of us. Martina is picking up children, if you were wondering. So we have a fantastic team. We also have former colleagues who have built the summit, because it's a multi-annual effort. The next year's summit starts tomorrow. That's how it actually goes. And we also run other events. So if we can get the slide up that was to follow. We also will have a taxonomy and international impact assessment event in Dubrovnik, which we're building together with the World Bank, European Investment Bank, and some other actors. You can't see it, it's in Dubrovnik. So the point is that we want to be active, and we also want to hear from you. So there will be feedback forms coming, any suggestions, any kind of help. If you want to be involved, get in touch. We like people and we like collaborations. So with that, I would actually like to close the summit and invite you to stay in touch, come to the next edition, which, as I mentioned, will be embedded into the Prague Climate Week, which will actually go all across the Czech regions, and eventually we want to make it a CEE kind of climate week coordinating between different cities. So we have high ambitions, and we're going to keep trying.
And as the last note, let's please give one really big round of applause to Linda, because actually this is her idea. She is the driving force behind the summit, not only this one, but all the previous summits as well. So please, round of applause for you as well. Okay, well, and let's get some drinks then, I guess. So please.
It's a free bar.
Free bar, yes. Free bar, some snacks. Let's do that. Let's use and enjoy the hotel for the end, and see you outside.